This free comprehensive MLO exam audio learning series will all the information you will need to pass Safe Mortgage Loan Originator, MLO, exam. Let's dive right into the materials. Chapter 1, History. How did we get here? Providing credit and the lending of money has been around since the dawn of organized mankind. On the other hand, mortgage loans are fairly new, they've only been around for a few hundred years. We offer this brief history lesson to provide you with some context for why it's necessary to take this class and to better understand the reason things are done in the way they are today. Before the 1990s, the concept of a traditional mortgage, a 30-year fixed-rate loan, is a fairly recent phenomenon with its roots well into ancient times, and in its current format is something that is fundamentally American. Prior to the Great Depression, most mortgages were private agreements between property owners, sellers, and the person or people attempting to become owners, buyers. Prior to the Depression, most mortgages were short-term in length, 3 to 5 years, and required the borrower to make a substantial down payment as well as a balloon payment at the end of the financing period. For many Americans, it wasn't until after the Great Depression and Franklin D. Roosevelt's presidency that the opportunity of homeownership became a reality. In an effort to spur the American economy and foster security in the banking industry, Roosevelt created the Homeowners Loan Corporation to refinance the loans made previously in the private sector. The Federal Home Loan Bank was also created to regulate savings and loan associations. The Federal Deposit Insurance Corporation was created to protect borrower deposits. These organizations were precursors to the Federal Housing Administration, FHA, which was created to reassure lenders in cases of borrower mortgage defaults. The FHA also emphasized the offering of a lengthy mortgage term, popularizing the 20-year mortgage, which eventually led to the advent of the 30-year product, which today, at least in the United States, is considered the traditional mortgage. Over time, the American mortgage industry evolved. Once the FHA was established and maintained a steady level of financial confidence in mortgage loans, the mortgage and homeownership became synonymous with the American way of life. Along the way, additional mechanisms and supports developed, such as VA loans for military veterans, and USDA loans to provide housing opportunities in rural areas. As a financial instrument and benchmark, the mortgage often served as an American's most important financial commitment. Because of this commitment and the almost certain appreciation in property value, Americans often refer to their home as their greatest financial asset or investment. The advent of Fannie Mae, Freddie Mac, and Ginnie Mae provided additional assurances to the industry that the home mortgage was a safe financial tool. After the 1990s, even though being a homeowner equated to the American dream, buying and owning a home remained out of reach for many until the mid-1990s. Prior to the last decade of the 20th century, obtaining a mortgage required a level of qualification that included high income and asset support, significant down payment, a strong credit profile, as well as a qualifying home to collateralize. To make more mortgage lending possible with fewer restrictions for borrowers, additional capital with fewer restrictions would be needed. Such capital was limited due to restrictions such as the Glass-Steagall Act of 1933, which maintained a barrier in the financial marketplace between commercial investors and the mortgage marketplace. For more capital to be available for mortgage lending, impediments such as Glass-Steagall would need to be lifted. Technology and the ever-increasing desire for investment opportunity drove officials to lessen restrictions on capital markets and make it easier for Americans to buy a home. In 1999, the Gramm-Leach-Bliley Financial Services Modernization Act I repealed some of Glass-Steagall's hurdles for investors to actively participate in the funding of mortgages, thus providing lenders with additional funds and making mortgages more available. As far back as the early 1970s, Freddie Mac was offering a product of packaged mortgages into investment instruments called mortgage-backed securities, MBS. The MBS allowed Freddie, and Fannie Mae soon after, to keep cash flowing in the mortgage marketplace through the sale of their MBS. The stability and constant increase in real estate values made MBSs a safe bet for investors. The deregulation of the 1990s allowed for more elaborate forms of the MBs to be available in the market, and lenders along with investors took advantage of the opportunity. In 2003, the American Dream Down Payment Initiative implemented an aggressive agenda for making homeownership even easier by lessening standards and easing controls on lenders. As a result, lenders focused less on borrower qualifications and more on collateral in determining loan approval. This led to the development of the subprime mortgage. Subprime mortgages made it possible for previously unqualified borrowers to purchase homes. These subprime loans came with higher fees and interest rates for the borrower, which in turn meant higher profits for lenders and loan originators. As long as property values continued to increase, investors considered the MBs, including those comprised of subprime mortgages, one of the safer investments available in the financial marketplace. History: the mortgage meltdown, a financial crisis and new rules. The mortgage meltdown, a financial crisis and new rules. Unfortunately, in the mid-2000s many of these subprime borrowers were unable to pay their mortgage bills. This began a domino effect in which more and more loans went into default, triggering foreclosures that led to a depressed real estate market and decreasing property values. Lenders and investors who needed to collect on the mortgages now found themselves holding properties that were worth more on paper than their actual value in the market. This mortgage meltdown not only impacted everyday borrowers, it also had devastating consequences for the entire financial marketplace because of the market's reliance on the MBs as an investment tool. The result was a near collapse of not only the American financial system, but also the world's financial markets. In response to this collapse and to prevent future occurrences, a significant restructuring of regulations and rules was enacted. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 20,101 changed the oversight and capitalization of financial institutions, added licensing and education standards for mortgage professionals, and limited the availability of riskier products in the marketplace. Today the mortgage industry is one still adjusting to the changes made after the financial crisis and working to maintain access to the American dream of owning a home. Dodd-Frank Wall Street Reform Act. On July 21, 2010, Congress signed into law the Dodd-Frank Wall Street Reform and Consumer Protection Act. This act was created to address economic concerns in many financial markets, including the mortgage industry, by improving regulations within certain consumer protection laws. These regulations apply to financial institutions, appraisers, and financial and investment advisors. Besides strengthening the consumer protection responsibilities of federal banking agencies, the Act also established the Consumer Financial Protection Bureau, CFPB, in order to consolidate the federal regulatory authority for those protections. The CFPB, otherwise known as the Bureau, oversees and enforces the regulations of the Dodd-Frank Act, with its sole purpose being to protect consumers from deceptive and unethical financial practices. Dodd-Frank removed a wide variety of agencies overseeing consumer protections and consolidated the oversight of those protections under CFPB control. In addition, the Dodd-Frank Wall Street Reform Act defined and specifically outlawed UDAAPs. Unfair, deceptive, or abusive acts or practices, UDAP. What is a UDAP? A UDAP is an unfair, deceptive, or abusive act or practice. The Dodd-Frank Act provides the CFPB with wide regulatory and enforcement powers as they relate to enforcing the prohibition of UDAAPs in the mortgage industry. Because of the all-encompassing nature of UDAAPs and their broad definition, the enforcement of UDAP prohibitions often serves as a main component in ethics investigations. Unfair, defined unfair acts or practices are activities that can cause injury, usually financial harm, to the consumer, especially if that harm cannot be avoided. There is an exception to the concept of the behavior being unfair if the benefit of the act outweighs the injury caused. Chapter 2, Who's Who? Over the course of this training, you will encounter numerous players in the mortgage industry. Here is a short list of some common roles: loan originator, lender, investor, consumer, customer, regulator. Here's a brief description of these roles. Loan originators. A mortgage loan originator takes a residential mortgage loan application and offers or negotiates rates and terms of a residential mortgage loan for compensation or gain. Mortgage loan originators, MLOs, may be simply referred to as loan originators, LOs, and the term MLO can be used to describe a company, branch office, an individual or a mortgage broker. Let's explore each one more in depth. Loan origination companies. Loan origination companies employ individuals who serve as individual loan originators. Both the company and the people who work directly with consumers negotiating loans must be licensed if the company is a non-depository institution. Individual loan originators. This is you after you take this course, prepare for the exam, and pass the test. You will work with borrowers to find them the best mortgage solution possible depending on their needs and qualifications. Remember the definition of a mortgage loan originator: a person who takes a residential mortgage loan application and offers or negotiates rates and terms of a residential mortgage loan for compensation or gain. Mortgage brokers. Mortgage brokers are loan originators who work independently of lenders. They originate mortgages for the customer and then find a lender to provide the loan. Since mortgage brokers are mortgage loan originators, they too can be companies or individuals. Other common roles in the mortgage industry. Other common roles in the mortgage industry. Processor. A processor works for a mortgage loan originator and provides clerical functions such as collecting documents or verifying information with borrowers. Some organizations may call this person an assistant, clerk, or administrator. What sets them apart from the MLO is that they are not permitted to negotiate rates and terms with borrowers. No special licensing is required for this role unless the individual works for the company as an independent contractor. Underwriter. The underwriter works for the mortgage loan originator and reviews loan applications to determine the risk associated with granting the borrower a mortgage loan. As was the case with the processor, the underwriter is not allowed to negotiate rates and terms with the borrower. They are not required to carry a special license unless they work for the company as an independent contractor. Appraiser. The appraiser works independently of the mortgage loan originator and provides the service of determining a property's value. This determination of value can be provided in a variety of ways, including a physical visit to the property and by comparing the home to similar properties. The appraisal is most often paid for by the borrower as part of the borrower's closing costs. Appraisers follow the guidelines of the Uniform Standards of Professional Appraisal Practice, USPAP, are licensed at the state level, and may need to register or be licensed by local jurisdictions. Title agent. The term title agent may refer to a title company or the individuals working for the company. Additionally, title agents may be referred to as abstractors or title attorneys. The title agent works independently of the mortgage loan originator, is chosen by the borrower, and typically paid a fee as part of the mortgage transaction's closing costs. Title agents research the ownership. Title is another word for ownership, associated with the property upon which the loan is made. The title agent also offers forms of title insurance, which protects the lender or borrower in case of future claims against title. Real estate agent. The real estate agent is an independent party working on behalf of the buyer or seller in a purchase transaction. Sometimes referred to as a realtor, registered, or real estate broker, this individual's focus is the sale of the property. Real estate agents typically are licensed in the states where they operate. Lender. A lender is a person or company that makes loans for real estate. Sometimes in legal speak the lender will be referred to as the mortgagee. Some lenders, but not all, also originate mortgages. It is not a requirement for lenders to write their own loans. Investor. An investor is a person or organization that puts money into financial arrangements, property, etc. with the expectation of achieving a profit. Regulator. A regulator is a person or institution that supervises and controls a financial system in order to guarantee fair and efficient markets and financial stability. In our industry there are both state and federal regulators. The state regulators oversee mortgage origination in their particular state, while the federal regulator oversees mortgage origination at the federal level. Consumer or customer. In the mortgage industry, it's important from a legal perspective to know the difference between a consumer and a customer. How the person is designated helps to determine what information must be provided to them and when it must be given. Customer: a customer is someone who is in an ongoing process or relationship with a financial services provider. Consumer: a consumer is an individual who may obtain financial services. They're shopping. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO Chapter 3, MLO Timeline, the 4CS MLO Timeline, Mortgage Loan Origination. In this chapter we will provide a summary of the mortgage loan origination process through the eyes of a borrower and their conversations with an MLO. We'll also provide a visual timeline to supplement the review. While this summary will help you associate where in the mortgage loan origination process certain activities take place, we want to caution you that this should serve only as a guide. In reality, every mortgage loan origination company uses methods unique to their specific organization to originate mortgage loans, and while they are similar across the industry, they may be described or coupled differently. The 4CS. Before we get into the timeline, it's important that we clearly establish the main determinant in how a mortgage borrower qualifies for a loan, the 4CS. The 4CS are the main foundational criteria that mortgage loan originators use to determine if a borrower qualifies for a mortgage loan. Each C stands for a specific item on the qualification spectrum, and each is equally important in determining if a borrower qualifies for the mortgage. Let's break it down with a quick rundown on what each one of the 4CS represents: credit, the borrower's credit score and history. Most mortgage programs require a minimum credit score and a history of proper credit account management to qualify for a mortgage loan. Capacity, the borrower's income or their incoming cash flow versus the monthly bills they're obligated to pay. The amount of income a borrower has will need to be compared to their debt obligations so the MLO can determine if the borrower can afford the loan, or has the capacity required to pay back the loan. Cash, the liquid assets the borrower has available to cover any shortfalls. The MLO will typically require a borrower to have money in reserves to cover any interruptions in the borrower's monthly income. Collateral, the property pledged as security for the loan. The value of the home and ownership responsibility must meet the standards required by the lender. Think of each C as if it were the leg on a table. For the table to sit squarely on the ground and not wobble requires each leg to be of equal length and strength. If one leg is shorter than the others or not as strong, the table may lean or collapse. Such is the case with the borrower's qualifications. If one of the qualifying factors, say the borrower's credit score, does not meet the standard, the likelihood is that the borrower does not have a strong enough base to support the repayment of the loan, and thus the lender is not likely to provide a loan. We'll talk more about specific qualification requirements in a later chapter dealing with programs, but for our purposes right now we'll focus on where and when in the mortgage loan origination process each of the 4CS is provided by the borrower and when they are confirmed. Now, let's follow the borrower Renata through the mortgage loan origination timeline. MLO timeline: shopping for a new home, pre-application. Shopping for a new home, pre-application. In the pre-application portion of our story, we want to give you an idea of how a borrower can get connected with a real estate agent and an MLO. The mortgage process can begin in many different ways, but the section below will illustrate a common scenario of how a borrower begins the process of obtaining a home loan. Every week Renata Vento's paycheck is directly deposited into her checking account. After she pays all her bills, Renata takes most of what's left and transfers the money into a special account she set up 4 years ago after her divorce. She set the account up to help her save enough money for the down payment on a new home. She never dips into the balance for frivolous expenses, and over time she's accumulated a pretty healthy savings balance. Today she was driving home from the office and she saw a for sale sign in the front lawn of a house on the corner of Main and Elm, 100 Elm Street. She's always appreciated the house's nice front porch with room for a couple of rocking chairs and strong beams from which to hang the type of flowering baskets that she loves. She once had the chance to attend a book club meeting in the home and had seen the first floor, a nice living room opening into a smartly laid out kitchen. There was also a small powder room on the first floor. The woman who owned the house at the time mentioned that the second floor had a good-sized master suite with an attached bath and a guest room that was being used for sewing space. Wrapped around the home was a well-cared-for lawn that Renata felt she could easily manage on her own. I wonder what they're asking, she thought. She called the number on the sign from her cell phone. Mrs. Morgenstern's moving in with her daughter, the real estate agent said. She can't get up and down the stairs anymore. Can you tell me what she's asking for the home? Renata asked. Renata could hear some papers rattling in the background. We listed at 185.9, came the voice on the other end. And I'm pretty sure that we'll move it quickly at that price. You're the third person to call today and I'm doing a showing for one of the others tomorrow morning. Renata murmured as she thought. Any chance I could take a look at the house tonight? Absolutely. Mrs. Morgenstern's already moved out, so we can get in any time, said the agent. But I do need to make sure of one thing before we do anything else. Do you have financing in place? In today's market I only show homes to serious buyers. It's such a tight market that if you don't have the finances in place all we're doing is wasting time. Oh. Renata hadn't even considered the money piece. She thought that her finances were in good shape. She had been saving money, paying her bills on time, even using a credit tracking app to keep an eye on her credit score, which was in the mid-700s the last time she checked. But she didn't have $185,900 available and didn't know who to turn to for a loan. Maybe the bank, she thought. I really hadn't thought that far ahead, but I think I should be able to get a loan. Not to worry, said the real estate agent. I work with a lot of mortgage people. Do you have something to write with? Let me give you some names and numbers. Renata scribbled down the information provided by the agent for a local mortgage broker as well as a mortgage loan originator with an online lender. They're both good. I've worked on many deals with each of them, said the agent. You may also want to reach out to your bank. Thanks for the information, but it sounds like this may take a while before I'll have anything in place, Renata said. I guess I'll call you in a few weeks, and maybe I'll get lucky and the house will still be available. MLO timeline shopping for a new home, pre-application, nonsense. The agent chuckled. Provided you meet some requirements, either of these folks should be able to get you qualified in an hour or two, at least with a pre-approval or pre-qualification letter that says you meet their standards for a particular loan amount. Really? With today's technology, you'd be amazed. Tell you what, the agent said. It's 3:45 right now. Why don't we meet at the house at 7:30 tonight? That should give you enough time to make some calls. Okay, Renata said. I'll call you if I can't make it. Do you qualify? Application. In our application portion of our story, you will see an example of an initial conversation between a borrower and an MLO for a purchase transaction. As you are reading through this part of the story, consider the following points. One of the first actions our MLO, Jervis, takes is confirming the first of our 4 Cs by pulling up a copy of the Renata's credit report. Why do you think that is? What kind of information does Jervis see listed? Jervis asks about Renata's income in comparison to her debts. Which of the 4 Cs deals with the borrower's income and debts? Why would Jervis want to know about this? Take a close look at the kinds of questions Jervis asks Renata. What sticks out to you? What other information is he trying to gather and why? Based on Jervis' explanation, what different elements make up Renata's monthly mortgage payment? How does Jervis explain the intent to proceed? After Renata hung up with the real estate agent, she dialed the number of the local mortgage broker. After a few rings, a friendly voice answered. Hello, Jervis Roberts Mortgage, Jervis speaking. How can I help you? Renata introduced herself and told Jervis about her conversation with the real estate agent and her interest in getting a mortgage to buy a home. So you found a house and want to see if you qualify for the mortgage. Well, Renata stammered, "There's a house I may be interested in. I haven't even looked at it yet. You know, toured it or whatever, but it's a house I like." "Okay," Jervis said. "Do you own a home now?" "No," Renata said. "I'm a renter." "Okay, that's great. That means you may be considered a first-time home buyer, which means you would be eligible for some additional options with the mortgage," the broker said. "I don't know if I'm even interested in a mortgage yet," Renata said. "But for me to look at this house, they're asking for some kind of approval or letter." "Not a problem," Jervis said. "Many sellers now require potential buyers to have some kind of financing in the works before they'll even let you look at the home. You and I can go through the pre-qualification process right here on the phone if you've got about 30 minutes, and we'll see what types of loans you qualify for. Provided everything works out, I can email you a pre-qualification letter within the hour." "Really?" Renata couldn't mask her surprise. "How much does it cost?" "For right now, just your time. If, after you look at the numbers, you want to move forward, there will be costs for originating the loan and the services needed. But I'll show you all of those costs before you're required to pay anything," he said. "Sounds good." The broker continued, "We'll need to look at your credit, so I'll need your permission to pull a credit report. I'll also need your address, date of birth and social security number so I can access your credit report. I'll also need to get some additional info from you, like how much the asking price is on the house, how much money you have available for a down payment if one is needed, your income and of course your full name." Renata hesitated. That's a lot of personal information, she thought. Then again, I was referred to him by the real estate agent. "Okay, let me know what you need." "I'm ready." "Okay," Jervis said. "The first thing I need is your permission to pull your credit in conjunction with your interest in obtaining a mortgage loan." "You have my permission," Renata said. After receiving Renata's information, Jervis pulled her credit report and briefly reviewed the information with her. "Well, it looks like you've got a credit score of 767, which is pretty good. I see you've got a couple of credit cards listed here with small balances and I think a car loan with Honda. Is that correct?" "Yes. There doesn't seem to be any issues on the credit side," he said. "Do you have any other debts that aren't showing up here? Anything else that you have to pay monthly or will be required to pay in the future?" "Nope. I've been pretty thrifty since my divorce 4 years ago. I even pay my credit cards off each month. I don't like debt." "Okay then, what we need to do now is compare your income to your debts," Jervis said. "I can use the information from your credit report for the bills, but what about your income? Are you paid hourly or do you receive a salary?" "Salary," she said. "I bring home $1,723 every 2 weeks. Is that after taxes?" "Yes." "Okay," the broker said. "Do you know what your gross income is? Before taxes and anything else gets taken out." "Oh. My annual salary is $67,000 per year." "Great," he said. Renata could hear him tapping on a keyboard in the background. "That comes out to $5,583 per month in gross income. Does that sound about right to you?" "Yes." "Okay," he said. "If after we go through this process you decide you want to move forward with me in getting the loan, we'll ask you for some pay stubs and other paperwork. For right now we can just go with these numbers. Now, just a couple more pieces of information we need so I can run some numbers for you. What's the asking price on the house?" $185,900. "Do you have an idea of how much you'd like to put down as a down payment?" "As much as I need to," she said. "I have almost $36,000 saved up." "Is that enough?" "Will I need to use all of it?" "It should be enough, and you may not need to use all of it," he said. "Each loan program has different down payment requirements, and you'll also need to consider closing costs and other expenses like moving costs and things like furniture and appliances that you may need. Of course, the more money you put down, the less you'll owe. What I'll do is use the program's minimum down payment requirements to figure out your monthly payment, and then we can go from there. Great, she said as she heard more typing in the background. MLO timeline: do you qualify? Application: tell you what, Renata, he said. Based on the information you've provided, I think we have a number of options available for you. If you can give me about 30 minutes here to look at what I think best fits your needs, I can call you back and go over the numbers with you. That would be fine. One last thing, he said. Based on your current finances, how much would you be comfortable spending each month on housing? Your current rent payment is $1,100. Is that a good number for you? Yes. I'm comfortable with that. I could probably afford about $100 more each month. Okay, the broker said. I'll call you back in a little bit. Jervis called her back 25 minutes later with 3 different loan options. He said that she qualified for many others, but based on their conversation, these were his recommendations. After further discussion, they agreed that a 30-year fixed-rate mortgage would be the best option for Renata. This is probably the only house I'll ever buy, she said. And I don't see myself changing jobs or income brackets anytime in the future. Let's talk for a moment about how the payment schedule works for this loan, Jervis said. With the fixed rate product, you'll be making something called a fully amortizing payment each month. What that means is that by making your payment each month on schedule, you'll be reducing the principal balance as well as paying the full amount of interest owed each month. So let's say that when you first take out the loan after you've made your down payment and everything else, your initial loan balance is $165,000 and your qualifying interest rate is 5%. With a 30-year fixed-rate mortgage at 5%, the monthly payment would be $885.76. So each month for 30 years you'll have 360 equal principal and interest payments of $885.76. The other thing that we do not have included in the principal and interest payment is the cost for insurance and taxes. Those are considered when we look at your total payment. Before I called you back, I got an estimate on annual property taxes and homeowners insurance for the house you're interested in. It looks like you'd expect to pay about $2,400 per year in property taxes, and $1,200 per year for homeowners insurance. We'll divide both of those numbers by 12 to include a monthly portion of each when figuring out your housing costs, which means another $300 per month for housing. So your total beginning payment in this case would be $1,185.76. I can't guarantee that the total payment will be the same for the life of the loan because taxes and insurance will probably change at some point, but the principal and interest portion will not change with this type of loan. Great, I think I understand. What's next? I need to send you some forms called disclosures that you need to review. I just sent a link to your email, so you can view them on our secure server. They basically cover the information we just discussed. Provided they meet with your approval, I'll need to get a disclosure called the intent to proceed with the loan from you, and that will allow us to continue the process. Once I have your intent to proceed, I can send over the pre-approval letter for the real estate agent. Wow! You've got my intent or approval or whatever, Renata said. I appreciate that, but not so fast, he said. You'll need to review the disclosures before you provide your intent. In the meantime, I can tell you that even if you agree to move forward now, it puts you under no obligation to complete the process. You can still decide later during the process not to do the loan. You are not legally obligated to the mortgage until after you sign the closing documents. The disclosure that lays out all of the costs and arrangements for the loan is called the loan estimate, or LE. I'm sending it to you now. Renata saw another email pop up on her screen. I'm clicking on the link to your site now and looking at the documents. The numbers are what we discussed. Are these written in stone? MLO timeline. Do you qualify? Application, not necessarily, the broker said. Some things may change during the process, but if they do I'll let you know and we'll have new disclosures for you to review. Okay, she said. I guess I'm ready to proceed. Great. Just go ahead and scroll to the bottom of the screen and you'll see a button that says, I intend to proceed with this loan. Click the button and you'll see our pre-approval letter in a few minutes in your email inbox. Initially approved and ready to go, processing, our timeline story is now in the processing phase. As you read through this next section, think about the questions below. What are the differences between Olivia's responsibilities as a processor and Jervis' responsibilities as an MLO? What kind of documentation is being collected and why? What is a 4506C? Renata received the pre-approval letter along with some other documents in her email from Jervis. She printed the letter and took it with her to look at the house with the real estate agent that evening. She loved the house, and armed with the letter, Renata made an offer for the full asking price. Once the offer was accepted, Renata called Jervis with the news and asked what was needed next. Wow, he said. You really do move fast. I had been in the house before and really liked it, Renata said. I checked some local home values online before I met with the agent and the price seemed to be at market level. So I made an offer and wrote the real estate agent a check as a good faith deposit. She called the seller and they accepted. We also filled out a purchase contract. The agent said you'd probably need that. She's right, he said. We'll need that and, as we discussed in our earlier conversation, we'll also need some other paperwork like pay stubs, bank account information and tax returns. I'll send you a complete list. Do you need me to email those? Whatever is convenient for you, he said. You can scan them and send them over, or my office is only a few blocks from where you work. You can bring everything to my office and we can make copies here. If you come in, I can also introduce you to my processor, Olivia. She'll be the one you'll be in contact with during this process, and she will manage your file during origination. Renata smiled to herself. This was all going so well, but she didn't have the documents with her and she would be tied up in meetings for most of the day. Okay, send me the list. But I'm already at the office and I won't be able to look for all of that stuff until tonight. Not a problem. Do you have second right now to look at what we'll need? Sure. Okay, the broker said. I just sent you the email. Take a look and let me know if you have any questions. Renata opened the email and started to read aloud the list of items: last 2 pay stubs, last 2 years W-2 forms, last 2 months bank statements, last 2 years tax returns. What's this 4506C form? Great question, he said. You'll need to sign that so we can have the IRS send a transcript of your returns to us for review. Most loans have program requirements for underwriting. In this case, our underwriters will review the information you provided to me on the phone and compare it to the documents we're asking for to ensure that you meet the program's qualifications. MLO timeline initially approved and ready to go, processing. At this point in the process, Olivia will be gathering all of your documentation and information for our underwriters to review. In the business we call this phase processing, and while everybody does things a little differently, at our office Olivia processes the loan and then packages everything up for the underwriter to review. She'll also be the one who will arrange for the appraisal and title work to be done, but we typically don't order those until after the underwriters have matched everything up. So underwriting and processing kind of occur at the same time. For us they do, he said. We're a fairly small operation because we like to interact directly with our customers. And because we are that small, we all have multiple hats to wear. I know what that's like, Renata said. It's the same way at my office. Provided you find everything we need when you go home tonight, he said. Would it be convenient for you to come by our office sometime tomorrow? It should only take about 30 minutes, and I can get your signature on some documents as well. Would 1 p.m. work? She asked. It's my lunch break. Only if you join us for a sandwich, he said. Tomorrow's deli day at the office and we'll have a sandwich tray brought in. Sounds great, she said. I'll see you tomorrow. As requested, Renata was able to find all the documents on Jervis' list. She showed up for lunch the next day and enjoyed a sandwich with Jervis and Olivia while the copies were being made. Usually at about this point in the process the customer is wondering how long this whole thing takes, Olivia said. I'm sure you're curious. Everything's gone so fast, Renata said. I'd guess this will take a week or so. I wish it were that easy, Jervis said. Our purchase loans usually take about 45 to 60 days to close. We do try to move certain loans through faster, especially if the purchase agreement lists a specific date by which the loan needs to close. Yours is coming up in less than 45 days, but we'll be able to make it work. Up until now you and I have been able to control the process, but now the heavy lifting comes on our end. We need to go through the underwriting process and that usually takes a few weeks. There's a lot of moving parts, document reviews, appraisal work, inspections, title work. Yeah, Renata said. I guess I really hadn't thought about all that. Not to worry, Olivia said. You've got some arrangements to make on your end as well. Moving, setting up utilities, and, of course, shopping for new furniture. I guess I'll be busy too, Renata smiled. Okay, Jervis said as he retrieved the documents from the copier. Here's all of your stuff back. We'll need you to sign some of these, Olivia said as she pointed to some disclosures on the table. Jervis can review them with you before you sign. One of the laws that we must follow says that only a licensed mortgage loan originator can discuss the rates and terms of a mortgage with the borrower. So during the process, if you have questions about rates or terms, he's the one you'll talk to. Otherwise, I'll be your main point of contact. Jervis walked her through the disclosures and documents needing her signature, which she reviewed and signed. Olivia made copies of the newly signed forms and added them to the stack of Renata's copies. She kept the original set in the folder on her desk. I'll get these over to our underwriting team. It will probably take about a week to get through them. Once they do the review, they may ask for some additional information, and I'll call you if they do. Otherwise, expect to hear from me toward the end of next week and we can plan for the appraisal with the agent. In the meantime, here's my card. Please do not hesitate to call me if you have any questions. Borrower qualification, underwriting, MLO timeline. Borrower qualification, underwriting. Now we begin the underwriting portion of the loan process. In underwriting, all of the 4 Cs will be verified. Pay particular attention to the following pieces as you read through this next section. How does our underwriter, Khalil, verify Renata's capacity and capital? Why do you think Khalil wants to confirm how much money Renata has in the bank? What is Khalil's main function as the underwriter? How does Olivia assist him throughout the underwriting process? How do their roles differ? How is the collateral verified? Who is responsible for completing the appraisal? How does Olivia explain title work to Renata? Olivia took the folder with all of Renata's paperwork down the hallway to the underwriting office. Hi, Khalil, she said as she approached the desk situated midway into the room. Jervis just wrote a new customer, and I see that you're the next one up for a folder. The man behind the desk didn't take his gaze off the computer screen in front of him. Please tell me this is an easy one, I'm still working through these others, he said as he waved to a pile of folders on the corner of his desk. Should be, she said. Nice woman, no co-borrower, good credit. All of her paperwork is in order. He made a note in the open file on his desk, closed and held it in the air. Good, because this one isn't easy. In fact, Mr. Cavill doesn't have the income needed to meet requirements. It would seem that he may have overestimated a little during application. She traded folders with him and said, "Sorry to hear that. I'll take this back to Jervis so he can call Mr. Cavill. Maybe he can rework the loan." "Thank you," Khalil said as he opened Renata's folder. 767 credit score? Great. He flipped through the pages. 30-year fixed, plenty down, money in the bank. As long as everything checks out we should be able to get through it in a few days. Khalil closed Renata's file and stuck it at the bottom of the stack next to him and then picked up the top folder and began to scan as Olivia turned and walked away. For the next few days, Renata's folder moved steadily along with the others in the stack on Khalil's desk. When it reached the top, Khalil opened it and typed the loan number into the database screen on his computer. Renata's information was already in there, along with some recent updates provided by Olivia showing that her employment and bank account balances were verified. There was also a contract sales date by which the loan needed to close listed in the proposed closing date field. He then pulled up a copy of Renata's application on the screen and reviewed the pay stubs to see if they matched what was listed, to the penny, he thought. Then he checked the W-2 forms to confirm the last 2 years' income. Next, he pulled up the numbers from the IRS transcript on his computer and compared them to what was listed on the tax returns. Everything matched. He returned to the application and confirmed that the debts listed on the application were the same as those listed on the credit report. Once the preliminaries were completed, he took out his calculator and computed whether she could afford the loan and whether her down payment would meet the program requirement. Everything was in order. He pulled up another screen on his computer and began to complete fields on multiple pages on the screen. By the time the afternoon reached its end, he was satisfied that Renata qualified for the mortgage she had applied for. He picked up the phone and dialed. MLO Timeline Borrower Qualification, Underwriting, "This is Olivia," came the voice on the other end. "It's Khalil," he said. "I know you'll get this in tomorrow's batch report, but I figured I might catch you before you leave for the day. I just finished Renata Vento's folder. She's good to go. I was hoping you could order the appraisal and title work today so we can get a jump on this. The contract date is coming up pretty quick, so I want to make sure we keep everything moving." "Awesome," she said. "I'll take care of it right now. Thanks for the heads up." Olivia hung up with Khalil and clicked to call an often used contact. After 3 rings a voice said, "Thanks for calling Northeastern Appraisal. No one is available to take your call, but if you'll please leave a message with your name and the nature of your call, we'll get back to you as soon as possible. For faster service or to request a service order, please visit our website at anyappraisal.net. Thanks again for calling." When the message ended, Olivia spoke into the receiver. "Hi, it's Olivia at Jervis Roberts. I was hoping I'd catch you. We've got a clean app ready for an appraisal for a house here in town on Elm, and we're on a tight timeline. I'm hoping we can schedule with you guys by the middle of next week. The name on the file is Vento, Renata. I'll put the order in online right now, but can you please call me when you get in tomorrow and let me know if it's possible? You've got my number. Thanks." After hanging up, she called another often used contact, but this time a loud voice answered. "National Title. How can we help you?" "Hey, Maria, glad I caught you." "Hey, Olivia." Maria said, "What's up? I need a quick turnaround on a purchase." "How quick?" Maria asked. "Middle of next week." Olivia said with some reserve. "It's a house over on Elm. Doesn't matter to us as long as it's in the county," Maria said. "Yeah, I guess that makes sense with the title work being done at the county records building," Olivia laughed. "What do you think? Can you do it? How complicated is the deal?" "One owner, no mortgage on the house currently," Olivia continued to give her the rundown on Renata's file. "Seems pretty straightforward," Maria said. "Lucky for you I just had a cancellation for tomorrow. Can you get the info over to me by 10 tomorrow morning?" "Oh yeah," Olivia said. I'll shoot the documents over to you when we hang up. Great. As long as it's as simple as you say, we should be able to turn it around for you quickly, Maria said. Hey, I've got to run. You need anything else? No. Thanks for your help, I'll have everything over to you within the next 30 minutes. The next morning Olivia called Renata to update her on the loan origination's progress. Your side of the approval's pretty much done, Olivia said. Now we just need to get things sorted on the property. I ordered the title work last night, and this morning the appraiser called the real estate agent to see about scheduling the appraisal visit. Do I need to be there? Renata asked. MLO timeline borrower qualification, underwriting, no. Typically the appraiser will work with the real estate agent or current owner and do their work with one of them on the property. They'll take some measurements and pictures, then they'll check recent sales of similar homes in the area to set a value. Is the appraisal really necessary? Renata asked. I mean, we already agreed on the price. You may have agreed on the price, but our underwriters will not approve a loan unless the home's value meets or exceeds the purchase price. What happens if it doesn't? You'd probably want to renegotiate with the seller, Olivia said. Or restructure the loan so that you put more money down to cover the difference. I don't think you have anything to worry about here, but if that's the case Jervis will call you and walk you through it. Renata crossed her fingers. Okay. What about the title work, what's that for? The title company will research the history of the property, confirm its current owner and ensure there are no liens or claims against the property, Olivia said. Once they do that they let us know that the property has a clean title and that they are willing to insure the property against the possibility of a previously unknown claim being made against the property after you take ownership. That's what the cost for title insurance is for on your disclosures. Does that happen? Occasionally, Olivia said. With the technology and record keeping we have now, it's fairly infrequent. So why do I need the insurance? Renata asked. Lenders won't make a loan without title insurance protection in place, Olivia said. I guess that makes sense. So, now it's a little bit of a waiting game while they do their thing. We'll get their reports back probably about the middle of next week and then our underwriters will take a look to make sure everything works. Olivia paused for a moment. I don't want to overpromise here, but we could have this whole thing wrapped up by the beginning of the following week. You should plan on hearing from Jervis by Monday or Tuesday of that week. And then the house is mine. Well, we have to schedule closing, that's when you will sign all of your final documents. There's also some disclosures and documents you'll want to look at before we close. Okay, Renata said. I've had my fingers crossed for 2 weeks. I guess I can go for another 2. Hang in there, Olivia said. Everything's moving along well. The next week passed slowly for Renata, but she kept herself busy looking for a new washer and dryer. She arranged with Mrs. Morgenstern to have the kitchen appliances stay with the house, but the washer and dryer had moved with the woman to her daughter's house. As for the review of the property's value and ownership, the process moved quickly. On Wednesday, Khalil returned to his desk from lunch and found a new email from Northeastern Appraisal with the report for 100 Elm Street attached. He opened the report and smiled. The appraisal valued the home at $190,000. He spent another half-hour reviewing the report, and everything checked out. The appraisal report based 100 Elm Street's valuation on comparisons to recent sales of similar homes in the immediate area. The report also included photos, a map, and an attachment with further explanation from the appraiser about how and why he arrived at the value given. MLO timeline borrower qualification, underwriting. He switched screens on his computer and opened the log Renata's loan. He added some notes and filled out fields associated with the underwriter's review of the appraisal. Then he attached a copy of the appraisal and closed out of the screen. As he finished he noticed that Olivia was talking to another underwriter a few desks away. Khalil motioned toward her. Hey, Olivia, Do you have a sec? Sure, what's up? We're good for the appraisal on Vento, he smiled. Came in about $5,000 high. Oh, that's great. She said. Any news on title? He asked. No, but National said they would have it to us midweek, so probably tomorrow. Okay, he said. Just let me know. True to Olivia's prediction, the title report and a commitment to insure arrived the next day from the title company. The report confirmed everything that they expected, and the commitment to insure said National Title was prepared to handle the title insurance for the previously agreed fee at the time of closing. It's closing time. Our borrower's journey in the mortgage loan origination process is coming to an end. Take a close look at the questions below. How does Jervis explain why Olivia cannot answer any questions about the loan itself? What is the purpose of closing? Who is involved in the closing? How does Olivia explain why Maria is present? On Thursday the 7th, Renata was at the desk in her office when the phone rang. Hello, she said. Renata. The voice sounded familiar. Jervis Roberts calling. I've got you on speakerphone. Is that okay? Yes. Renata could feel her heart beating faster. I've got Olivia here with me, Roberts said. And then in unison Roberts and Olivia said, congratulations. Olivia stepped in with, we're all set on our end. Everything's approved. Renata struggled as if something was caught in her throat. Really? Oh my gosh. Oh, thank you. Jervis picked up the phone. Olivia has to step out, but we both wanted to let you know. There are some more documents and disclosures that you'll need to review. I've already put them on our secure website for your approval. When you get in there you'll see a bunch of things to review. I'm happy to sit down with you and walk you through them at your convenience. One of the disclosures I want you to pay particular attention to is the closing disclosure. The information on it pretty much mirrors what was listed on the loan estimate that you received at the beginning of the process. The closing disclosure just goes into more detail and includes the information for your escrow account, the account that holds your tax and insurance payments. Okay, Renata said. I'll take a look and let you know if I have any questions. MLO timeline closing. One more thing, he said. Olivia will be calling you to arrange the closing. It can't be scheduled for at least 3 more days because by law we have to wait at least 3 days for you to review the documents. And we'll need to make arrangements with the real estate agent and Mrs. Morgenstern. So I think we should stick with our original closing date. Oh yes, Renata said quickly. I've got some things I need to do now, hire movers, clean out my apartment, buy more stuff. Okay, he chuckled. Olivia will call you in a day or 2 to make the arrangements. Another thing, if you have questions about the loan itself, you'll need to talk to me. The law says that only a licensed loan originator can discuss rates and terms with the borrower, and Olivia's not licensed. She'd tell you that if you asked her about the loan. She already told me. Renata said. Thanks again. Olivia scheduled closing for 2 weeks later. The closing took place at Renata's office and was attended by Renata and Maria from National Title. Olivia explained when she called that part of Maria's responsibility in this transaction would be to serve as the closing agent. She told Renata that title companies often handled loan closings, but not always. In Maria's case she was also an attorney and a notary, so she could answer any questions Renata might have during the meeting as well as witness the signatures and then take care of filing the documents after they were signed. Renata looked at the stack of papers spread out on the desk between her and Maria. So, before we start, I usually like to explain the process with the borrower, Maria said. Is that okay? Yes, please. Renata said. Maria waved her hand over the papers. This is your closing package. You should have received a closing package from the mortgage company at least 3 days ago to review. Renata nodded. I brought it with me. Good, Maria said. These should be an exact copy of those papers. As we're going through this process, please review each document and ensure that it matches what you already received. I'll explain what each document is before you sign it. If you have any questions, please do not hesitate to ask. Renata nodded. Once you sign these, I'll take your certified check for the down payment to the lender. Tomorrow I'll meet with Mrs. Morgenstern so she can sign her documents and I'll give her the check for the full amount of the sale, Maria said. From there I'll file the papers with the county, and then I'll see you on Friday with the keys and your finalized documents. Any questions? Renata shook her head, grinning. I don't think so. Great, Maria smiled, handing a pen to Renata. Let's make you a homeowner. The signing took about an hour and ended with a handshake and smiles from both women. MLO timeline ownership. Our timeline is complete, and our borrower is now in their new home. Renata will now start making her mortgage payments to her servicer. For Renata, the first few weeks after closing were a whirlwind. She cleaned out her apartment, moved into 100 Elm Street and went through the steps of establishing herself in her new home. Things were busy on the business side of the mortgage as well. Once Maria had received and filed the loan documents and distributed all the necessary funds, the loan was sold by the lender to an investor. The sale of the loan did not impact Renata in any way, but the choices the investor made for the collection and processing of her loan payments did. A letter was sent to Renata indicating that the servicing of her loan, i.e., the collection and processing of her payments, would be handled by a company called ServiceStar. ServiceStar told Renata that a monthly statement would be sent to her. When time came for Renata's first payment, she sent it well ahead of the due date to ServiceStar. When ServiceStar received the payment, they credited the principal portion of her payment against her loan balance, thus reducing the balance slightly based upon the amortization schedule. ServiceStar also took the portion of the payment involving property taxes and insurance and placed it in her escrow account to have ready when it came time to pay the tax and insurance bills. A portion of the interest part of the payment amount went to ServiceStar for servicing the loan and the remainder was sent to the investor who owned the loan. Renata remained in her home for many years, making regular payment on time and in full, and lived happily ever after. What's next? The story you just read was written to help you understand the mortgage loan origination process. It was in no way a complete description of the process, nor did it touch on many of the complications that can occur during origination, like the challenges that occur when an appraisal does not support the value of the loan or title research uncovers unexpected ownership issues. The bulk of the course workbook and virtual trainings cover the specific topics of mortgage loan origination in more depth. As you're reading the text and participating in the training, pay particular attention to the importance the borrower plays in the process. The laws and practices we will discuss were created with consumer protection at the forefront of each component of the mortgage loan origination process. How loan repayment works. MLO timeline. How loan repayment works. It's basically understood that if you borrow something, you have to give it back. In the mortgage industry, when a loan is made, the borrower isn't only expected to pay back what they borrowed, but also interest, that goes directly to the lender, or investor if the loan is sold. There are a variety of ways that this repayment with interest is accomplished, but the most common is in the form of an amortization schedule. What exactly is amortization? Our glossary defines amortization as periodic payments on a loan requiring payment of enough principal and interest to ensure complete repayment of the loan by the end of the loan term. For example, if a loan is amortized over 20 years, and the correct monthly payments are made at the appropriate time, the loan will be fully paid off in 20 years including interest. The way the payment is allocated to interest or to the principal owed on the loan balance can change with different types of amortization schedules. The one we'll talk about now is fully amortizing. With a fully amortizing payment, each month more money is allocated to the principal, and less to the interest. Negative amortization. Although what we just described above, a fully amortizing loan, is the most common way loan repayment works, we do want to include another type of amortization. Negative amortization occurs when the mortgage payment made does not cover the full amount of interest owed. As a result, the amount of unpaid interest is added to the loan's principal balance. To put it simply, negative amortization is when the loan balance goes up, rather than going down like with a fully amortizing loan. Examples of negative amortization loans include reverse mortgages and graduated payment mortgages, GPM. In the case of GPMs, the loan only negatively amortizes during the rising payment period. Read more about these loan products within the products chapter. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO Chapter 4 Agencies Federal Law vs. State Law. Agencies. Long before the SAFE Act and the heightened federal interest in participating in the active oversight of mortgage lending, the states had their own rules and regulations for mortgage lenders. Each state has different laws unique to that particular state, and the way business and consumer protections are organized according to the state's governance. Through the coordination of the nationwide multi-state licensing system and registry, NMLS, the states work together with the federal government to regulate the industry. The following sections provide an overview of the state and federal agencies involved with the regulation of the mortgage industry. We'll conclude this section with the agency's activities. Federal law vs. state law. Back when the United States was being formed and the Constitution was being written, the states agreed to govern themselves in accordance with the laws of the country. These laws are called federal laws, and they control how the United States operates as a whole. At the same time the Constitution was adopted, the first 10 amendments to the Constitution, the Bill of Rights, were immediately added to ensure that specific rights for citizens would be protected. The 10th Amendment to the Constitution says in part, "The powers not delegated to the United States by the Constitution nor prohibited by it to the states, are reserved to the states respectively, or to the people." To simplify that, states are allowed to make their own laws as long as they do not contradict federal law. This is known as state sovereignty, and it was because of this that each state established their own rules and regulations for overseeing activities in their states, including the mortgage industry. The states. There are currently 59 different state and territorial mortgage regulating entities across the United States. Some states have more than one authority depending on the way state law and how the state's governance is organized. Each state's mortgage laws are unique to that particular state. For instance, the laws governing mortgage origination in Ohio are different from those in Michigan. The state model. After the mortgage meltdown of 2008, federal regulations were reorganized with a special emphasis placed on common standards for the mortgage industry. These standards, known as the state model, were written by the Conference of State Bank Supervisors, CSBS, to ensure that state law governing mortgage loan originators followed certain guidelines. These guidelines allow for consistent legislation at the state level that is consistent with the rules of the SAFE Act. The state model is simply a template, not a law, for how states should regulate the mortgage industry in their state. Standards established by the state model are expected to be incorporated by the states into their respective codes and regulations. As an incentive to adopt the state model, the states receive perks such as having access to a centralized database location for licensing records. Agencies. The state's state standards and the SAFE Act. The following are standards expressed in the state model that states are expected to incorporate into their own laws: the requirement for licensing and/or registration of mortgage loan originators, MLOs, the application for and issuance of licenses or registries, education requirements, testing requirements, license renewal, enforcement authority, violations and penalties, surety bond, state fund, and net worth requirements, investigation and examination requirements, prohibited acts and practices, mortgage call reports. Use of the NMLS requires unique identifiers on all advertising. Maximum penalty for violations of the SAFE Act is $30,058. Agencies. The states. The state authority. The SAFE Act requires that each state have an authority in place to oversee, regulate, mortgage loan originators. This authority goes by a variety of names depending on the particular state. Common titles include Superintendent, Department, Commissioner, Director, Authority, Secretary, Bureau. The state authority responsibilities. The state has the authority to apply, interpret, and enforce the SAFE Act within that particular state. The state also has the authority to put into action rules and regulations that aid in implementing this act. Among the numerous regulatory responsibilities of the state authority, the following are the most significant: registration and licensing for mortgage loan originators, enforcing the SAFE Act at the state level, reporting MLO actions to the NMLS, fines, mortgage education requirements for the state examinations, orders and directives, agencies, the state licensing and registration to originate loans on real property located in any state. The mortgage loan originator must be registered or licensed in the state in which the property is located. So yes, it's entirely possible for an MLO to carry over 50 loan originator licenses. Enforcement actions: how the state authority handles violations of mortgage law is also very important. The SAFE Act and the corresponding state model require the authority to have enforcement responsibilities in the oversight and regulation of their respective licensees. Prohibited conduct: the following are deemed prohibited conduct under the state model and could result in penalty: directly or indirectly employ any scheme, device, or cunning trick to defraud or mislead borrowers, lenders, or any person; engage in any unfair or deceptive practice toward any person; obtain property by fraud or misrepresentation; earn a fee or commission to obtain a loan when no loan is obtained for the borrower; solicit, advertise, or enter into a contract for specific interest rates or financing terms that are unavailable at that time; aid and abet any person conducting business without a valid license; fail to make disclosures; negligently make any false statement or omission of information requested in connection to an investigation conducted by a governmental authority; make monetary bribes or threats to any person to influence their judgment related to a residential mortgage loan. Make monetary bribes or threats to any appraiser of a property to influence the appraiser's judgment regarding the property's value; collect, charge, attempt to collect or charge, or use any agreement with the intention to collect or charge any prohibited fee; cause or require a borrower to obtain property insurance coverage in an amount that exceeds the replacement cost of improvements; fail to truthfully justify monies of a party in a residential mortgage loan. Transaction 1. Agencies. Federal government. The federal government has numerous agencies that oversee the mortgage industry. In this section we'll review the most important to your role as a mortgage loan originator. The Consumer Financial Protection Bureau, CFPB. The Consumer Financial Protection Bureau, CFPB, was created as part of the Dodd-Frank Act with the express responsibility of providing a single federal regulator for consumer financial protections. Mortgage-related law regulated by the CFPB. Upon its creation, the following mortgage-related federal regulations were reorganized or created and placed under the CFPB's authority. Note: if the regulation has a letter, e.g. X, N, P, it is regulated by CFPB. Regulation: Equal Credit Opportunity Act, ECOA, 12 CFR 1002; C Home Mortgage Disclosure Act, HMDA, 12 CFR 1003; G Secure and Fair Enforcement for Mortgage Licensing Act, Federal Registration of Residential Mortgage Loan Originators, SAFE Act, 12 CFR 1007; H Secure and Fair Enforcement for Mortgage Licensing Act, State Compliance and Bureau Registration System, SAFE Act, 2 CFR 1008; N Mortgage Acts and Practices, Advertising, MAP, 12 CFR 1022 p. Privacy of Consumer Financial Information, Gramm-Leach-Bliley Act, GLBA, 12 CFR 1024 v. Fair Credit Reporting Act, FCRA, 12 CFR 1022 X. Real Estate Settlement Procedures Act, RESPA, 12 CFR 1024 Z. Truth in Lending Act, TILA, 12 CFR 1026. Agencies. Federal government impact of the CFPB. The CFPB is charged with making protections easier to understand and more accessible to consumers. The SAFE Act establishes federal regulatory and enforcement responsibilities of mortgage loan originators that are similar to those of the state authority. These include examining MLO records and data, penalizing licensees, providing information about licensees and potential licensees to the NMLS. The main differences between the responsibilities of the CFPB and the state authority are that the CFPB has jurisdiction in all 50 states and can replace the NMLS system if needed. The CFPB's impact on the mortgage industry is significant. During its short tenure, the CFPB has added multiple rules, regulations, and initiatives to better protect consumers. These new rules include the TILA-RESPA Integrated Disclosure Rule, TRID, the Loan Originator Rule, Section 36 of TILA, and the Qualified Mortgage, QM, Rule, Section 43 of TILA. Given the broad scope of the Bureau's responsibility, one of the most important aspects of their operation involves a consumer's ability to file a complaint. The CFPB developed a system that allows for consumers to file complaints with the Bureau that are then quickly posted online for public access. Regardless of validity or resolution, the complaint remains available as a matter of public record. Department of Housing and Urban Development, HUD. The United States Department of Housing and Urban Development, HUD, is a federal agency with a mission to create strong, sustainable, inclusive communities and quality affordable homes for all. One as the lead federal housing agency, HUD oversees the Federal Housing Administration, FHA, and fair housing laws, and sponsors the Federal National Mortgage Association, FNMA, Fannie Mae, the Federal Home Loan Mortgage Corporation, FHLMC, Freddie Mac, and the Government National Mortgage Association, GNMA, Ginnie Mae. The Fair Housing Act and other fair housing laws are overseen by HUD to ensure that all Americans have equal access to housing in strong and stable communities. The fair housing laws protect against discrimination in the provision of housing and the financing of housing. An example of housing discrimination would be the denial of a person trying to purchase a home due to their race or ethnicity. As government-sponsored enterprises, GSE, Fannie Mae, Freddie Mac, and Ginnie Mae operate as private entities that were created to serve a public purpose. Fannie and Freddie establish standards for conventional conforming mortgages that are then bundled as financial products and sold to investors in the secondary market. Ginnie Mae provides insurance to investors on bundles of non-conventional loans. Agency activities. Other federal departments and agencies. Because the business of mortgage loans touches so many areas of American life, there are numerous other agencies we will discuss in this course. The following is a list of these agencies and a brief explanation of how they impact the mortgage industry. The Department of Justice, DOJ, enforces fair housing and other federal laws. The DOJ serves as the prosecutor in cases where the federal government sues a mortgage loan originator. The Financial Crimes Enforcement Network, FinCEN, and the Secretary of the Treasury regulate and enforce financial crime laws, such as the USA Patriot Act and anti-money laundering laws. An example of FinCEN and the Treasury fighting financial crime can be found in their work battling terrorists' use of money laundering as a tool to support their activities. Mortgage transactions often include activities that cross state lines, such as when a mortgage loan originator writes the mortgage for a property in Pennsylvania while working out of an office in Michigan. The Federal Trade Commission, FTC, oversees how this business is done. Similarly, because that MLO is likely to use communications tools such as the telephone and the internet to conduct their business, the Federal Communications Commission, FCC, deals with the control of those communications. Finally, the mortgage industry's development of the secondary mortgage market, where lenders and investors buy and sell packaged mortgages called mortgage-backed securities, MBS, requires the involvement of the Securities and Exchange Commission, SEC. Agency activities. As previously discussed, the state authority and the CFPB both operate in similar fashion, it's just their jurisdiction that differs. Whereas the CFPB focuses on federal law and mortgage loan originators, the states focus on the industry in their particular state. The one area where they specifically differ is that the states and only the states can issue, deny, revoke, or suspend an MLO's license or registration. The main activities that they share are examinations, audits, and reporting. Examinations. Pre-examination, determine the scope of the investigation. Institution licensing, review the company's ownership, structure, and affiliations. Human resources, review individual licenses and renewals. Compliance management, is the company compliant with NMLS rules and regulations? Operational management, personnel, training, systems, reporting, and internal audits. Financial condition review: does the company meet necessary financial standards? Mortgage call review: did the company meet quarterly and annual reporting requirements? Interviews: with personnel and affiliates, it is the responsibility of the financial institution to comply with the request of the regulator as well as to pay for all costs associated with the examination. Agency activities reporting: in addition to the examination responsibilities, regulators are also responsible for reporting their findings to the NMLS and ensuring that mortgage loan originators file necessary documents with the appropriate regulator when due. The most common of these reports is the Mortgage Call Report, MCR, which is filed both annually and quarterly. The NMLS receives and collects this information from the mortgage loan originator on behalf of the regulators. Responsibilities that both federal and state agencies share: enforcing the SAFE Act, reporting MLO actions to NMLS, assessing fines, mortgage education and testing requirements, holding examinations, giving orders and directives. Cease and desist orders: a cease and desist is a legal order that requires the recipient to immediately stop a specific action. For MLOs, all cease and desists are considered temporary until a hearing takes place. If a person has, is, or is about to violate the law, the state authority or the head of the CFPB, director, can request each person involved to cease and desist from committing the violation. If the person's violation will likely result in harm to the public interest prior to the proceedings end, the director can enter an immediate temporary cease and desist. The director can publish the findings. The director will send a notice regarding the proceedings and will set a hearing date. The notice will include a hearing date that is between 30 and 60 days of the MLO receiving it. Only the director can set an earlier or later date, with the consent of the person served. After the notice and opportunity for a hearing, the cease and desist order may require future plans for compliance, if the director specifies. The mortgage loan originator can do the following: request director review, apply for the order to be set aside or suspended, if the temporary order was entered after an opportunity for a hearing, or requesting a hearing within 10 days of a temporary order that was originally served without a hearing. Request judicial review, apply to a district court system within 10 days after a hearing and decision on a temporary order that was originally entered without a hearing. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO Chapter 5, Your License, the Secure and Fair Enforcement Act, SAFE Act, Your License. This next chapter will help break down the specific requirements implemented by the SAFE Act to ensure minimum standards for the licensing of MLOs regardless of the state jurisdiction. The Secure and Fair Enforcement Act, SAFE Act. The Secure and Fair Enforcement Act of 2008, SAFE, was created to improve consumer treatment by the mortgage industry through the minimum qualification of its mortgage loan originators. This improvement was achieved through licensing and registration requirements for originators. The SAFE Act may also be referred to as Title V of the Housing and Economic Recovery Act, HERA. 1. The Nationwide Multistate Licensing System and Registry, NMLS. The Nationwide Multistate Licensing System and Registry, NMLS, serves as the communication hub and database for the mortgage industry. The NMLS was created by the Conference of State Bank Supervisors, CSBS, and the American Association of Residential Mortgage Regulators, ARMR. The NMLS is operated by the State Regulatory Registry, SRR, which works on behalf of the CSBS and ARMR to manage the NMLS, oversee education and testing content, as well as operate the system as a database of information about mortgage loan originators. It also allows for consumers to seek out information regarding MLOs. The CFPB serves as the regulator for the NMLS and through this provides information to the system about licensees. Because of its regulatory authority, the CFPB also has the right to create a new licensing system should the NMLS fail in its responsibilities. CSBS and ARMR. The Conference of State Bank Supervisors, CSBS, is a national organization founded in 1902 to further advance the ideas and professionalism for state banking departments. It acts as the single voice to Congress for state banks and serves as a liaison between state and federal regulators. Involving over 5,000 state-chartered financial institutions, the CSBS and its member state banking departments supervise many financial service providers operating in their states. These providers include mortgage lenders and originators, money servicers, check cashers, finance companies, and payday lenders. The American Association of Residential Mortgage Regulators, ARMR, was established to promote the exchange of information and knowledge between the states regarding residential mortgage lending, servicing, and brokering. Both the CSBS and ARMR play an integral role in consolidating opinion at the state level and provide guidance and communication for their members at the national level. Your license. The Secure and Fair Enforcement Act, SAFE Act. What does the NMLS do? The NMLS has a wide range of responsibilities. The following is a list of major tasks that fall into that range: give uniform license applications and reporting requirements for mortgage loan originators, provide a comprehensive licensing and supervisory database, collect and improve the flow of information to and between regulators, provide increased accountability and tracking of mortgage loan originators, streamline the licensing process, increase consumer protection and support anti-fraud measures, provide consumers with information about mortgage loan originators free of charge, establish requirements for mortgage loan originators to act in consumers' best interest, ensure responsible behavior in the subprime mortgage marketplace, provide training and examination requirements related to subprime mortgage lending, facilitate the collection and disbursement of consumer complaints on behalf of state and federal mortgage regulators. Regulations G and H. The SAFE Act includes two regulations that define and direct the registration and licensing of mortgage loan originators, Regulation G and Regulation H. Regulation G. Regulation G1 applies to federally regulated depository institutions that operate in the mortgage industry. Examples of these companies are banks that are members of the Federal Reserve System as well as insured state non-member banks. Some savings associations and credit unions also fall into this category. For the most part, if the institution has checking and savings accounts and originate mortgages, they probably fall under Regulation G. Loan originators that work for these companies are only required to register with the NMLS and will receive a unique identifier, NMLS ID, for their registry. This registration process includes a background check and 10 years previous work history. Regulation H. Regulation H2 affects non-federally regulated entities that provide mortgage-related services. To make it simple, while Regulation G deals with depository institutions, Regulation H covers companies that do not have checking or savings accounts, i.e., non-depository institutions. A company that only originates mortgage loans is an example of a non-depository institution. Mortgage loan originators governed by Regulation H must also register with the NMLS and receive a unique identifier, and will also need to take the extra step of obtaining a license. Registration, licensing, education, and testing. To be licensed in a particular state, a mortgage loan originator must apply to that state for the license. We cannot emphasize enough how important it is for you to understand that your mortgage loan originator's license is issued by the state. Having met the 20-hour PE requirement and passing the test only means that the candidate has met the minimum NMLS requirement under the SAFE Act. Each state operates independently in determining whether or not to award a mortgage originator a license for their state, and they will only do this if the education and testing requirements are met. Your license. The Secure and Fair Enforcement Act, SAFE Act, registration requirements. As part of the registration process, mortgage loan originators are required to fill out and submit a mortgage uniform, MU, form. There are 4 different types of MU forms, MU1, MU2, MU3, and MU4. In order to register, MLOs will also need to provide authorization for a credit check, submit fingerprints for a federal background check, and submit a 10-year work history to the NMLS. The MU1 is also known as the institution form. Companies are required to submit an MU1 for company licenses. The MU2 form is known as the responsible party form and is filled out and submitted by the individual person responsible for a company. The MU3 form is known as the branch form and must be submitted for each branch location the company originates mortgages from. The individual form is the MU4. The MU form must be filled out and submitted by you as part of your licensing application process. Licensing requirements: persons required to be licensed mortgage loan originators as well as independent contractors acting as processors or underwriters must register with the NMLS, obtain a unique identifier, and acquire a license for each state in which they do business. Persons not required to be licensed: the following individuals are exempt from the licensing requirements of Regulation H: an individual who performs only real estate brokerage activities, an individual who only extends credit related to timeshare plans, an individual who performs only administrative, clerical, or support duties, as an employee, under the direction of a mortgage loan originator, an individual who is NMLS registered and is an employee of a covered financial institution, an individual who simply forwards a loan application, such as a loan processor, or who decides if a borrower is qualified, such as an underwriter, an individual who explains loan terminology or steps and arranges the loan closing, such as a closing agent, an individual who acts completely as a volunteer, an individual who offers or negotiates terms on behalf of an immediate family member, an individual who offers or negotiates terms of a residential mortgage loan secured by a dwelling that served as the individual's residence, a licensed attorney who engages in the business of a mortgage loan originator, if those loan origination activities are all three of the following, considered by the state's court of last resort to be part of the authorized practice of law within the state, carried out within an attorney-client relationship, accomplished by the attorney in compliance with all applicable laws, rules, ethics, and standards, an employee of a government or housing finance agency, an employee of a bona fide nonprofit organization, an employee of a non-federally insured credit union. Education requirements: the 20-hour pre-licensing education (PE) requirement, as prescribed by the SAFE Act, is broken into multiple topic areas and minimum time requirements for each topic. The Act requires at least 3 hours devoted to federal law and regulations, a minimum of 3 hours of ethics, including fraud, consumer protection, and fair lending issues, 2 or more hours of standards related to non-traditional mortgages, and 12 hours of undefined education. The undefined component is usually spread over the 3 main topic areas. Once MLOs are licensed, they will also be required under the SAFE Act to complete at least 8 hours of continuing education, CE, to keep their licenses up to date. The breakdown on CE minimum time within the 8 hours is as follows: 3 hours of federal law and regulation, 2 hours of ethics, including fraud, consumer protection, and fair lending issues, 2 hours of standards related to non-traditional mortgages, and the 1 remaining hour to be used for undefined education. Credit is given only for the year in which the course is taken. Loan originators cannot get credit for taking a class multiple times in the same year or taking the same course in successive years. Credit for approved course instructors is given at the rate of 2 hours credit for each 1 hour taught. Point 1: as indicated previously, states may require additional state-specific education as part of their PE and CE requirements. Testing requirements: in most cases, the MLO candidate will only need to take and pass the Uniform State Test, UST, aka the SAFE test, to meet the testing requirement for application to each state for their license. There are 5 categories of questions on the exam, each with a specific percentage of total questions. The 5 categories are: mortgage loan origination, MLO 27%, general mortgage knowledge, GMK 20%, federal law, 24%, ethics, 18%, and uniform state content, USC 11%. All questions on the exam are multiple choice with the opportunity for 1 correct answer from a group of 4 options. The UST test itself requires a passing score of 75%, this standard was set as part of the SAFE Act. The current UST exam has a total 120 questions. 5 of these questions are not graded, but are included on the exam for experimental purposes, which means your score is based on 115 questions. If you want to do the math, this means you'll need to get at least 87 questions correct to pass. Test takers are allowed a maximum of 190 minutes to complete the exam. If the candidate does not pass the test, they must wait 30 days to take the test again. The candidate will have 3 opportunities in a test cycle to pass the test. Should they fail on the 3rd attempt, they will be required to wait 180 days before attempting the test again in a new cycle. Each cycle is composed of 3 attempt opportunities with a 30-day wait period in between. Test takers are permitted unlimited cycles in their attempt to pass the test. How to lose, or never get, your license. Licenses can be denied, suspended, or revoked by the state, and only by the state. To keep it simple, if one state denies or revokes your license, the other states will likely deny or revoke your license as well. Additionally, institutions may be denied a license for failing to meet specific net worth or surety bond requirements. They can also lose their license if they fail to meet a regulator's request or demand for information. Individuals. The following is a list of common reasons why a state may deny or revoke an individual loan originator's license. Revocation of a loan originator's license in any governmental jurisdiction. Conviction of, or plead guilty or nolo contendere, no contest, to any felony in any court within the last 7 years. Conviction of, or plead guilty or nolo contendere, no contest, to any felony at any time involving fraud, dishonesty, breach of trust, or money laundering. Lack of financial responsibility and good character. Failure to complete the necessary pre-licensing education requirement. Failure to pass the federal or state components of a written exam. Companies/institutions. The following are reasons for license denial specifically related to companies or institutions: failure to meet the net worth and surety bond requirement or pay accordingly into the state fund as required by the state. Failure to complete and submit the required NMLS mortgage call report, detailing a loan originator's activities for the previous year. Surety bond. Bonds act as insurance for entities. A company secures their bond and it covers all MLOs sponsored by the company. Some states have a set required amount, others determine the amount based on volume of loans in the previous year or number of licensees. Net worth. Net worth is a requirement that is only applicable to companies applying for licensure and only in certain states. While individuals applying for originator licenses are subject to background checks and credit reports in addition to disclosing their criminal and pertinent financial history, there is no net worth requirement imposed on individual originators. The company must meet those net worth requirements and demonstrate it by submitting a financial statement to the NMLS. Loan originator with temporary authority. Certain loan originators have temporary authority to act as a loan originator in a state for a limited period of time while applying for a state loan originator license in that state. Not all loan originators are eligible for temporary authority. Temporary authority applies to loan originators who were previously registered or state licensed for a certain period of time before applying for a new state license. Additionally, loan originators are eligible for temporary authority only if they have applied for a license in the new state, are employed by a state-licensed mortgage company in the new state, and satisfy certain criminal and adverse professional history requirements described in the SAFE Act. To be eligible for temporary authority, MLOs must meet the following 2 criteria: 1. Employed by a state-licensed mortgage company in the application state, and 2. Either A. Registered in NMLS as an MLO continuously during the 1-year period preceding the application submission, or B. Licensed as an MLO continuously during the 30-day period preceding the date of application. MLOs who have had the following issues do not qualify for temporary authority: a license application denied, or an MLO license revoked or suspended in any jurisdiction, been subject to, or served with, a cease and desist order, or been convicted of a misdemeanor or felony that would preclude licensure under the law of the application state. Temporary authority begins on the date an eligible MLO submits a license application with the required background check information, which is fingerprints, personal history and experience, and authorization for a credit report. 1. Temporary authority ends when the earliest of the following occurs: 2. The MLO withdraws the application, 3. The state denies or issues a notice of intent to deny the application. 4. The state grants the license, or 5. 120 days after the application submission if the application is listed on NMLS as incomplete. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO Chapter 6, RESPA governs RESPA Real Estate Settlement Procedures Act, Regulation X. The Real Estate Settlement Procedures Act, RESPA, Regulation X, is the federal law that governs the oversight of costs associated with the mortgage and the entire real estate transaction. RESPA governs all federally regulated mortgage loans that are secured by residential property. To be secured by residential property simply means that the loan, mortgage, provided by the lender is given, secured, in exchange for the borrower's collateral, which is the home, residential property. RESPA does not govern loans on residential property of more than 25 acres. RESPA does not govern loans for agricultural properties, like an income-producing farm, or business/commercial properties, like office buildings or storefronts. If the property has a business purpose, the loan is not governed by RESPA. RESPA also does not govern temporary loans, such as construction loans and bridge loans. RESPA is not involved when a loan is modified, which means the terms of the loan are changed through an agreement with the lender in cases where the borrower is struggling to make their mortgage payment and would not qualify for a refinance. Finally, transactions involving the sale of the loan in the secondary market have nothing to do with RESPA. Simplifying RESPA's purpose is to ensure that consumers can make informed decisions about real estate transactions by understanding the costs for settlement. The law prohibits illegal practices such as referral fees or kickbacks paid or provided by real estate settlement service providers. As we already discussed, RESPA governs mortgages on residential property. So what do we mean by real estate settlement? Real estate settlement is the process in which all of the parties involved agree to the terms of the transaction and sign the documents needed to demonstrate their agreement. This process is also known as closing. Okay, then what is a settlement service? A settlement service is any service needed or provided in order to carry the transaction to the closing table. These services include servicing, collecting the payment from the borrower, appraisal, determine the property's value, title work, including title insurance, clarifies and protects the property's ownership rights. Legal services, document preparation. There hasn't been a mortgage transaction yet that didn't kill a few trees. There's a lot of paperwork and somebody has to put it all together. Credit reporting. Credit reports come from companies like TransUnion, Experian, and Equifax. Property surveys and inspections. Depending on the transaction, property lines may need to be determined and inspections might be needed. Real estate services and brokerage. If it's a purchase transaction, there could be a real estate agent involved, and they don't get paid until the paperwork is signed and filed. Loan origination includes processing, underwriting, and funding. This is where you fit in. What? You thought we'd forget you? Closing or settling the transaction. Nothing is free, including signing the paperwork. This covers the cost of the closing agent and associated fees. Again, to be clear, RESPA deals with the costs associated with these settlement services, not necessarily with the actual service involved. Example: the cost of the appraisal is governed by RESPA, but other laws such as Section 42 of TILA govern the actual work done by the appraiser. One more thing you should know about settlement services: the borrower may only be charged the actual cost of the service. No additional charge, administrative, or handling fees may be added to the cost of the service by the originator or lender. And just in case you were wondering, the Consumer Financial Protection Bureau is the regulatory authority for RESPA. Important sections of RESPA. Most laws are broken down into sections that focus on a specific aspect of the regulation and its requirements. In the case of RESPA, the key sections we're concerned with are Section 6, Section 8, Section 9, and Section 10. RESPA, Section 6, Servicing Section 6 of RESPA requires servicers to set specific policies and procedures within their organization in order to meet certain RESPA-required objectives. Servicing is the process of collecting payments from the borrower and dispersing them to the loan owner, and proper escrow authorities. The example below shows how payments flow from the borrower to the owner of the loan, the bondholder. The following 4 objectives are foremost as it relates to Section 6. Objective 1. Provide timely and accurate information in relation to an information request, complaint, foreclosure process, or death of a borrower. Ensure that borrowers are well informed about procedures for submitting error notices and requests for information. Objective 2. Properly oversee and ensure compliance of all employees/employers with relation to procedures and laws. Certain procedures must be followed with relation to a borrower's escrow account and/or hazard insurance policy. Objective 3. Properly process and evaluate loss mitigation applications. Follow proper regulations with regard to the pre-foreclosure process. Objective 4. Ensure that necessary information about probable or actual transfer of servicing are disclosed, and ensure that all documentation is transferred during actual servicing transfer situations. RESPA, Section 8, Referrals. Section 8 of RESPA deals with prohibitions on referrals and kickbacks. In most circumstances, the payment or provision of a thing of value in exchange for a referral is outlawed under RESPA. Even if a thing of value is provided, and no kickback is gained, that still may be a violation. What's a thing of value, you ask? Great question. The answer is anything that's worth something. So in the eyes of RESPA it would be considered illegal for you to buy dinner for your friend, the real estate agent, in exchange for them sending you a client. Dinner is a thing of value. It's also illegal for you and your real estate friend to exchange clients, i.e., for every client they send to you, you send one to them. This is known as quid pro quo and it is a no-no. It is permitted for referral fees to be paid within an organization. Let's say that you're licensed to write mortgages in Connecticut. After you close a loan with a Connecticut client, they're so pleased with your service. After all, you're reading this book and taking this course, you must be awesome, that they ask you to refinance the mortgage for their vacation home on Martha's Vineyard. Unfortunately, Martha's Vineyard is in Massachusetts, and you aren't licensed in the state of Massachusetts, but one of your fellow team members are. Under the rules of RESPA, it's perfectly legitimate for the other MLO to scratch a check for the referral. Why? Because you work for the same company. If you work for different companies, referral fees are not allowed. Section 8 also requires that an MLO disclose to their client if they are referring them to a company with whom the MLO is affiliated. Affiliated means they own 1% or more of the other business. If a company is an affiliated business, we must tell the borrower about the relationship if we refer them. The only thing of value that can be received from the use of an affiliate is the equivalent in ownership percentage provided from the payment of the fee. RESPA, Section 9, Title Agent. Section 9 is pretty simple. The borrower and/or seller has the right to choose their own title agent. A lender cannot require the use of a specific title company as a condition for the loan. RESPA, Section 10, Escrow. Section 10, Think 1.0, E-Escrow, of RESPA is focused on protection for consumers with escrow accounts. As with most consumer protection laws, RESPA Section 10 requires that borrowers be informed about their escrow account. Section 10 allows the servicer to collect a maximum of 1/6, or 2 months, of the borrower's annual tax and insurance payment. An overage is allowed as a cushion in case the tax or insurance bill fluctuates higher than expected. At the time of the annual escrow analysis, if a surplus of $50 or higher is discovered, the complete overage must be returned to the borrower within 30 days of the analysis. Disclosures required under RESPA. What's a disclosure? To disclose means to tell or inform. In our business, there are 3 types of disclosure requirements: basic, written, and form. The basic disclosure means that the law requires, the MLO to disclose to the borrower certain things like, You should keep all of the documents you receive for this transaction. Basic disclosures are not limited by how they must be provided to the borrower, but most MLOs provide them in written form to ensure the borrower can keep a copy. Written disclosures are just like it sounds, they must be provided in writing. Form disclosures are disclosures that must be provided to the borrower on a specific type of form. For example, the loan estimate and closing disclosure are two forms that must be used when a borrower is in process for a closed-end mortgage. RESPA requires a number of disclosures be given to the borrower throughout the loan process to provide guidance, notification, and education for the consumer. Required RESPA disclosures for most loan transactions: Mortgage Servicing Disclosure Statement, MSDS, Notice of Transfer Statement, NTS, Affiliated Business Arrangement Disclosure, ABA or AFBA, Initial and Annual Escrow Statement. Homeownership Counseling Organizations list RESPA disclosures required under RESPA. Mortgage Servicing Disclosure Statement, MSDS, required under Section 6, servicing must be delivered to the consumer at application or within 3 days, excluding legal public holidays. Saturdays and Sundays, on first lien mortgages informs the borrower that their loan may be assigned to another company for servicing. Includes likelihood of the loan's servicing rights being sold. Explains the borrower's rights for complaint resolution. Applicant Acknowledgement Signature Line Notice of Transfer Statement, NTS, required under Section 6, servicing must be delivered to the borrower 15 days prior to the transfer of servicing and 15 days after the servicing is transferred. Informs the borrower that their loan is being placed with a new servicer. Includes contact information for current servicer, contact information and payment address information for new servicer. Provision that during the 60-day period following the transfer, a late fee cannot be charged to the borrower for payments sent to the previous servicer. Affiliated Business Arrangement Disclosure, ABA, AFBA, required under Section 8, referrals must be delivered to the consumer at the time of referral if the originator is affiliated with the service provider. Informs the consumer of the business arrangement between the two parties. Includes description of the business arrangement as well as ownership interest and estimate of costs. Statement that the consumer is not required to use the affiliate for the service and may instead choose their own provider. Initial and Annual Escrow Statements required under Section 10, Escrow. Initial escrow statement, due at closing or within 45 calendar days of establishment of escrow account, explains the amount needed for escrow and breaks down each payment. Annual escrow statement, due within 30 days of analysis, determines any overages or shortages. RESPA disclosures required under RESPA. Homeownership Counseling Organizations list required under the general rules of RESPA must be delivered to the consumer at application, or within 3 business days if mailed. Informs the borrower of local counseling organizations the lender is ultimately responsible for ensuring that the consumer receives the list. Reverse mortgages and timeshares are exempt from receiving the list. Must have at least 10 organizations listed within the vicinity of the subject property. Good faith estimate, GFE. This disclosure is for HELOC and reverse mortgages only. Required under the general rules of RESPA. Must be delivered to the consumer at application, or within 3 business days if mailed. Informs the consumer of expected costs of the complete transaction and is good for 10 business days. HUD-1 Settlement Statement, HUD-1. This disclosure is for HELOC and reverse mortgages only. Required under the general rules of RESPA. Must be delivered to the borrower at closing, or 1 day prior if requested. Informs the borrower of the final costs for the entire transaction. RESPA penalties. Like most laws, RESPA provides penalties within its language for violations of its rules. The following are penalties as prescribed under each section of the law. Section 6, Servicing damages not to exceed $1,000. Class actions, penalties up to $1,000 for each member, total damages not to exceed $500,000, or 1% of net worth, whichever is less. Section 8, referrals, fines up to $10,000 and up to 1 year in prison. Section 9, title agent borrower can sue for up to 3x amount charged for title insurance. Section 10, escrows, failure to provide an annual escrow statement equals $75 per violation, $130,000 annual limit, intentional violations equals $110 per violation, no limit. RESPA record keeping according to RESPA, The good faith estimate, GFE, must be kept for 3 years from the date of settlement. The following disclosures must be retained for 5 years from settlement: the HUD-1 settlement disclosure, the affiliated business arrangement disclosure, ABA or AFBA. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO Chapter 7, Products Set vs Variable Rates of Interest. One of the key factors involved with lending money is interest. In the simplest of terms, interest is what the lender charges the borrower for the use of the lender's money. The interest rate charged on a loan is determined when the loan terms are negotiated during the application process. At this time, it is also decided if the interest rate will remain constant throughout the repayment cycle or if the rate can change. If the loan's interest rate will be constant for the life of the loan, the function of the loan's interest is considered set. If the interest rate can change during the repayment cycle, the loan's interest is considered variable. Closed-end vs open-end. Before we get into specific product types, it's important for us to draw a specific designation between two categories of loans, closed-end and open-end. What makes these two categories different is whether the final payoff date is certain. With a closed-end mortgage, the final payoff date is determined when the loan is originally made. For example, a traditional mortgage will be paid off in 360 payments after the loan repayment process begins. So, if the first payment is due on June 1, 2018, the final payment would be May 1, 2048. The loan is considered closed-end, because there is certainty about when the loan will be repaid. Think of a closed door. On the other hand, with an open-end mortgage, the final payoff date is unknown when the loan is originally made. For example, a reverse mortgage is not due until the borrower leaves the home permanently. At the time the loan is made, there is no specific date for the borrower to leave and therefore no final due date for payment. The payment date is determined by the borrower's departure date. The loan is considered open-end, because there is no certainty about when the loan will be repaid. Think of an open door. We need to know whether a mortgage loan is open or closed because this will dictate some of our responsibilities and actions as mortgage loan originators, along with disclosures we are required to provide to the borrower. Closed-end mortgages products. Closed-end mortgages, as we said before, closed-end mortgages are loans whose term and maturity date cannot change. Closed-end mortgages have an established time at which the entire debt will be repaid. This means when the loan closes and the repayment period begins, the borrower and the lender know exactly when the loan will be repaid if the payment schedule is followed. The majority of mortgages we'll discuss in this course are closed-end mortgages. Fixed-rate mortgages. Fixed-rate mortgages are mortgages in which the interest rate of the mortgage remains constant throughout the loan. This steady rate provides a level of certainty to borrowers and allows them to easily manage their long-term budgets. With fixed-rate mortgages, the principal and interest portion of the payment remains the same. This is accomplished through an amortization schedule as discussed earlier in this section. Amortization allows for the combined payment of principal and interest to remain the same until the loan is completely paid off at the end of the term. The most common forms of fixed-rate mortgages come in the following term lengths: 10, 15, 20, 25, and 30 years. The 30-year fixed-rate mortgage is known as a traditional mortgage. Adjustable-rate mortgages. An adjustable-rate mortgage, ARM, is a loan in which the interest rate can change over the term of the loan. Since the rate can change, ARMs are sometimes referred to as variable-rate mortgages because their most obvious feature is the variance of rate. Most ARMs function on a 30-year full amortization schedule, which means that even though the interest rate and payment amounts may change during the loan's term, the loan will be completely paid off after 360 payments. How and why an ARM's interest rate changes is tied to the current state of the financial marketplace. When the money markets place a low value on money, meaning it is readily available, interest rates are low and thus the rate on an ARM will adjust lower. If money is tight and inflation goes up, an ARM will follow that trend and move higher with interest rates. Types of ARMs. Adjustable rate mortgages come in a variety of types. Traditional ARMs. Traditional ARMs are loans in which the rate adjusts on a periodic basis. Most traditional ARMs have an interest rate that adjusts each year, but at one time in history it was not unusual for the rate to change monthly. Hybrid ARMs. Hybrid ARMs are the most common adjustable rate mortgages available in the market today. The hybrid ARM combines features of a fixed rate mortgage and an adjustable rate mortgage. An example of a hybrid ARM is the 5/1. With a 5/1 ARM, in the first 5 years the loan's interest rate remains fixed at the note, initial, rate. After the 5th year, the rate adjusts once annually. Common forms of hybrid ARMs include 3/1, 5/1, 7/1, and 10/1, 3, 5, 7, and 10-year set periods respectively. The chart below provides a graphic of how a hybrid ARM works. Option ARMs. Option adjustable rate mortgages are ARMs in which the borrower has the option of 3 different payment amounts. One option allows for the borrower to make a fully amortized payment like any other ARM loan. The second option is an interest-only payment where just the interest part of the payment is made. The third option can be called a minimum or reduced or flat payment. No matter the name for the third option, this payment does not cover enough principal and interest, so it leads to negative amortization. With option ARMs, the interest-only and flat payment choices are only available for a limited period, usually the first 5 years of the loan term. After this period, the borrower is required to make a fully amortizing payment. How an ARM adjusts. The factors that impact an ARM's interest rate are the margin and the index. Margin, the lender's profit on the loan, and an amount of interest that remains constant. Since the margin serves as the lender's cut of the mortgage payment, the interest rate of an ARM can never go below the margin, regardless of market factors. Index makes the ARM's rate change. It is an instrument that tracks the financial marketplace. If the market moves, so will the rate of the ARM. In today's market, the most commonly used indices are the London Interbank Offered Rate, LIBOR, United States Treasury Bill, T-bill, and the Cost of Funds Index, COFIA.K. of the 11th District. The index that will be used to determine an ARM loan's adjustment is included in the language of the mortgage contract and cannot be changed once the loan closes. As of January 3, 2022, the LIBOR is no longer used as an index for mortgages in the U.S. It will be replaced with the Secured Overnight Financing Rate, SOFR. One of the reasons for the change was LIBOR was manipulated in the past and federal agencies sought to find a more secure index. Another reason was SOFR is being used is because it is secured by U.S. Treasuries. Even though LIBOR will no longer be used as of January 3, 2022, lenders will begin transitioning to SOFR beginning as early as August 2020. Borrowers who have ARM loans that used LIBOR will be affected by this because their rates will now be based off of SOFR. Fully indexed rate vs. note rate. Note rate, the note rate, aka initial rate, is the interest rate at the time of loan closing. The reason it is known as the note rate is because the initial rate is the one listed on the promissory note. Fully indexed rate, the fully indexed rate is a combination of the margin plus the index. It is the interest rate of a mortgage provided there are no limits on how high or low the rate may go. Caps. Due to the variable nature of an ARM, it sometimes can be more challenging for a borrower to manage. That's why most of the ARMs available today come with caps. Think of the cap as a ceiling or a floor that the ARM's rate cannot exceed. If the fully indexed rate remains within the cap, then that's the new rate. But if the fully indexed rate exceeds the cap, the ARM's new rate stops at the cap. Caps are voluntary limits set by the lender when making the mortgage agreement, and if included, they are written as part of the mortgage contract. The most common caps are annual caps, also referred to as the periodic cap, and lifetime caps. Some ARM loans also include an initial cap which is used to control the amount a rate may change the first time the rate adjusts. Caps on adjustable rate mortgages limit payment shock, a sudden or severe increase in payment. Balloon mortgages. Balloon mortgages are loans that require a planned full repayment of the balance prior to the end of a 30-year amortization schedule. Depending how the mortgage is structured, the borrower typically makes regular payments at the beginning payment cycle. These payments may reflect or partially amortizing payment, even be interest only. At the end period of payments, the remaining principal balance paid. 1. This chart shows how a balloon mortgage functions. The payments the borrower makes may reduce the principal balance, if the payment is fully amortized. If the payment is interest only, the principal is not reduced. If the borrower falls on hard times and is unable to pay or refinance the remaining balance when the period of regular payments ends, they may lose their home. Types of balloon mortgages. Balloon mortgages come in a variety of forms. With a 30/15 balloon mortgage, the borrower makes payments for the first 15 years in the amount of a fully amortizing payment for a 30-year fixed-rate mortgage. At the end of the payment period, 15 years, the remaining balance is due. Reset and conditional refinance. If the borrower is unable or unwilling to refinance or sell their home to avoid the large lump sum payment, they may have the option, through a conditional refinance provision, to convert the balloon mortgage to a fully amortizing mortgage at the maturity date. These reset options are not automatically built into every loan. They need to be agreed upon by the borrower and the lender and/or investor at loan application. Some loans do not contain a conditional refinance provision. For example, the earlier mentioned 30/15 balloon loan does not contain a reset option. A balloon loan with a reset option is a 5/25 loan. The lump sum is due after 5 years while the reset amortizing term is 25 years. For the refinance of a loan with a reset option, no income or credit needs to be qualified. The following provisions still must be met. Black small square. The property must be the borrower's primary residence. Black small square. The resetting mortgage must be the only lien on the property. Black small square. The borrower must have no late payments in the last 12 months. Black small square. The borrower is still required to sign documents and pay closing costs. Graduated payment mortgages, GPM. Graduated payment mortgages are products that allow the borrower to ease into a fully amortizing payment on the loan. Typically used by first-time home buyers, the GPM features monthly payment amounts that increase annually until they reach the full payment. The gradually increasing payment period usually lasts for 5 to 10 years. During this time the payment does not for each payment is added to the principal balance of the loan. This result is called negative amortization, and it is an expected feature of the GPM. At the end of the gradual increase period, the remaining loan payments are made based on a fully amortizing amount that will result in the loan being fully repaid at the end of the payment cycle. Open-end mortgages. Home equity lines of credit, HELOC. A HELOC is a form of an open-end mortgage that allows the borrower to make repeated withdrawals and payments against the equity they have on their home. Very similar to how a credit card functions, the HELOC assumes a lien position on the borrower's home that allows for a maximum dollar amount that can be used by the borrower. In a simplistic sense, it's using the equity as if it were a credit card. The reason the HELOC is an open-end mortgage is because, based on the recurring payments and withdrawals, it is impossible at the time the account opens to determine all the repayment terms. Open-end mortgages. Reverse mortgage benefits, requirements, and restrictions. The benefit of a reverse mortgage to the borrower is that they are not required to repay the mortgage balance until they leave or sell the property. The following are requirements necessary for the borrower to obtain a reverse mortgage. Borrower must be 62 years of age or older. Home must be the borrower's primary residence. No other liens may exist on the property. 2. The following are restrictions that must be observed by a borrower with a reverse mortgage. If any of these restrictions are violated, the borrower may be obligated to immediately repay the loan to the lender. Taxes and insurance must be paid on time. Property must be maintained and kept in good repair. No additional owners may be added to title. Borrower may not rent the property. Borrower may not declare bankruptcy. Miscellaneous products. Short-term mortgages. Products. Miscellaneous products. Short-term mortgages are also referred to as interim loans because their intent is to only be in place for a limited period of time. The most common form of interim loans are construction loans and bridge loans. Characteristics. Short-term mortgages are typically 12 months or less in length. They usually have higher interest rates because of their short repayment period and higher level of risk. Because they are used as a method of interim financing with no intent to reduce the principal balance, Short-term mortgages are interest-only in their payment type. Types of short-term mortgages. Construction loans. Construction loans are used to finance the construction of a new home or addition to a home. They finance the project based on the plans, materials, labor, and permit costs needed to complete the construction. Once the home is built, the borrower is expected to refinance or pay off the principal balance. Some construction loans are structured as a construction to permanent loan in which the balance from the construction loan is automatically rolled over into a more standard mortgage when a certificate of occupancy, CO, is received. Receipt of a CO is an indication that construction is completed and the home is available for residency. 1. Bridge loans. Bridge loans serve American Samoa temporary financing for a home buyer when purchasing a new home if they are still paying a mortgage on their current home. Bridge loans are usually available in two forms, secured and unsecured. Secured bridge loans allow the lender to secure a lien interest in the borrower's current home until it sells and the borrower can repay the lender. A lender may allow for an unsecured bridge loan, meaning the lender is not taking out a security interest in the borrower's current home, for the borrower on their new home if their current home is in process or under contract for sale with a buyer. Home equity loan. A home equity loan, HEL, is a mortgage loan in which the borrower accesses their existing equity in the home. Unlike a HELOC where the borrower uses their equity through a line of credit, the money for the HEL is provided in a lump sum payment at closing from the lender to the borrower. This is often referred to as a cash-out transaction because the borrower is literally taking cash out of their own equity value in the home. Miscellaneous products. Piggyback loan. The piggyback loan is a type of mortgage that provides a loan to cover the down payment. In the days prior to the financial crisis of 2008, this type of product was used frequently because it allowed the borrower to avoid private mortgage insurance on their mortgage. There were two common forms, an 80/20 and an October 10, 80. 80/20 was when the primary mortgage covered 80% of the home's purchase price, while the piggyback loan covered 20% of the price. The October 10, 80 was when the 80, once again, covered 80% of the home's purchase price, and another loan is provided for 10% of the purchase price. The final 10% would be provided by the borrower as a down payment. In all of these circumstances, the piggyback loans are subordinated to the larger 80% primary loan. Because of this subordination and higher risk, the piggyback typically carried a much higher rate of interest than the primary mortgage. Piggyback loans are seldom seen today in standard mortgage transactions. However, they can still be found in special financing transactions through housing finance agencies. Subprime mortgages. Subprime mortgages are a type of loan intended for borrowers with less than prime qualifications. Typically factors such as lower income, poor or limited credit history, and minimal assets can lead to a borrower receiving a subprime loan. Because of the borrower's circumstances, these loans carry a higher level of risk and therefore lenders will charge a higher rate of interest to offset the risk. Jumbo mortgages. Jumbo mortgages are a type of loan where the dollar amount of the mortgage exceeds the conforming loan limits set by the Federal Housing Finance Agency, FHFA. This loan is considered riskier than normal because of the high dollar amount. The lender will have greater exposure to risk should the borrower default. To protect against this risk, the lender will usually require higher credit scores and a higher level of income compared to the borrower's monthly debt-to-income ratio. Niche loans. Niche loans are for unique circumstances or needs. This loan is typically unavailable through major lenders and usually requires higher rates of interest for the borrower. An Alt-A mortgage loan is an example of a niche loan. Alternative A paper, Alt-A, mortgages. Alt-A mortgages are a type of loan intended for borrowers who have good credit but don't meet other underwriting criteria for conforming prime loans. Borrower shortcomings such as high loan-to-value and debt-to-income ratios or limited documentation of the borrower's income make this loan higher risk and may require higher interest rates. Unique loan types. Products. Unique loan types. So far we've discussed a whole bunch of different loan products and categories that you'll encounter in your new role as a mortgage loan originator. Now it's time to give you a brief look at some unique loan characteristics that are currently available in the market or once were available in the market. Keep in mind that some of the characteristics that used to be prevalent may very well return as regulations and standards change and evolve. Subordinate liens. The term subordinate means lower in rank or position. For instance, in our federal government the vice president is subordinate to the president. Used as a verb, to subordinate something means to put it below or behind something else. In the mortgage industry, we use subordination, the act of subordinating a loan, to establish rank or priority for which loan gets paid off first in the case of a sale, foreclosure, or another act on the property's title. It is not uncommon for a property owner to have multiple mortgages on their property. The homeowner may have a primary mortgage, a second mortgage and a third mortgage. In many cases, the borrower may have used the primary or first mortgage to buy the home, then decided to use their equity by getting a home equity loan, HEL, to pay off some debts. The HEL would be in second position on the list of payoff priority because it came after the primary mortgage. A few years later, after making payments on both the primary and second mortgages, the borrower may take out a home equity line of credit, HELOC, to help pay for improvements on the home. The HELOC in this circumstance would be the third mortgage. There isn't a specific way that a HEL or HELOC must be placed in priority. A homeowner could have a HELOC as their primary mortgage, it depends on which lien comes first. The rank of lien priority can be amended if a borrower and lender agree to subordinate, make lower in rank, an existing mortgage. Consider the HELOC we just described as the primary or first mortgage. Perhaps the borrower wants to take out another mortgage. The new lender might request that the HELOC lender subordinate the HELOC as a condition for loan approval. If the HELOC lender declines, the new lender may choose to not do the loan. A borrower can have an infinite number of mortgages on their home, first, second, third, fourth, etc. Typically, the lower the rank of the lien, the higher the interest rate of the loan. This higher rate is due to the level of risk the lender carries with being placed behind other lenders in the rank of who gets paid off first. Interest-only loans. Interest-only loans are loans for which the borrower is only required to pay the interest portion of their payment. By only paying the interest on the loan, the principal balance is never reduced. Quite often IO is just a limited feature of a loan product, such as in the case of the option arm. With the option arm, the borrower is allowed to make IO payments for the first 5 to 10 years, but after this initial period is required to make fully amortizing payments. IO is also an initial repayment feature of some balloon products. Most interim, short-term, loans are IO products. Reduced documentation loans. One of the loan products that fueled the fire in the mortgage meltdown of 2008 were reduced or no documentation loans. These loans allowed borrowers to apply for and receive mortgage loans without full documentation to support their application. The basis for these loans grew out of a previous lending practice in which borrowers with some strong qualifications and good relationships with the lender would be provided a loan, even though they might not fit the standard qualification profile. This borrower, often referred to as an Alt-A borrower, could meet most of the qualification standards, but due to certain circumstance, such as a business owner who shows little income, could not qualify for a prime mortgage. Since the borrower and lender had a good relationship, the lender was willing to provide the loan without all of the standard qualifying information. Regardless of a loan's limited documentation, the loan originator will still need a verification of employment, VO, credit report review, and an appraisal for the subject property. Reduced document loans and the mortgage crisis. As discussed in the first unit, the marketplace in the early 2000s was hungry for more and more loans that could be written and sold in the secondary market. To feed this hunger, lenders began applying the process that was used for Alt-A borrowers to less qualified individuals. To ease their concerns about these less qualified individuals, the lender justified the risk by charging higher costs and fees to the borrower. These loans were called subprime loans, and after they were written and funded, many of the borrowers defaulted on their debt obligation. It is believed that if lenders did not loosen their standards, such as not requiring documentation to support the borrower's application, to accommodate these borrowers, much of the mortgage meltdown could have been avoided. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO Chapter 8, Mortgage Math 1 Simple Interest Rate. One of the biggest areas of confusion for consumers when they borrow money is the difference between the simple interest rate and the annual percentage rate, APR. While they seem like the same thing, they are actually much different. The simple interest rate, aka nominal interest rate, is the fee or cost charged to the borrower by the lender for the borrower's use of the lender's money. In the financial industry, this is often referred to as the interest rate, and it's usually provided as a percentage of the principal amount. With most mortgage loans, a portion of principal and interest is repaid each month, which allows the borrower to pay off the loan over time. Calculations, PITI. In this chapter we'll cover the four components of a borrower's monthly payment, the PITI payment. The PITI payment is typically what our industry considers to be the monthly payment obligation for the borrower. Before we can figure out the overall PITI payment, we need to calculate each individual portion of the payment. Interest only, the amount of interest paid with the loan, is extremely important. In essence, it's the amount the client pays to borrow the money. Property tax. Property tax is calculated monthly by dividing the annual property taxes by 12. Insurances. There are two different types of insurances that can affect a client's monthly payment: hazard insurance, sometimes called homeowner's insurance, and mortgage insurance. We will discuss these insurances in a later chapter. Borrowers are required to have hazard insurance, therefore we must consider this when qualifying our clients. Some clients may also have mortgage insurance, but this depends on their loan program. Let's explore how to calculate both. Hazard insurance. Hazard insurance protects the property from damage. All lenders require borrowers to have this insurance as a condition of making the loan. The cost of hazard insurance is typically annualized, so for the purpose of determining the monthly payment we simply divide the annual amount by 12. Mortgage Math 1 calculations, PITI. Mortgage insurance, private mortgage insurance, PMI/mortgage insurance premium, MIP. Mortgage insurance is another insurance that a borrower may have as part of their payment calculation. While not part of all loan agreements, when required, mortgage insurance is something that we need to calculate as part of the borrower's monthly PITI payment. We will explore the concept of mortgage insurance in a later chapter. Mortgage insurance is calculated by multiplying the mortgage insurance factor by the loan amount and then dividing the result by 12 to determine the monthly PMI payment requirement. Calculations, DTI. Debt to income. Once we've figured out our borrower's monthly income, we'll need to examine how that income stacks up against their bills. The method for evaluating this comparison is the debt to income, DTI, ratios. DTI calculations fall into two categories: front-end and back-end debt to income. Housing. DTI. Housing, or front-end, DTI is used to determine the borrower's ability to pay all their monthly housing-related expenses. Typically, these housing expenses are tied to the borrower's financial responsibilities for the home and include the PITI payment as well as homeowner's fees. These expenses do not include utilities, e.g. heat and electricity. Front end only includes things like the mortgage, taxes, and insurance. In other words, what the borrower must pay so that the mortgage holder or the tax man doesn't kick them out of the house. You can live in your house without electricity, even though it might be a little dark at night, but you can't live there if the tax collector seizes your home for not paying your property tax. These expenses are then compared to the borrower's monthly gross income. Total. DTI. Total, or back-end, DTI is used to consider all of the borrower's non-cancelable monthly debt obligations, including their housing-related expenses, to their gross monthly income. Non-cancelable debts include loan payments, such as car and student loans, credit card payments and other miscellaneous items. The key is that they cannot be cancelled. If the debt can be cancelled, it should not be included in the calculation. Even though the borrower might regularly spend money on things like food and utilities each month, they are not considered part of the total DTI. Calculations, income calculations. income. When determining a borrower's ability to pay back the loan, we usually start by calculating their monthly income. In some cases it's easy, especially if the borrower is paid monthly. Unfortunately, it's not always that easy, so over the next few pages we'll be discussing how to calculate monthly income. One thing to mention before we start: when considering a borrower's income for qualification, we always use their gross income. Gross income is the amount the borrower earns prior to the payment of taxes and non-taxable items like health insurance coverage. And to ensure we always have an accurate average monthly income, we calculate income out to the year, then divide by 12 to get the monthly income. As a rule, always figure out what a borrower is paid per year pre-tax, then divide by 12 to determine their monthly income. Hourly: if a borrower is paid an hourly wage, a certain amount for each hour worked, they're considered an hourly employee. The following calculations are used to determine their monthly income. Mortgage Math 1 calculations: income salary. Salaried employees can be paid in a variety of ways. The following calculations show the different types of salary payments and how to calculate income. Documentation required for each employment type. Remember, you will be able to estimate your borrower's income based on what they tell you, but you will not know exactly what they make until we request income documentation from the borrower. This typically happens during processing, but you can request that the borrower provide income documentation before you write their loan. Depending on how they are employed, they will receive different income documentation. Below is a list of common types of documentation required for each employment type. 1. Salary, 2 years W-2s, 30 to 60 days worth of pay stubs. 2. Independent contractor, 2 years 1099s. 3. Passive income, Social Security/retirement award letters, bank statements. 4. Self-employed/commission, 2 years tax returns. No matter how you are employed, all borrowers will also have to sign a 4506C. This allows for the lender to go to the IRS and get a transcript of the borrower's tax returns. Calculations: LTV. Down payment. Mortgage Math 1 calculations, LTV. Before we calculate the down payment, we need to clarify what a down payment is. The down payment is a requirement of the lender and the loan program provider as part of getting a mortgage. The seller has nothing to do with the down payment. As far as the seller is concerned, they will receive the agreed upon sales price at closing. So if the home sells for $100,000, the seller gets $100,000. If the buyer uses a mortgage loan to purchase the home, the buyer will give the lender the down payment. The lender then uses the down payment amount as a factor in determining the borrower's loan amount. In the above scenario with the $100,000 purchase price, let's assume that the minimum down payment required for the loan is 3.5% of the purchase price. This means the borrower would pay the lender $3,500, $100,000 x 3.5%, as the down payment on the loan, and thus the loan amount would be $96,500, $100,000 to $3,500. There are two ways you can determine someone's down payment. See below. We need to do this calculation as part of the process to help determine if the borrower has the money needed to purchase the property. Each loan product has different minimum down payment requirements, and knowing the down payment helps us inform the borrower of their options. It also helps us determine the borrower's loan-to-value, which is how we determine the borrower's equity position. Mortgage Math 1 calculations, LTV. Loan-to-value. One of the most important factors that impacts a borrower's qualifications is the amount of equity they have in the subject property. Equity simply means ownership or value. Equity is the amount of the home's value that is free and clear, or not wrapped up in a loan. You can find a home's equity by subtracting the loan balance from the value of the home. In a purchase transaction, the down payment amount is the borrower's initial equity position. If the borrower makes a $5,000 down payment on a $100,000 home, their equity value equals $5,000 while the lender's equity value is $95,000. Equity can also be described as a percentage. In this scenario, the borrower's equity position is 5% and the lender's is 95%. Equity can be determined in a variety of ways, but the most accepted practice for equity determination is through loan-to-value, LTV, calculations. There isn't a more simple way of describing LTV, it's the loan amount compared to the value of the home. In these calculations, the value of the home is based on either the purchase price or the appraised value, whichever is less. So if the purchase price of a home is $100,000, but the home appraises for $95,000, the value used for the calculation is $95,000. When calculating LTV, we use the borrower's current principal balance as the loan amount. If a borrower took out the loan 3 years ago at $100,000, but they've been making payments and the balance is now $90,000, then $90,000 is the amount to be used when determining LTV. Lastly, if the LTV is being used for a refinance loan, the purchase price doesn't matter. Only the appraisal amount will be used for determining value, unless multiple appraisals are done, in which case, the lowest of the appraised values will typically be used. There is more than one LTV calculation, and the type of LTV calculation to use when determining equity depends on the transaction and the type of mortgages or liens involved. LTV is the amount of the primary, first, mortgage compared to the home's value. Here is how you calculate it: combined loan to value, total loan to value, combined loan to value, CLTV, may also be described as total loan to value, TLTV. Fannie Mae uses CLTV while Freddie Mac uses TLTV. This is the amount of all of the borrower's mortgages or liens compared to the home's value. High combined loan to value, high total loan to value. The final equity calculation we'll discuss is high combined loan to value, HCLTV, or in the case of Freddie Mac, high total loan to value, HTLTV. HCLTV is used when a home equity line of credit, HELOC, is involved in the transaction. Rather than use the HELOC's current balance, like we would do with CLTV, we would replace that balance with the borrower's maximum limit on the HELOC. Chapter 9, Programs. The 4 CS programs in this chapter will discuss conventional and non-conventional mortgage loan programs. Each program offers their own version of fixed-rate mortgages, ARMs and reverse mortgages. Some include products with unique characteristics. For example, a product like the graduated payment mortgage is available only from the FHA, but no other government agency. The 4CS will talk more about underwriting later in this course, but for now you need to know that each lender underwrites loans before closing. Through this process, they evaluate whether the borrower meets certain qualification requirements to be approved for a mortgage loan. The qualifications GSEs and lenders evaluate fall into what we call the 4CS: credit, capacity, collateral, and cash. When we describe loan programs through this section, you will see that each loan program also has unique qualification requirements. In the Mortgage Math 1 chapter, we do a deep dive on what the qualification ratios described in the 4CS are, and how they are calculated. For now, you will want to know the unique qualifications for each loan program, because they will tell you which program is the best fit for each client and their needs. Credit. This is where we will look at the borrower's credit report, which tells us the borrower's credit score and summarizes their current debt obligations. The credit report/score is a good indication of how reliable our borrowers have been in paying back debts. See more in the application chapter. Capacity. This is where we will look at the client's gross monthly income in comparison to their monthly debt-to-income ratio. This will tell us what is affordable for the client. See more in the Mortgage Math 1 chapter. Collateral. This is where we measure the loan amount in comparison to the home's value, loan to value. See more in the Mortgage Math 1 chapter. Cash, also known as assets, this is any money the client has in a bank account, retirement account, etc. Conventional loans. Conventional means setting the standard. Conventional mortgages were the first type of mortgages available, so they set the standard. When mortgages were first created, they were only available through private lenders, and this was the only way a borrower could finance the purchase of a home. At the time, they were not called conventional mortgages, but as the industry evolved they became conventional because they were the original standard. Today conventional mortgages are still private programs, meaning they are not government-backed or insured, but they are categorized into two different groups: conventional conforming mortgages and conventional non-conforming mortgages. Conforming loans meet the underwriting standards of Fannie Mae and Freddie Mac. Non-conforming mortgages do not meet these guidelines, however are still not sponsored by the government. Conventional conforming loans: Fannie and Freddie Mac programs. Conventional conforming loans: the Federal National Mortgage Association, Fannie Mae, and the Federal Home Loan Mortgage Corporation, Freddie Mac, are government-sponsored enterprises, GSE, that set the underwriting standards for conventional conforming mortgages. Even though Fannie and Freddie are GSEs, they are not insured or guaranteed by the government. Remember, GSEs are private entities created for a public purpose. Fannie and Freddie were created to reduce cost and improve the availability of money in the mortgage marketplace. The way that Fannie and Freddie accomplish this purpose is by setting underwriting standards for mortgage loans. If a lender makes a loan that meets these standards, it is considered a conventional conforming mortgage, because it conforms to Fannie and Freddie's standard. These standards are typically higher than conventional non-conforming loans and include a minimum level for credit scores, DTI, LTV, reserves, and a maximum loan amount limit. If a loan conforms to their standards, Fannie and Freddie will buy the mortgage from the lender. This frees up money for the lender to make more loans. Fannie Mae. In 1938, President Franklin Roosevelt and the United States Congress created the Federal National Mortgage Association, Fannie Mae, as an entity responsible for buying mortgages from lenders. The lenders could then use the influx of capital to provide more loans. The agency, along with FHA, supported a methodology that created a new wave of American home ownership for low and middle income borrowers. Fannie Mae typically buys loans from larger lenders such as high-volume depository institutions. Freddie Mac. In 1968, Fannie Mae was spun off from the government into a publicly traded company. President Lyndon Johnson made this decision due to the heavy toll the Vietnam War was taking on the federal budget. To counterbalance Fannie Mae's potential monopoly, the Federal Home Loan Mortgage Corporation, Freddie Mac, was created in 1970. Freddie Mac went public in 1989. Freddie Mac typically works with small lenders. These lenders are often referred to as thrifts. Conventional conforming loan qualifying standards: Fannie and Freddie ensure liquidity in the marketplace by purchasing loans that meet their standard. These standards include limits on the size of loans established annually by the Federal Housing Finance Agency, FHFA, based on changes in median home price. The limitations on loan amounts, as shown in the chart, determine whether or not a loan qualifies as a conforming loan. Conventional conforming mortgage loans can be fixed-rate mortgages, ARMs, hybrid ARMs, or super-conforming mortgages. Super-conforming mortgage loans are for high-cost areas that require larger loan amounts. During the financial crisis of 2008, many loan programs that supported loan amounts exceeding the FHFA loan limits were pulled from the market. Recognizing the need to service higher loan amounts, Fannie Mae and Freddie Mac worked with FHFA to increase loan limits for high-cost areas. These higher loan amounts are super-conforming loans. 1. Conforming mortgages with limited risk are considered A paper or prime loans and would involve a borrower with a FICO score greater than 680, an LTV less than 80%, and a DTI of less than 36%. Programs: conventional conforming loans. Credit: to qualify for a conventional conforming loan, the consumer's FICO score should be 620 or higher. Capacity: the DTI ratio standards for conforming loans are generally a 28% housing DTI ratio, front end, and a 36% total DTI ratio, back end, with an allowance of up to 45% with compensating factors such as substantial assets. Non-taxable income, such as Social Security, disability, charitable donations, life insurance payouts, child support, or any public assistance, can be grossed up by 25%, for a total of 125% of the income. A 2-year average of overtime and/or bonuses the consumer receives should be considered. 75% of rental income can be utilized in determining total monthly income. If a revolving debt does not state a monthly payment on the credit report, 5% of the debt must be included in the consumer's total monthly liabilities. Collateral: a standard appraisal must be completed by a licensed/certified appraiser. Maximum LTV will vary depending on loan program and occupancy status. For investment properties, requirements are more strict. For purchase loans, the maximum LTV is 95%. Cash: the consumer will need to prove asset reserves for certain programs. For example, mortgage loans for investment properties usually require up to 6 months of reserves to be verified. If the consumer is bringing money to the closing of a mortgage loan transaction, then the source of those funds must be verified. Conventional conforming loan particulars: fees. Fannie Mae and Freddie Mac do not set any limitations for mortgage loan fees. Fees must be compliant with federal regulations. Unique features: conventional loans allow consumers to get a loan for a second home or an investment property, in addition to a primary home. Securitization: Fannie and Freddie package the loans they purchase into collateralized debt obligations, CDO, called mortgage-backed securities, MBS, which they then sell to investors in the financial market. We'll review this more in a later unit. Conventional conforming loans: conventional conforming purchase loans, down payment as an overall minimum. Fannie Mae and Freddie Mac require a 95% LTV, 5% down payment, for one-unit primary residences. Second homes and investment properties require a lower LTV, greater down payment, due to the increased risk factor. The minimums for eligible programs may vary depending on the following factors: number of property units, occupancy, principal, second or investment property, automated underwriting versus manual underwriting, credit score, if applicable, transaction type, purchase, limited cash out refinance, or cash out refinance, mortgage program type, fixed, ARM. Seller concessions: in a purchase transaction, the seller may pay a percentage of the buyer's closing costs. If the buyer obtains a conforming mortgage loan, the maximum amount the buyer can receive from the seller is 6% of the purchase price if the buyer puts a down payment of 10% or more toward the purchase. If the buyer decides to put down less than 10%, the maximum seller concessions are 3%. Lastly, if the buyer is purchasing an investment property, the maximum seller concessions are 2% regardless of how much the buyer puts down. Conventional non-conforming loans: a non-conforming mortgage loan is a conventional loan that does not meet the requirements established by Fannie Mae and Freddie Mac. This type of financing is considered riskier than a conforming mortgage loan. Non-conforming loans usually have lower qualification standards and higher costs and fees. A non-conforming loan can either remain in the lender's portfolio or be securitized by the lender and then sold to an investor as an MBS. What is a conventional non-conforming loan? Non-conforming mortgages may be considered non-conforming even if the loan only misses one of Fannie or Freddie's qualifying standards. An example of this could be the Alt-A borrower who shows lower income, but was still considered less risky by the lender. Because conventional non-conforming loans are by their nature non-conforming, there are no specific set qualifying requirements. To be clear, there's nothing wrong about non-conforming mortgages. Depending on the circumstance, they may fit a particular borrower's need. And simply because someone has lower or different qualifications doesn't mean that the loan they receive is a bad product or from an unscrupulous lender. Types of conventional non-conforming loans: forms of non-conforming mortgage loans include jumbo loans, mortgages that exceed the loan limits established by the Federal Housing Finance Agency, FHFA, and thus do not meet the standards set for conforming mortgages. Niche loans, provided under special or unique circumstances by private lenders. Example: a borrower has little to no credit and/or work history, but a high level of net worth, and the lender makes the loan based on their net worth, Think of a young NBA player who just signed a multi-million-dollar contract. Non-traditional arms. An option arm could be an example of a non-traditional arm. Graduated payment mortgages, GPM. Because of its negatively amortizing features, a GPM could be a non-conforming loan. Subprime mortgages, loans for borrowers with lower qualifications, such as poor credit or bankruptcies. Non-conventional mortgage loans, government loans. Non-conventional mortgages are also known as government mortgages. The reason they're considered non-conventional is because they were created to meet a public need not being filled by conventional mortgage loan programs. Non-conventional mortgage loans are offered from 3 different program providers: the Federal Housing Administration, FHA, the Department of Veteran Affairs, VA, and the United States Department of Agriculture, USDA. While the FHA loan program is accessible for all Americans that meet its qualification standards, both VA and USDA loans do come with some restrictions as to who can apply and qualify for their products. Each one of these programs provide loans that are accompanied by some kind of government insurance or guarantee. It is this guarantee that provides lenders with the assurance that they will be compensated even in the case of borrower default. This encourages lenders to offer non-conventional loans to their borrowers. The next few pages will discuss the different programs, which are backed by the full faith and credit of the United States government. Non-conventional mortgage loans, government loans, FHA mortgage loans. The Federal Housing Administration, FHA, offers a variety of mortgage products to consumers. In comparison to conventional conforming products, FHA loans have lower qualification requirements and therefore are more accessible to consumers. These qualifications include lower credit score, LTV, DTI, and reserves, but share similar loan limit requirements of conventional conforming loans. FHA products. The following are some of the more common FHA loan products: 203B fixed rate mortgages, 15, 20, 25, 30-year terms. 203K, rehab and repair, used for repairing a home. 204G, Good Neighbor Next Door, GNND. This program provides a 50% discount for law enforcement officers, teachers, firefighters, and emergency medical technicians to purchase homes in revitalization areas. Eligible single-family homes are listed exclusively for sale through the Good Neighbor Next Door sales program. Properties are available for purchase through the program for 5 days. Borrowers must agree to live in the home for a minimum of 3 years. 232, Residential Care Facilities Financing. 234, C used for condominiums. 242, Hospital Financing. 245, A, Growing Equity Mortgage, GEM. This is where a borrower pays a little extra to gain more equity sooner. 251, Adjustable Rate Mortgages, ARM 5/1 and 7/1. 255, Home Equity Conversion Mortgage, HECM. The FHA Reverse Mortgage, aka HECM, was introduced in 1987 as part of the National Housing Act. Designed to provide governmental stability to the reverse mortgage marketplace, the HECM program can be used to purchase or refinance a home. 513, Energy Efficient Mortgages, EEM. Originally piloted by a congressional mandate in 1992 and expanded as a national program in 1995, Energy Efficient Mortgages helps homeowners reduce their utilities usage by adding energy-saving features to their home. An EEM allows the homeowner to purchase or refinance their home and incorporate the cost of energy improvements into the mortgage without qualifying for, or making a down payment on, the improvement costs. EEMs can be used in conjunction with most existing FHA programs. The borrower must be eligible for a maximum FHA insured loan using standard underwriting procedures and make a 3.5% down payment. The cost of the energy improvements plus the cost of reports and inspections needs to be less than the following amounts: 5% of the value of the property, 5% of 115% of the median area price of a single-family dwelling, 5% of 150% of the conforming Freddie Mac limit. Non-conventional mortgage loans, government loans, FHA loan qualifying standards: credit, mortgage, late payments, bankruptcies, and seriously delinquent accounts could prevent a borrower from being eligible for this mortgage loan. A credit score of 580 makes a borrower eligible for maximum financing. A 500 to 579 score limits a borrower to a 90% LTV eligibility. And a score below 500 disqualifies a borrower. Capacity: the ratios used to qualify a mortgage loan applicant based on their ability to repay an FHA loan are generally a 31% housing DTI ratio and a 43% total DTI ratio. Collateral: the livable condition of the home and its appraised value will determine whether or not it qualifies for an FHA loan. The consumer may be required to make minor home repairs, such as adding handrails for a staircase or repairing water damage. For purchase loans, the maximum LTV is 96.5%. For a refinance loan, a maximum LTV of 97.75%. Cash at closing: the borrower may need to bring cash to cover closing costs and prepaid items, property taxes and insurance, or a down payment requirement on a purchase loan. The borrower must demonstrate that they have these funds available through asset verification, checking or savings account statement, money market account, 401k retirement account, etc. Gift funds received from a relative are acceptable as long as there is a statement, gift letter, from the gift donor. FHA mortgage loan particulars: fees for an FHA loan. Mortgage lenders are able to charge borrowers customary and reasonable costs needed to close the mortgage loan. The following are considered to be customary and reasonable: lender origination fee, attorney's fee, appraisal fee, home inspection fee, title insurance, title examination fee, document preparation fee, property survey fee, credit report fee, transfer stamps, recording fee, taxes. As an additional note, the FHA does not consider a processing fee or an expediting fee to be customary and reasonable. Unique features: if a property with FHA financing is resold within 90 days of the date of its purchase, the property will not be eligible for a FHA mortgage loan. Non-conventional mortgage loans, government loans, mortgage insurance. The FHA mortgage program thrives because of the protections provided through mortgage insurance premiums, MIP, to lenders. MIP provides support for lenders in the case of borrower default. There are two forms of MIP, both of which are required with FHA loans. Here's a basic explanation of how mortgage insurance premiums work. At the time of closing, the borrower pays their UFMIP and then includes their MIP payment as part of their monthly payment to the mortgage servicer. If the borrower defaults, doesn't pay the mortgage payment and the home is foreclosed upon, the lender can sell the home to recoup, get back, the principal balance owed by the borrower. If the house sells for less than the balance due, the FHA will provide the lender with the difference. Through the collection of mortgage insurance, FHA provides certainty and support to lenders. This insurance makes lenders more willing to write loans for borrowers who meet FHA's lower qualifying standards because they know they are protected in case of default. UFMIP, upfront mortgage insurance premium. This is a one-time fee charged to the borrower at closing. It is a standard 1.75% of the loan amount and may be rolled into the amount financed by the borrower. MIP mortgage insurance premium. This is a fee calculated annually and paid monthly that is included with the borrower's PITI payment. MIP is part of that second I for insurances. The amount required for MIP is based upon the term, loan amount, and initial LTV of the mortgage. FHA purchase transactions. Down payment. With an FHA purchase loan, a borrower must provide at least 3.5% of the purchase price of the home as the down payment. Because of this, the maximum LTV for most FHA purchase loans is 96.5%. The maximum LTV for most FHA refinance mortgage loans is 97.75%. For properties under construction or existing construction less than a year old, the maximum LTV is 90%. The borrower would have to make a down payment of 10% of the purchase price. The minimum credit scores for FHA financing affect qualifications. Therefore, not all consumers will qualify for the low minimum down payment amount. Seller concessions. In a purchase transaction, the seller is able to pay a percentage of the buyer's closing costs. If the buyer obtains a FHA mortgage loan, the maximum amount the buyer can receive from the seller is 6% of the purchase price. These seller concessions cannot be considered as a cash reserve for the borrower, and they may only be applied towards allowable closing costs and prepaid items. Regardless of the amount of seller concessions in an FHA purchase transaction, the borrower must still provide at least a 3.5% down payment. Qualifying standards for FHA HECM loans. Qualifying differs with FHA's HECM product. As a reminder, HECM is the FHA's reverse mortgage program. The HECM is focused specifically on the value of the property involved. While the borrower's credit history and financial capacity needs to be verified, there are no minimum requirement thresholds. Timely payment of the borrower's property taxes, hazard and flood insurance premiums, if applicable, will be verified as well. Instead of traditional LTV ratios to determine how much money the borrower can receive, the underwriter calculates the principal limit, PL, based on age of the youngest borrower, current interest rate, maximum claim amount, lesser of the appraised value, sales price, or mortgage limit of $822,325. Initial mortgage insurance premium. A HECM mortgage loan becomes due and payable upon certain conditions such as death of the last surviving borrower. In cases where there is a non-borrowing spouse, if the borrower passes, then the due and payable status will be deferred, postponed, for as long as the non-borrowing spouse continues to meet all qualifying requirements for the loan. Programs. Non-conventional mortgage loans, government loans, HECM purchase. The FHA HECM allows seniors to purchase a new primary residence with its reverse mortgage program. Using the loan proceeds of a reverse mortgage to purchase a home enables senior homeowners to relocate closer to family or to downsize to homes that meet their physical needs. If the home being purchased is newly constructed, it must be 100% complete at the time of inspection and initial application. Seller concessions are not applicable to HECMs. The cash investment in the property must equal the difference between the amount of the insured mortgage, excluding any upfront MIP, and the total cost to purchase the property, closing costs. HECM particulars. HECM costs include ongoing and initial costs. Accrued interest and annual mortgage insurance premium, MIP, are ongoing costs. The following are initial costs: UFMIP, 2% MIP, 0.5% origination fee, up to $2,500 for loans less than $125,000. For loans $125,000 or greater, the fee is 2% of the first $200,000 and then 1% of anything beyond the first $200,000 with a maximum of $6,000 total. Third-party costs: appraisal, title insurance, survey, inspection fees, recording fees and taxes, credit report fee, attorney's fees, etc. Servicing fee covers the cost of managing the administrative responsibilities of the loan. VA mortgage loans. VA mortgage loans are non-conventional loans that are guaranteed by the Department of Veterans Affairs. Loan eligibility. Mortgage loans provided by the Department of Veterans Affairs, VA, are specifically and only for active duty and retired military personnel and eligible spouses, along with surviving spouses. VA loans were initially created to provide financial support for returning military veterans and their families after World War II. Since that time, the program has flourished through the well-deserved benefits provided to VA borrowers. A VA loan is only available on primary homes and may not be used for investment properties or secondary homes. The transaction can be for a purchase, refinance, construction, land contract, or assumption loan. Unlike FHA loans, VA loans do not impose a maximum loan amount for qualification. Eligibility for a VA mortgage requires more than a borrower's qualification as a veteran. It also depends on the length and character of the veteran's service. The borrower's level of eligibility is documented on a Certificate of Eligibility, CO. To request a CO for VA home loan benefits, A veteran submits a VA Form 26 to 1880 to the Atlanta Regional Loan Center. The CO is mailed directly to the veteran. Veterans in the Reserves, National Guard, or on active duty must also obtain a signed statement of service issued by their commanding officer. A veteran dishonorably released or discharged from military service does not qualify for a VA mortgage. A DD Form 214 is needed to prove a veteran was released or discharged from active duty under any condition other than dishonorable. Products: VA loans are available in fixed rate, adjustable rate, and energy-efficient mortgage loan products. Even though they're government loans, they carry much of the same qualifying standards as conventional conforming mortgages. VA guarantees 30-, 25-, 20 and 15-year fixed-rate mortgage programs as well as ARM programs. VA ARM programs have a 1% annual interest rate cap and a 5% lifetime interest rate cap for 1- and 3-year hybrid ARMs. As with all ARMs, the interest rate caps remain throughout the life of the loan. VA Energy Efficient Mortgage, EEM. Just like FHA EEMs, VA EEMs are loans to cover the cost of making energy efficiency improvements to a home. They can be made in conjunction with a VA loan for the purchase of an existing home or a VA refinancing loan. Programs: non-conventional mortgage loans, government loans, VA loan qualifying standards. The VA program also uses the 4Cs to determine the creditworthiness of a mortgage loan applicant. Credit history standards are similar to other government programs as well as Fannie Mae and Freddie Mac programs. The VA specifically requires that the borrower's qualifying credit report must be less than 120 days old. Capacity: the VA requires a pay stub from within the last 60 days. The ratio used to qualify a mortgage loan applicant based on their ability to repay a VA loan is usually a 41% total DTI. The VA also includes a residual income threshold as a factor for determining loan suitability for applicants. Because regular expenses such as food, clothing, and gasoline are paid out of the residual, VA uses the residual income factor to ensure that the new mortgage will not put an unnecessary strain on the prospective borrower's household budget. Residual income requirements vary by region and family size. Even though these residual income requirements are a factor in determining borrower qualification, a failure to meet the threshold does not cause immediate application rejection. Collateral: once the appraisal is complete, the VA will issue a Certificate of Reasonable Value, CRV, that shows the property's current market value based on the appraisal. The CRV does not include information regarding any defects associated with the property. A VA appraisal is valid for up to 180 days. Maximum LTV is 100%. Cash at closing: the borrower may need to bring cash to cover closing costs and prepaid items, property taxes and insurance, or a down payment requirement on a purchase loan. The borrower must demonstrate that they have these funds available through asset verification, checking or savings account statement, money market account, 401k retirement account, etc. Gift funds received from a relative are acceptable as long as there is a statement, gift letter, from the gift donor. Programs: non-conventional mortgage loans, government loans, VA loan particulars: funding fee, entitlement, and guarantee rather than insurance. The VA requires a funding fee on its loans that work to help support the costs of entitlement and guarantee for their veteran borrowers. Below is a high-level overview of these concepts. See the Insurances section for more details. Funding fee: this is a one-time fee, required by the VA to be paid by the borrower and added to the loan amount. The fee amount depends on the veteran's circumstances, such as if they had a previous VA loan. The fee ranges from 0.5% to 3.6%. For example, the funding fee on a purchase VA loan with no down payment is a set 2.3%. The funding fee is waived for veterans who are eligible for military disability classification and surviving spouses of veterans deceased due to military activities. The funding fee may be waived if the veteran has a documented disability due to military service. A funding fee refund may be allowed when a veteran paid the fee despite being exempt, disability, or when there was an overpayment due to a miscalculation. Point 1 Entitlement. This is the amount that a veteran can be guaranteed for a VA mortgage loan. It is on the CO. The entitlement is the basis upon which a guarantee will be provided to the lender in case of borrower default. The basic entitlement that VA offers is $36,000 for loans of $144,000 or less. For loans greater than $144,000, VA offers an increased entitlement amount of 25% of the loan amount to help with down payments in higher cost areas. Entitlement is not given in the form of cash or checks directly to the veteran, and it cannot be exchanged for cash. Guarantee. This is the amount VA may pay a lender in the event of loss due to foreclosure. The maximum guarantee VA will issue is 25% of the value of the loan amount for homes valued at $453,100 or less. This guarantee can come from a client's available entitlement. There are some rare exceptions made for expanded guarantee limits in some of the more high-cost U.S. counties. VA determines the maximum guarantee amount for these counties by establishing limits. VA uses the same loan limits as Fannie and Freddie, which are set by FHFA. The maximum guarantee amount, available for loans over $144,000, is 25% of this loan limit. A veteran with full entitlement available may borrow up to the limit and VA will guarantee 25% of the loan amount. If the veteran's loan amount exceeds the limit, they may be required to supply a down payment to meet the required 25% guarantee. If a veteran has previously used entitlement that has not been restored, the maximum guarantee amount available to that veteran is reduced accordingly. Point 3 Non-conventional mortgage loans, government loans, fees for a VA loan. Mortgage lenders may charge borrowers customary and reasonable costs needed to close the mortgage loan. Brokerage fees cannot be charged on a VA mortgage loan. The typical origination fee charged by a mortgage lender for a VA mortgage is 1%. Unique features with VA loan programs. It is essential that certain forms, such as the CO and DD Form 214, are provided. Often a leave and earnings statement, LEA, is requested from a borrower. This is essentially a pay stub for military and government workers. Additionally, in order to qualify for a VA loan, clients must meet a specific residual income threshold, which varies depending on the size of the family and location. VA purchase loans down payment. The VA offers purchase and refinance loan programs that require no down payment or equity, and therefore 100% financing is available. Seller concessions. If the buyer obtains a VA mortgage loan, the maximum amount of concessions the buyer can receive from the seller is 4% of the purchase price. Non-conventional mortgage loans, government loans, USDA mortgage loans. USDA mortgage loans are non-conventional loans guaranteed by the U.S. Department of Agriculture. USDA basics. Just as VA loans are restricted to military personnel, United States Department of Agriculture, USDA, loans are restricted to properties in designated rural areas. Rural is defined very broadly in USDA requirements and may include towns and small cities. For the sake of simplicity, let's consider that for a property to be called rural, it should be in open country and not associated with an urban area. The purpose of USDA loans is not for farms. We know, you'd think that a loan from the Department of Agriculture would be for farms. In fact, USDA expressly prohibits their loans to be used for income-producing properties like farms. Instead, USDA loans are really meant for people who work in the agriculture industry or support that industry. Think about how few apartment buildings or rental properties are located in rural areas. Finding housing if you work on a farm or for a business that works with the farming industry could be very challenging, so the need for housing financing in rural areas is a necessity. USDA Products Section 502 Direct Housing Loan Program, also known as USDA Direct. This program is available in terms of 33 to 38 years and is available to low-income borrowers. Single Family Housing Guaranteed Loan Program, also known as SFHGLP or Guaranteed. This program is only available in the form of a 30-year fixed-rate mortgage and is designed for moderate-income borrowers. USDA backing as the FHA requires MIP and VA requires the funding fee. The SFHGLP requires a guarantee fee paid at closing and an annual fee that is paid in monthly installments beginning 12 months after loan closing. Both the guarantee fee and the annual fee function similarly to other government loans. They provide assurances to lenders in case of borrower default. 1 USDA loan qualifying standards. The USDA program uses the 4Cs to determine the creditworthiness of a mortgage loan applicant. Credit mortgage late payments, bankruptcies, and seriously delinquent accounts could prevent a borrower from being eligible for this mortgage loan, but there are no specific credit rating requirements. Capacity. The ratios used to qualify a mortgage loan applicant based on their ability to repay a USDA loan are generally a 29% housing DTI ratio and a 41% total DTI for the SFHGLP, guaranteed loan. For the 502 direct housing loan, USDA requires the borrower to prove they have low income based on area median income. Collateral. A standard USDA appraisal is needed. Properties cannot be located in a floodplain defined as landforms subject to repeated flooding. Maximum LTV is 100%. Cash. No specific asset verification requirements exist. Non-conventional mortgage loans, government loans, USDA mortgage loan particulars. Fees. For a USDA loan, there are no fee limitations. Fees must comply with federal regulations. Unique features. These mortgage loans are distinct because they are made in rural areas. Some USDA loan products can be longer than 30 years. And some USDA loans can be used for home repairs finished after closing. USDA purchase loans. Down payment. The USDA offers purchase loan programs that require no down payment, and therefore 100% financing is available. Seller concessions. With a USDA loan, the amount of seller concessions a buyer can receive in a purchase transaction is unlimited. If, however, the amount of seller concessions exceeds 6%, a comment from the appraiser is required explaining why a greater amount is needed. Chapter 10, Application. The mortgage loan application can be one of two things. In the eyes of some of the biggest laws and rules that govern our industry, like RESPA, the Real Estate Settlement Procedures Act, Regulation X, TILA, the Truth in Lending Act, Regulation Z, and their jointly corresponding TRID, TILA-RESPA Integrated Disclosure Rule, the meaning of a complete application is simply when the consumer provides the mortgage loan originator with the 6 pieces of information needed to apply for credit. On the other hand, the actual form we use in our industry to record the consumer's information, qualifications, and loan information is called the Uniform Residential Loan Application, URLA, or 1003. In this chapter we'll touch on what the law says is a complete application and the responsibilities borrowers and co-signers have. We will then discuss the physical application form and process, including a breakdown of the URLA into easy-to-understand sections. Complete application vs. The application. Complete application. What does it mean to complete an application for credit? You may think it means filling out some forms, providing some documents and crossing your fingers, but in mortgage law it really means when the consumer provides the mortgage loan originator with the 6 key pieces of information needed to apply for credit. This complete application can be provided to an MLO in writing, through an electronic submission process, or verbally. If it is provided verbally, the MLO must keep a written or electronic record. However, these 6 pieces will typically be recorded on the Uniform Residential Loan Application. The 6 pieces of information include: address of the property to be mortgaged, loan amount sought, borrower's income, estimated value of property, borrower's name, borrower's social security number, application, borrower information, who's responsible. During the mortgage loan origination process, both the mortgage loan originator and the borrower have responsibilities in providing and ensuring that the application is correct. Consumer. The consumer is ultimately responsible for the information they provide on the application. Providing accurate information allows consumers to properly qualify for a mortgage loan that fits their situation. Simple mistakes such as misspellings and the omission of information are typical and considered bona fide errors. However, Falsifying any information to gain approval for a mortgage loan is considered fraud and is punishable by law. By signing the application, the consumer acknowledges the truthfulness of the information they have provided. Mortgage loan originator. Technically, the mortgage loan originator assists the borrower with completing the application, because the borrower is the one responsible for the information they provide. The MLO is the expert and therefore helps determine the suitability of mortgage loan products and programs for a consumer. There must be an advantage, or tangible net benefit, for a mortgage loan to be suitable for a borrower. For example, with a refinance, simply providing a lower monthly payment may not be a tangible net benefit if the length of the mortgage term is extended. On the other hand, if providing a lower monthly payment over a longer term helps the borrower meet their current financial obligations more effectively, it is a tangible net benefit. When taking an application, the loan originator must assist the consumer in filling out the application accurately and must check for any mistakes. It is considered fraud and is punishable by law if the loan originator falsifies or alters any information on the URLA. During this time, it is important for the loan originator to properly explain all possible risks associated with the borrower's new loan. The following are some additional examples of tangible net benefit: lower interest rate, consolidation of debt, shorter amortization schedule, changing from an adjustable rate to a fixed rate, eliminating a negative amortization feature, eliminating a balloon payment feature, receiving a cash out from the new loan in an amount greater than all closing costs incurred in connection with the loan, avoiding the likelihood of foreclosure, eliminating mortgage insurance, borrower information, borrower versus co-signer. A co-borrower is somebody who is both on title, has ownership rights, and on the loan. A mortgage loan can have as many co-borrowers as desired. A co-signer is somebody who is on the loan but does not have ownership of the property. A co-signer is an individual who provides their qualifications to assist the borrower in receiving the loan. Typically, a co-signer is included on the loan application because the borrower is unable to qualify without the co-signer's qualifications. Co-signers do not have ownership rights to the property. Regardless of whether they are a borrower or co-signer, all applicants on the loan application will have equal responsibility for the debt. The difference is the consequence of the debt not being paid. For co-borrowers, if the debt is not paid, the borrowers will lose their home and damage their credit history. For the co-signer, because they do not have ownership rights to the property, they won't lose their home, but it will still damage their credit. Accuracy: since the borrower is the one responsible for what goes on the application, we want to make sure that the information is as accurate as possible. Certainly there will be times when the borrower makes an innocent error with the information they provide. Perhaps they work hourly and make $25/hour. Normally, their weekly income is $1,000, but occasionally they work overtime and make $1,200 per week. You happen to talk to them while they're looking at their most recent pay stub and right at the bottom it says $1,200, so they tell you, "I make $1,200 per week." This could certainly be an innocent error. Perhaps when asked about their property tax bill, they tell you they think it's $3,000/year. They realize later it's closer to $4,500. That's okay, most people don't think about taxes, so it's not unusual for them to mistake the number. We should do our best when assisting the borrower to get the most accurate information possible. Even the simplest error could result in improper initial qualification for the borrower. This could cause the loan to be suspended in process and ultimately lead to the loan being denied. Nobody wants that, so when you're helping the borrower fill out the URLA, make sure they understand how important accuracy is with the information they provide. If possible, tell them in advance some of the questions you'll be asking so that they're prepared with the answers. Even better, let them know what documents will be needed by the underwriter when processing and verifying their loan, and have them bring the paperwork with them for the application discussion. That way they'll already have the necessary documents and you can review them together to ensure the information is correct. Mortgage fraud: we'll talk more in depth about mortgage fraud in a couple of the other units in this course, but we wanted to take a moment to touch on it here. The time of application is crucial in establishing with your borrower the importance of being truthful and honest with the information that they provide on the application. They may not realize it, but lying on the application is a punishable offense with as much as a $1 million fine and or 30 years in prison. Given the severity of the penalty, it's wise that the borrower understands not only how important it is to tell the truth but also that if they insist on lying, it's fraud. Credit report. Typically one of the first things a mortgage loan originator will do as part of the application process is to look at the consumer's credit report. This is known in the industry as a credit pull. You will likely do this before you do anything else, because the information it provides can tell you very quickly if the consumer will be able to qualify at all and, if so, for what type of product and program. To do the credit pull you'll need the borrower's name, social security number, date of birth, and current address. Once the MLO reviews the credit report, they can determine the likelihood that the borrower may qualify for the loan product and program they need. Given the volume of information provided on the credit report, many consumers and MLOs choose not to move forward in the application process based on derogatory information provided on the report. Permissible purpose. The MLO will also need permission from the consumer to access the report. This is known as permissible purpose. Permissible purpose not only requires the consumer to agree to the credit pull, but the pull must also have a valid purpose. Permission plus purpose equals permissible purpose. For us, the application for a mortgage loan is a purpose. Information on the credit report. The information on the credit report provides the borrower's credit score and credit history, including open and closed accounts, what credit accounts do they currently have, as well as previous accounts. Payment history, did they pay their bills on time and what kind of bills were they? Public records information, do they have any legal judgments against them? Bankruptcies. Uniform Residential Loan Application. The Uniform Residential Loan Application, aka URLA, Form 1003, the application, is the standard mortgage application form used in almost all mortgage processes. Fannie Mae, Freddie Mac, and Ginnie Mae, FHA, VA, and USDA, require that all information needed for a mortgage loan be recorded on the URLA. While there is no law that requires the URLA to be used for mortgage loans, if the lender ever expects to sell the mortgage in the secondary market or meet non-conventional mortgage standards, they'll need an URLA. In this section, we'll review each part of the URLA and briefly discuss what information is required. Just as a reminder, bona fide errors in the complete application or the URLA are common and are not an indication of fraud. But, to help reduce these errors, instructions are provided throughout the URLA to assist the consumer and the loan originator in properly completing the application form. The URLA is a dynamic document. If the borrower is not required to complete a section, it will not be visible to the client while signing. The URLA is broken into 9 sections, which include 1. Borrower information, 2. Financial information, assets and liabilities, 3. Financial information, real estate, 4. Loan and property information, 5. Declarations, 6. Acknowledgements and agreements, 7. Military service, 8. Demographic information, 9. Loan originator information, continuation sheet, lender loan information. The lender loan information is a separate piece to the URLA that must be completed by the lender. This document provides a look into the terms and conditions of the loan. Page 1 of the lender loan information includes property and loan information, title information, mortgage loan information. Page 2 of this document includes qualifying the borrower, minimum required funds or cash back. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO. Chapter 11, ECOA. The Equal Credit Opportunity Act, Regulation B. The Equal Credit Opportunity Act, ECOA, Regulation B, was enacted by Congress in 1974 to address the issue of discrimination in lending practices. While the act of extending credit is discriminatory by nature, since some consumers qualify, and others do not, the discrimination has not always been based on qualifications alone. In the past, specific minorities found it difficult to obtain mortgage financing due to discrimination based on factors such as race, creed, or color. ECOA was added to the Consumer Credit Protection Act, CCPA, as Title VII of the existing law to eliminate the discriminatory treatment of consumers who apply for loans. The purpose of ECOA is to promote the availability of consumer credit to all applicants by prohibiting credit decisions based on race, color, religion, national origin, gender, marital status, or age. The Act also prohibits credit decisions made based on an applicant's income being derived from any public assistance program or based on an applicant having exercised their rights under the CCPA. ECOA is overseen by the CFPB. ECOA simplified. Under the rules of ECOA, creditors cannot make a loan with unfavorable terms or deny credit to someone for any of the 9 prohibited factors or the property location. ECOA applies to the extension of credit by providers who regularly extend or renew credit. To help better determine if lenders are properly following ECOA guidelines, MLOs are required to request the applicant's race, ethnicity, gender, and marital status for government monitoring purposes. MLOs must also record this information on the URLA. ECOA recommends self-testing and self-correction as a voluntary program conducted to evaluate a creditor's compliance with ECOA. The benefit to the creditor to perform self-testing involves the creditor not having to disclose to any government agency the findings or admit a violation has occurred, if corrective action was taken. Corrective action happens when a creditor identifies the practices that led to a violation, assesses of the scope of violation, remedies it, and corrects it. ECOA's regulatory authority is the CFPB. General permissible acts under ECOA. The following actions are not considered a violation of ECOA: inquiries regarding race, ethnicity, gender, immigration/citizenship status, marital status, or age for federal monitoring programs in compliance with fair lending laws or to determine if the borrower is eligible for special programs. Inquiries relating to a borrower's marital status. If one of these reasons apply, the purpose is to include a spouse in the credit transaction. The credit transaction is in a community property state. The purpose of the inquiry is to learn if the borrower has a spouse whose signature must be obtained on the security agreement for the lender to be able to foreclose under the property laws of the state in which the security property is located. The borrower uses their receipt of alimony or child support as a basis for qualification and repayment inquiries about whether the borrower's income is derived from a public assistance program, for verifying the probable continuance of income when such income is being used to qualify for the mortgage loan. Inquiries regarding an elderly borrower's age, to qualify the borrower for a program that is in the borrower's favor, such as a reverse mortgage. The 9 prohibited factors. The lender may not discriminate based on 9 prohibited factors. These prohibited factors include: 1. Gender, 2. Race, 3. Color, 4. Religion, 5. National origin, 6. Marital status, 7. Age, 8. Whether any or all an applicant's income comes from any public assistances program, including Social Security. 9. Whether the applicant has, in good faith, exercised any right under the Consumer Credit Protection Act. Example: participation in credit counseling. Circumstances when it is acceptable to deny credit. It is acceptable to deny a loan or credit to an applicant if the applicant does not qualify based on qualifying criteria prescribed within the loan or credit program. These criteria may include: income loan to value ratios, credit history, collateral, age, in cases of reverse mortgages, or minimum age requirements to enter into a binding contract. ECOA in-depth. 3 common forms of discriminatory behavior. Overt evidence. Overt evidence of credit discrimination occurs when the behavior in question is obviously discriminatory. An example of overt evidence of discrimination would be a sign hanging in the front window of loan originator's office that said, "We don't write loans for women." Disparate treatment. Disparate treatment in terms of credit discrimination is demonstrated when a lender treats an applicant or borrower differently based on one or more of ECOA's prohibited factors. Disparate impact. Disparate impact differs from disparate treatment in that seemingly legal behavior on the part of the creditor has a negative effect on a group of people protected under the 9 prohibited factors of ECOA. Disparate impact typically needs broader scope to be revealed. An example of disparate impact might be when members of a community who are considered a minority are legally denied credit due to low qualifications, but as a result no one in the community can acquire financing. ECOA in-depth types of action. Whenever a specific decision is made in determining the applicant's credit application status, an action must be taken. When such action occurs, a disclosure called the Notice of Action Taken is required to be delivered to the applicant. Types of action include: credit is approved/counter offer made, application is incomplete, credit offer is unused/not accepted by the applicant, credit is denied. Adverse action characteristics: adverse action is defined under ECOA as a denial or revocation of credit or a change of terms of existing credit. Typically an applicant may be denied credit, and thus experience an adverse action, when one or more of the following characteristics do not meet the lender or program's qualifying standard: the consumer's creditworthiness, credit standing, credit capacity, character, general reputation, personal characteristics, mode of living. ECOA in-depth ECOA valuation rule: because property value and appraisal serve as a key factor in qualifying the borrower for credit, ECOA's valuation rule requires that a copy of the appraisal be provided to the borrower as soon as the MLO has finished processing the report. The borrower will be notified of this right through a disclosure called the Notice of Right to Receive an Appraisal. The borrower can waive their right to immediate delivery, but they will still receive it with their closing documents. Making the appraisal available is helpful for both the MLO and the borrower. One of the most significant challenges our industry faces is incorrect property value estimates by applicants. In many cases, borrowers believe their home to be of higher value than the amount provided by the appraisal. Giving the borrower access to the appraisal report provides documentation for the borrower, especially if their loan was denied or circumstances changed due to a lower value than expected. Under the ECOA valuation rule, the applicant can waive their right to promptly receive a copy of the written appraisal. The timing requirement for these copies may be waived by the consumer if they wish to receive any copy at or before closing, or account opening. The creditor must receive this waiver from the consumer at least 3 business days prior to closing or account opening. If the consumer does provide a waiver and the loan does not close, or the account is not opened, the creditor must provide these copies no later than 30 days after it is determined closing will not occur or the account will not be opened. ECOA and the application process: because the process of applying for a mortgage loan includes evaluation of the borrower, we must be careful to only make approval decisions based on non-discriminatory factors. This next section will focus on ECOA's impact on the application process. Factors considered when determining creditworthiness: while ECOA does provide all applicants with the same rights in seeking credit, that does not mean that everyone who applies will be approved for credit. As we know, the 4 Cs, credit, capacity, collateral and capital, can and ultimately will impact whether the borrower will be approved for credit. Types of acceptable income considered for a loan review: mortgage lenders will consider a vast array of income to support a loan application. The most important factor for all these sources is documentation and proof. Here are some of the most common forms of income used for qualification: salary or hourly income, sole proprietorship income, partnership income, S-corporation income, military income, investment income, social security income, non-taxable income, rental or property income, unemployment income. Information required on a loan application: if an applicant applies for credit and does not qualify, the creditor may allow a co-signer on the credit application. It is not necessary for the co-signer to be the applicant's spouse, but the co-signer must meet the qualification requirements for the loan to be approved. In addition to evaluating an applicant's creditworthiness, the MLO is obligated under the rules of ECOA to collect specific government monitoring data. MLOs are required to ask for and record information about the applicant's ethnicity, race, and sex. This information in the form of a voluntary questionnaire for the borrower is in Section 8 of the URLA. If the borrower chooses not to answer the questions, the law and instructions on the URLA specifically state they are not required to do so. The MLO is required to make determination through visual observation or surname. Disclosures required under ECOA Notice of Action Taken. As we stated previously, there are 4 different types of action that can be taken on a loan application. Under ECOA, the applicant must be notified by the creditor whenever an action is taken or a decision is made about their credit application status through disclosures. The applicant will be notified through a disclosure called the Notice of Action Taken. As a reminder, here are the 4 different types of action that can be taken. Credit is approved/counter offer made, within 30 days of application. Application is incomplete, 30 days after request for additional application information. Credit offer is unused/not accepted by the applicant, 90 days after offer/counter offer. Credit is denied, aka adverse action notice, within 30 days of application. In cases where multiple applicants are involved in the transaction, it is only necessary that the adverse action notice be given to the primary applicant when it is apparent that the applicant is such. If the borrowers have legal ties, like spouses living at the same address, the primary applicant is typically the one listed first on the URLA. The following information must be included on the Notice of Action Taken: written statement of the type of action taken, along with an explanation, or the applicant's right to an explanation, creditor information, ECOA's statement on discrimination and the CFPB's information, ECOA in-depth notice of right to receive an appraisal. The notice of right to receive an appraisal is due to the borrower at the time of application or within 3 business days if mailed. This disclosure could use some improvement in its title. It's actually a little misleading. As we described earlier in this chapter, under ECOA's valuation rule, the borrower is entitled to a copy of their appraisal once it has been processed by the MLO. Notice we didn't say everybody gets an appraisal. The rule and this disclosure actually say that the borrower will receive a copy of their appraisal report if one is performed on the property. So if the borrower doesn't qualify based on the initial application, no appraisal will be done and thus no copy of the appraisal will be available. As alternatives to an appraisal, other methods of property value determination could include online data analysis tools or a broker's price opinion, BPO. A BPO is a method of determining property value in which a real estate broker does a value analysis based on their knowledge of the home and comparables in the community. Whatever method is used, the borrower must be provided a copy if one is completed. ECOA penalties: civil penalties up to $5,000 per day with definitive patterns of discriminatory behaviors penalized up to $25,000. Punitive damages: ECOA individual violations as high as $10,000, class actions less than or equal to $500,000 or 1% of net worth, whichever is lower. Actions can be taken against a mortgage professional or institution within 5 years of the violation. ECOA record keeping: the following must be retained for a minimum of 25 months by the MLO: notices of action taken, incomplete application disclosures, monitoring program disclosures, complaints or other written statements from a consumer to want to try some MLO exam practice questions. Go to www.learnbyhearing.com/MLO. Chapter 12, Consumer Contact Laws, Fair Credit Reporting Act, FCRA, Regulation V. Consumer Contact Laws. The laws in this chapter: the Fair Credit Reporting Act, the Gramm-Leach-Bliley Act, the Do Not Call Laws, the E-Sign Act and Mortgage Acts and Practices, focus on how the MLO contacts and interacts with the borrower. Be sure to consider how these laws will impact your future career. Fair Credit Reporting Act, FCRA, Regulation V. Congress enacted the Fair Credit Reporting Act, FCRA, in an effort to ensure accurate and fair credit reporting by consumer reporting agencies. This act regulates consumer reporting agencies, CRAs. It regulates both those that provide and those that use consumer credit information. FCRA regulates how CRAs use and report a consumer's information and is overseen by the CFPB. Due to the growing concern of identity theft and the proper procedures needed to prevent it, the Fair and Accurate Credit Transactions Act, FACTA, amendments were incorporated into FCRA. These amendments require lenders to help protect against identity theft and to properly dispose of consumer information. Under FACTA, consumers can obtain a free credit report once a year from CRAs, such as Equifax, Experian, and TransUnion, and consumers must receive a credit score disclosure when their credit report is reviewed. The official site to request the free report is annualcreditreport.com. Simplifying FCRA and FACTA. FCRA requires CRAs to adopt reasonable procedures that ensure a consumer's information is handled confidentially and accurately in an equitable and fair way. The Act limits access to a consumer's information and requires that only parties with a permissible purpose receive a copy of the consumer's credit report from a CRA. Lenders and consumer reporting agencies must guarantee the accuracy of a consumer's credit report. The report and maintenance of accurate information is extremely important for the consumer. Inaccurate information can prevent an otherwise qualifying consumer from obtaining credit. FACTA added provisions to the law that include the following responsibilities for CRAs: all derogatory, negative, credit information must be reported on a consumer's credit report, for no longer than 7 years. Bankruptcies must be reported for no longer than 10 years. The consumer's credit score and a description of key factors that affect their credit score must be included in the report. Indication of an account closed or disputed by a consumer must be reported. For a disputed account, responses must be provided within 30 days to the consumer. Consumer Contact Laws Fair Credit Reporting Act, FCRA, Regulation V. The disposal rule: all persons under the jurisdiction of FACTA must take reasonable measures to protect against identity theft by disposing of the consumer's information. FACTA considers reasonable measures as burning, pulverizing, or shredding papers, and destroying or erasing electronic files or media containing consumer report information so that they cannot be read or reconstructed. Fraud alerts under FCRA and FACTA. The following are necessary measures to prevent identity theft. 1. Call fraud alert. CRAs must place a one-call fraud alert on a consumer's credit report if the consumer claims a suspicion that they are or will be a victim of identity theft. This fraud alert must be filed in the consumer's credit report for a period of not less than 12 months. Extended fraud alert. CRAs must place an extended fraud alert on a consumer's credit report if the consumer submits an identity theft report to the CRA. A fraud alert must be filed for at least 7 years. Active duty alert. CRAs must place an active duty alert on a consumer's credit report if the consumer, who is on active military duty, requests a notice of their status during their time away. This alert must be filed for at least 12 months. CRAs must display their contact information on a consumer report. CRAs must block the information of a consumer that requests such alerts listed above and do so within 4 business days of request so that no new credit extensions can be made during the period of the freeze. 5. As an MLO, you need to be familiar with the different types of fraud alerts because you will see them when you pull credit. You will be notified as soon as you try to access the credit information of someone with a fraud alert. Red flags rule. FCRA and FACTA require the development, implementation, and administration of identity theft prevention programs at CRAs. This framework, known as the Red Flags Rule, requires that an identity theft prevention program include 3 basic elements to address the threat of identity theft. 1. Identify relevant red flags by detecting patterns and practices that indicate possible identity theft. 2. Create reasonable guidelines to address a credit transaction occurring on an inactive account, inactive for more than 2 years, and provide notice to the consumer. 3. Verify guidelines and procedures established for proper implementation through internal controls, quality control, a compliance officer, and training programs. The Red Flags Rule is regulated by the Federal Trade Commission, FTC. Consumer Contact Laws. Disclosures required under FCRA/FACTA. Penalties under FCRA and FACTA. Action can be taken against a mortgage professional or institution for 2 years after the date of discovery of the FCRA or FACTA violation, and must be taken within 5 years of the violation. Obtaining information under false pretenses or misleading consumers in regards to disclosures can result in a fine and 2 years of imprisonment. The civil penalty for willful non-compliance of FCRA and FACTA is actual damages, punitive damages, and any attorney's fees. Disclosures required under FCRA/FACTA. Notice of right to receive credit score must be delivered to the consumer at time of completed application or within 3 business days if mailed. Informs the borrower of their right to obtain their credit score after making an inquiry for financing and how to request a copy of their credit report. Gramm-Leach-Bliley Act, GLBA. The Gramm-Leach-Bliley Act, GLBA, is also known as the Financial Services Modernization Act of 1999. The provisions of most interest to the MLO are the regulations that focus on the protection of a consumer's non-public personal information. Simplifying GLBA. GLBA is divided into many parts. The 2 key components that will impact your work as an MLO are the privacy protections found under Regulation P and the requirements for formal planning and protection in the FTC Safeguards Rule. The regulatory authority for the privacy and pretexting protections, Regulation P, found in GLBA is the CFPB. All other rules of the Act, such as the Safeguards Rule, are regulated by the Federal Trade Commission, FTC. The terms used to describe consumer and customer in financial service industries are formally defined in GLBA. These definitions help to determine how that individual's information is handled by institutions during the transaction process. Consumer, customer, an individual who obtains or has obtained a financial service or product that will be used primarily for personal, family, or household purposes. A consumer who has a continuing transactional relationship with a financial institution. Examples: applying for a loan, obtaining cash from a foreign ATM, an ATM that is not associated with your financial institution. Examples: obtaining a loan from a mortgage lender, opening a credit card account. Consumer Contact Laws. Gramm-Leach-Bliley Act, GLBA. Privacy, Regulation P. Regulation P, the first part of GLBA, requires financial institutions to exercise certain conduct with relation to a consumer's and customer's non-public information. Point 1. Examples of non-public information are your driver's license number, social security number, account numbers, and account balances, all information that is not made public. Below are the objectives and requirements of this regulation. Black small square financial institutions must follow certain principles when disclosing non-public information about consumers to non-affiliated third parties. Black small square consumers must have an opportunity to prevent a financial institution from disclosing their non-public information with most non-affiliated third parties. These protections are regulated and enforced by the CFPB and include privacy policy, opt-out, and pretexting rules. Pretexting/phishing. In order to further protect a customer's financial information, GLBA outlines certain protections against pretexting. Pretexting, otherwise known as phishing, is the act of obtaining an individual's non-public personal information through false pretenses, without authorization. Perhaps you didn't know what it was called when you received that mysterious email from the long-forgotten member of some faraway royal kingdom who wanted to hide his millions in your bank account, and all you had to do was provide your name, social security number, and bank account information. Now you know, it's called phishing. Privacy policy disclosures. Institutions must provide privacy notices in such a way that the consumer can expect to receive the actual notice in writing or electronically if so desired. The threshold for expectation of receiving the actual notice is met if the institution hand delivers a printed copy of the notice to the borrower, mails a printed copy to the borrower's most recent address. In cases of electronic transmission, the notice may be posted on an electronic site with the consumer required to acknowledge receipt. In isolated transactions such as usage of an ATM, it is acceptable to post the notice on the device's screen requiring the consumer to acknowledge receipt of the notice. For annual notices only, the reasonable expectation is met if the customer accesses a website or portal to conduct their business and agrees to receive the notice via that website. In circumstances where the customer requests that the institution not send the notices, it is acceptable that the institution's privacy policy remains available to the customer upon request. Consumer Contact Laws. Gramm-Leach-Bliley Act, GLBA. Initial privacy notice. Financial institutions must provide an initial privacy notice explaining what information the institution gathers, where this information is shared, and how the institution safeguards that information. This initial privacy notice must be given to a customer no later than when a customer relationship is established, and a consumer before the institution discloses any non-public personal information about the consumer to any non-affiliated third party, if applicable. If the institution does not provide this information to non-affiliated third parties, then the privacy notice is not required. Annual privacy notice throughout a customer relationship. Financial institutions must provide an annual privacy notice to their customers. The annual notice contains the same information as the initial privacy notice, as well as a notice of the right to opt out of information being shared, and an explanation of how to do so. Opting out financial institutions are required to disclose to a consumer that they have a reasonable opportunity to opt out of allowing information to be shared in both the initial privacy notice and the annual privacy notice. Opting out allows the consumer to prevent their non-public information from being shared with the institution's non-affiliated third parties. The opt-out notice should include an explanation of the kind of information that the institution may disclose, as well as reasonable means to opt out. This disclosure must be in writing or in electronic form, and must be provided to the consumer before their information is shared. There is no specific time frame associated with the opt-out period, just that it must be a reasonable period of time. FTC Safeguards Rule. The FTC, the second part of GLBA, issued the Safeguards Rule, which requires financial institutions to develop a written information security plan that describes how the company is prepared for, and plans to continue, protecting consumers' non-public personal information. It applies to the information of any consumers, past or present, of the financial institution's products or services. The Safeguards Rule forces financial institutions to take a closer look at how they manage private data and to do a risk analysis on their processes. Do not call laws. Consumer contact laws. Do not call laws. The significant advancements in technology and data collection allow many industries to use telemarketing as an effective tool to reach both current and potential customers. With the growth of telemarketing came consumer complaints related to unwanted calls. Due to consumer unhappiness, do not call regulations were created. Because of the significant use of telemarketing techniques within the mortgage industry, it is necessary to review these regulations. The do not call regulations put the consumer in control of which phone calls they receive. These regulations stemmed from several laws and eventually resulted in the Do Not Call Registry with different scopes. The Federal Communications Commission, FCC, and the Federal Trade Commission, FTC, regulate telemarketing rules established by these acts. The FCC is capable of overseeing interstate, national, and intrastate, in-state, calls. The FTC typically focuses its regulatory energies on interstate calls, which are calls made from one state, such as Wyoming, to another state, such as Maine. Persons regulated by do not call laws include any telemarketing company or individual that uses solicitation to gain business. Telephone Consumer Protection Act, TCPA. The Telephone Consumer Protection Act, TCPA, regulates the conduct of telephone solicitations and sets certain standards. Under this act, the Federal Communication Commission, FCC, requires that solicitors maintain a do not call list for those consumers who wish to avoid solicitation, and it limits telephone solicitation between the hours of 8 a.m. and 9 p.m. 1 Do Not Call Improvement Act. The Do Not Call Improvement Act was passed to amend the Do Not Call Implementation Act. Under this act, consumers who register their phone number with the Do Not Call registry will remain in the registry forever, instead of only 5 years, unless the number is invalid, disconnected, reassigned, or the consumer requests to be taken off. In addition, telemarketers must stop calling a phone number within 31 days of its registration into the Do Not Call registry and from calling cell phone numbers. Cell phone numbers are automatically entered into the Do Not Call registry. Telemarketing rules require that records from call activities be kept for a period of 24 months following the action. These records include Advertising materials such as brochures, call scripts, and promotional materials name and address of prize recipients who are awarded prizes or promotional gifts in excess of $25. Name and address of customers, the good or service purchased, and the amount paid. The name, or fictitious name, home address, and telephone number of the telemarketing solicitor. Any verified authorizations or informed consent provided by the consumer. 2. Fines for violation of the Do Not Call Act can be as high as $43,280 per violation. Consumer Contact Laws. E-Sign Act. E-Sign Act. Electronic Signatures in Global and National Commerce Act. Technological advances in the processing of contractual agreements such as mortgages led to the creation and implementation of the Electronic Signatures in Global and National Commerce Act, E-Sign Act, on October 1, 2000.1. The E-Sign Act is the general rule governing electronic records and signatures for commerce in the United States and those transactions in the global marketplace. The Act allows for the use of electronic records to satisfy any statute, regulation, or rule of law requiring that such information be in writing. The E-Sign Act also indicates that oral communications do not qualify as an electronic record. The regulatory authority for the E-Sign Act is dependent on the law governing the item being e-signed. For example, if the item being signed is the truth in lending disclosure, then the regulatory authority would be the CFPB, which has regulatory authority over the Truth in Lending Act, TILA. Current technology allows for the limited verification of identity for an electronic signer. The most widely spread practice for verification involves dual or multiple levels of authentication. Multiple verification usually involves a click-to-sign action coupled with additional non-public personal information the signer must provide and corroborate. Newer technologies are now being implemented that include adding biometric data such as fingerprints, actual signatures, voice recognition, and retina scans. It is likely that as technology improves and the need for more and more electronic signatures grow, that verification practices will continue to evolve. The E-Sign Act requires that, prior to making an agreement involving electronically delivered documents, a disclosure must be provided indicating that the consumer has the right to receive the signed agreement in paper form. A statement indicating whether the provided disclosure is specific only to the agreement that was e-signed or to a group of documents with which the e-signed agreement is associated. The steps needed for the consumer to withdraw their consent to the agreement. How the consumer can obtain a paper copy of the agreement regardless of whether or not they agreed to utilize the electronic method for agreement. Before agreeing to the use of electronic records, the consumer must be provided with a statement indicating the hardware and software needed to access and use the electronic record. Should the hardware or software requirements change, the E-Sign Act requires that the consumer must be notified of the change. Mortgage Acts and Practices, Advertising Map, Regulation and Consumer Contact Laws. Mortgage Acts and Practices, Advertising. Mortgage Acts and Practices. Advertising, Map, Regulation N, protects consumers from mortgage-related misrepresentations in advertising and is regulated by the CFPB. The activities that apply to this rule include any commercial communication by a mortgage professional. A commercial communication is defined as a statement, illustration, or depiction meant to generate interest in the purchase of goods or services. Commercial communications can be in or on any form of media, such as packages, magazines, radio, web pages, billboards, cellular networks, and letters. 2. Violations can be penalized by any Attorney General or other officer of a state, or by the CFPB. Copies of commercial communication must be retained for 2 years from the last date of the commercial communication. Documents about available mortgage loan programs must also be retained for 2 years. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO Chapter 13, Borrower Ethics and Fraud. Ethics and Money. Borrower Ethics and Fraud. In this chapter we'll review aspects of borrower ethics with a focus on human nature. We'll also discuss the murky issues involving the difference between telling an untruth or committing fraud, and give brief examples. Finally, we'll finish with a scenario that is all too common in the world of mortgage origination. Ethics and money. Even though this course is not a psychology or sociology class, we need to spend some time talking about human behavior. The way a borrower acts and conducts their business is directly connected to the way they think and understand the world around them. People are influenced in so many ways, by their family, friends, culture, and society in general, that it would be foolish for us to assume that the way we see something is the way that our borrower sees it. We spend a lot of time in this course talking about the law. Our clients, on the other hand, have their own lives and jobs to do. So it's very likely that they will not have the same level of understanding about mortgages, nor will they interpret their responsibilities and requirements the way we do. Because of this, we need to explore some basic aspects of human nature, especially when it comes to money. Human nature. Self-esteem is the trigger inside of us that wants to present ourselves in the best way possible. You may think that you perform your morning grooming for others, so that they can see you as your best possible self, but as famed philosopher David Hume pointed out, the real reason we behave in this manner is out of our own self-interest. We want to see ourselves in the best light. Hume's perception of self-interest is another way to describe self-esteem. What does this have to do with mortgage loans? A great deal, actually. As we discussed in the application unit, the origination process is tied directly to the information that the borrower provides. Remember, who's responsible for the information on the application? The borrower. The information they provide for the application is crucial to whether or not the loan will be approved or denied. Based on what we know about self-esteem, do you think it's possible that your client might bend the truth a little bit when answering your questions about their income and financial well-being? The answer is yes. The challenge here is whether the client is bending the truth willingly or simply because they don't know any better. As psychologist Robert Feldman found in a University of Massachusetts study, we're trying not so much to impress other people but to maintain a view of ourselves that is consistent with the way they would like us to be. As Feldman says, people lie reflexively. Essentially, we don't even recognize that it is a lie we're telling. Ultimately, we lie because our self-esteem requires us to project an image that fits with who we believe we are. As this relates to the borrower and the application process, consider how your client might answer a question related to their income, especially if the income fluctuates due to overtime, bonuses, or commissions. Will they provide a conservative number based on the average of their last few years of work, or are they more likely to tell you a more generous number formed through a forecast of what they expect to earn in the current year? Most people will provide the second option. Why? Our understanding of self-esteem tells us it's likely that they'll go with the higher number because that's who they think they are, as Feldman said, view of ourselves, especially because they know they'll need a certain level of income to qualify for the mortgage, the way they would like us to be. Oftentimes, they may not even realize they have exaggerated. In the end, human nature and self-esteem control how people behave. This behavior can impact the interaction between MLOs and borrowers. In the next section, we'll discuss how to interpret this behavior to ensure an ethical and successful loan origination process. Borrower ethics and fraud. Ethics and money. Does a lie equals fraud? In a simple sense, a lie is an act of fraud. The word lie is defined in Merriam-Webster's dictionary as making an untrue statement with intent to deceive. The same dictionary says fraud is an act of deceiving or misrepresenting. We don't know about you, but those definitions sound pretty similar. If the world we live in was black and white, i.e., there are only two choices, black or white, this or that, open or closed, determining whether a person was committing fraud would be pretty easy. If they lied, they would be committing fraud. It would be that simple. But it's not. Think back to the last section in which we described self-esteem and human nature. Self-esteem tells us that people lie with the intent to deceive, often not only because they want to make themselves feel better, but also because they believe that is how others expect them to be. So, is lying fraud? Well, maybe. Consider the following conversation you've probably had in the past. You're having lunch with your friend and your friend says, "What do you think of my new haircut?" You were really hoping they wouldn't ask. In fact, you've tried your best to avoid the topic all through the meal, but now you've got to answer. In your head you're thinking it looks like someone took a blender to your friend's head, and no matter how much gel, mousse, or other product they put in their hair, it will still look like a small furry animal died there. Oh, you got a haircut. You say. Wow, I'm sorry, I didn't even notice. In this interaction you've just lied. You intended to deceive your friend by not telling them the truth about their new look. Now compare that conversation to this: "I am not a crook," former President Richard Nixon said when he denied any involvement in the Watergate scandal. President Nixon told a lie as well. He deceived the American people and government officials for almost 2 years in an attempt to avoid losing his office. The difference between these lies is morality. Your lie to your friend would be considered moral because it did not harm them. Nixon's lie is considered immoral because it did cause harm. The writings on ethics by philosopher John Stuart Mill sum it up best in declaring that a lie is moral or immoral based on the consequences the lie produces. If we add Mill's take on morality to the question of whether or not a lie is fraud, we have a much better indicator. The lie you told your friend about their hair was moral because the consequence did not cause harm. In President Nixon's case, his lie was immoral because of the negative impact it had on our country. One last thing to add to our fraud equation is the question of active intent. Active intent is when someone is faced with the reality of their lie, chooses to continue forward with the lie. They willingly or knowingly act in a way that supports the lie. In our President Nixon example, once the president was confronted by the Congress to turn over evidence from the White House, audio-taped conversations between the president and his aides were erased. The president's desire to destroy evidence shows active intent. Borrower ethics and fraud ethics and money. The formula for fraud. While there is no legal basis to formula we're about to discuss, MLOs can use it to help determine if their client is attempting to deceive. The formula consists of 3 components. 1 is the information factually correct? At the beginning point of the discussion with the borrower, the MLO should set the proper expectations for honesty and truthfulness in the process. Being honest and providing correct information will provide for the best loan process experience for the borrower. Did the borrower provide true information on their application? 2. Are there consequences to the mortgage loan? Once the borrower has provided their basic information, but before the MLO completes the initial application process, it might be a good time for the MLO to review the impact false information can have on the loan. Negative impacts to the borrower include a suspended or denied application, or the lender could provide a loan that is improperly qualified. 3. Is there intent? This is a chance for the borrower to reconsider the information they've provided to the MLO. At this step, the MLO may be requesting documents for verification, and the borrower will have to determine if they gave proper information initially, or if they need to change some of the things they told the MLO. If the borrower insists on submitting false information, their actions should be considered fraud. By using this test and the steps provided above, the MLO can take an ethical approach to their interaction with the borrower, and be certain that they've taken the extra steps necessary to ensure they've done the right thing. So let's add it up. If we take a lie, add the question of morality, and then consider active intent, we have a pretty good system for determining fraud. Suspicious activity. To protect the lender and ensure they are meeting the ethical requirements, mortgage loan originators should be on the lookout for suspicious activity on the part of the borrower. Suspicious activity includes a borrower with multiple properties and mailing addresses, unusual or unverifiable income sources, lack of necessary documentation, untraceable funds. Keep in mind, just because someone demonstrates one or more of these behaviors doesn't mean that they're committing fraud, but they should trigger a higher level of scrutiny on the MLO's part. If you encounter circumstances such as these, ask more questions to better determine the reasons behind the activities. This is another opportunity for you, as an MLO, to provide quality service to your client by digging deep and ensuring the best possible experience and loan available. If after further examination you still believe that your borrower is committing fraud, You are obligated to report this behavior to the proper authorities at the state or federal level. If there is anything you should take away from this discussion about borrower fraud, it is how important your role as a mortgage loan originator is in helping to stop fraud before it happens. The MLO's interaction with the borrower, such as asking proper questions and providing quality counsel and education, will lead many borrowers away from mistakes that could be very costly for them. We'll say it one last time, the penalty for mortgage fraud includes up to a $1 million fine or 30 years in prison or both. Impact of borrower fraud. Typically when a borrower commits mortgage fraud, they do so with the desire of benefiting from the property gained or the improved circumstance of the new loan. While on its face this seems innocent because the borrower commits the fraud without intending to harm anyone, the impact of their fraud can have far-reaching victims. If the borrower is unable to repay the loan due to lack of income, the owner, lender or investor of the loan may be harmed. If the borrower is unable to handle the expense of maintaining their property due to the overwhelming cost of repaying the loan, the appearance of the home may negatively impact the value of surrounding properties. Additionally, if the borrower defaults on the mortgage, the scar of foreclosure and vacant property can also hurt nearby property values. In situations in which widespread foreclosure occurs, an entire community can be devastated. All of these are examples of unintentional impacts caused by a borrower's seemingly innocent yet fraudulent actions. Types of borrower fraud. State and federal regulation and requirements for mortgage law have increased the amount of information lenders must review before approving a potential borrower's mortgage loan application. With the increased vigilance in ensuring that a borrower is truly qualified for the mortgage they receive, lenders are becoming more reliant upon the borrower's income as a key factor for mortgage approval. Alas, this increased focus on income has created renewed activity related to actions by borrowers to fabricate inflated earnings that will ensure they meet the lender's requirements. Borrower ethics and fraud. While modern technology allows many lenders to process mortgage loan applications faster, it has also made forgery easier for the most novice culprit. Unethical borrowers intent on providing fraudulent income information to lenders can do so today with the ease of a few keystrokes on a computer. Software that allows for document modification through cutting and pasting or other graphic manipulation is readily available in the consumer market. Because of this, mortgage loan originators and ultimately the lender's underwriter must be extremely attentive when reviewing the documentation provided by the borrower for review. Documents that cannot be clearly read or with information, dates, addresses, amounts, etc., that doesn't match up with reported information are red flag indicators that fraud is being perpetrated. Fraudulent actors, in an effort to satisfy a loan's income requirements, often submit falsified W-2s, pay stubs, bank statements and even tax return forms such as the 1040. Because this practice is so prevalent, most lenders will combat this by contacting a borrower's employer to verify income. Lenders will also use a Form 8821 or 4506C to request a tax transcript of prior tax returns from the IRS so that they can verify the information the borrower provided for review is correct. Someone committed to acting unethically is likely to do so regardless of the counsel they receive from the mortgage loan originator. However, in cases where a potential borrower is unaware of the ramifications of their actions, the mortgage loan originator has the responsibility of educating the borrower as to the necessity for behaving in an ethical manner. Communicating to the borrower the downsides associated with submitting fraudulent income information can help prevent fraud before it begins. Asset fraud. Asset fraud on the part of the borrower simply involves the borrower providing false information about their assets. Things like artificially increasing their account balances or creating fictitious accounts to make their qualifications better. As the technology and pace for MLOs improves to verify and confirm borrower assets, so do a fraudulent actor's ability to manipulate the system. Moving monies from account to account or using borrower funds to temporarily inflate account balances are just a few of the ways this fraud can be perpetrated. Income fraud. Income fraud involves the borrower falsifying income information to provide a better qualification profile. Income fraud can occur through verbal or conspiratorial means as well as through document modification. A recent increase in income fraud has been through conspiracy methods in which a fraudulent borrower will conspire with a friend who will claim the borrower works for them in a part-time contractual capacity. The friend may provide a loan to the borrower through repeated payments that seem to be income when initially reviewed. Once the loan closes, the borrower will return the loaned payments to the friend. This is income fraud because the contract income was actually a loan. Bank fraud. Bank fraud is a form of borrower fraud similar to asset fraud. Bank fraud relies on the fraudulent borrower's manipulation of accounts through money transfers and short-term loans. An example of bank fraud is something known as check kiting. This happens when the fraudster will write a check from one account to another without the funds to cover the amount written on the check. At the time the check is deposited in the borrower's account, it appears that they have the money. If reviewed at the right moment, the borrower could use the account balance to support their application qualifications. This is fraud because the borrower is demonstrating a balance on paper that doesn't actually exist. Bank fraud scenarios such as this require a high level of sophistication on the part of the borrower and fairly limited underwriting standards on the part of the lender. Borrower ethics and fraud. Borrower fraud. Occupancy fraud. There are three different ways a borrower can occupy a property. Primary residence. The borrower lives in the property for more than 6 months out of the year. The borrower's primary residence is most likely the address on their IDs, and where they get their mail. Secondary/vacation home. The borrower lives in the property less than 6 months out of the year. This property must be a reasonable distance from their primary home. Investment home. The borrower does not live in the property, and intends for someone else to live there. Typically a family member/friend lives here, or the property is rented out. Occupancy fraud occurs when the borrower applies for a mortgage claiming a less risky occupancy type than they actually intend to use the home for. As we already know, the riskier the loan, the higher the qualification standards and costs. So a borrower might claim that the mortgage they seek is for their primary residence rather than an investment property, even though they intend to use the home as a rental unit. The borrower may do this because they know that they may need at least a 25% down payment for an investment property, and the interest rate is likely to be substantially higher than for a primary residence. Certainly, the borrower's knowledge and intent demonstrate this as fraud. Occupancy fraud is one of the most prevalent forms of borrower fraud occurring today. In some cases, the fault lies as much with the mortgage loan originator as with the borrower. Consider this. What if the MLO did not do a very good job of explaining the differences between occupancy types, primary, second home, or investment property, and the borrower simply assumed there was no difference? The borrower could receive a loan based on primary occupancy qualifying standards. While this example is an incorrect qualification of occupancy, I think we can all agree that the borrower is not responsible in this example for fraud. Fraud methods. Verbal fraud. Borrower ethics and fraud. Fraud methods. Fraud through verbal actions can be tricky to determine. A verbal action could be something as simple as talking to a client as we assist them in filling out the URLA. As we've already covered, it's quite possible for the client to lie to you, but not with actual fraudulent intent. This is even more difficult to determine if the fraud is occurring through verbal means. For instance, if the borrower is providing information on the phone to their mortgage loan originator, and tells the MLO an incorrect level of income, it's hard to determine if that's fraud. If we apply our truth/lie and morality and intent formula to this case, here's how it might play out in a phone call. MLO, you said that you're paid hourly and you make $20 per hour. You work full-time, so your income is $800 per week. Borrower, I usually work some overtime so it's more like $900 per week. MLO, great. Is that $900 regularly or does it fluctuate? Borrower, oh, it's definitely at least $900. Here's where the benefit of how the fraud formula can help. We assume that the borrower is telling us the truth, but at the same time we want to give them counsel on providing accurate information. MLO, how we qualify your income is important. So one of the things we ask borrowers to do once we get the loan into process is provide documents like pay stubs and W-2s to help us verify your income. Because you receive overtime that fluctuates, we may want to take an average over the last 2 years so that we've got a clear picture and ensure that you're receiving credit for everything you've earned. If you've got those documents handy, we can review them. Remember, we assume our borrower is being truthful. However, that last piece from the MLO helps the borrower know what to expect next in the process, and also gives the borrower the opportunity to reconsider if they're stretching the truth. If the borrower is lying and knows that they're lying and decides to continue the lie by saying, "I'm looking at my W-2 from the last 2 years and it shows $46,800 for last year and $49,000 for the year before," this is verbal fraud. Conspiracy fraud. A conspiracy is when more than one person works together to commit an act. A conspiracy to commit mortgage fraud on the part of a borrower is when the borrower is working with others who commit fraud. An example could be a borrower providing their conspirator's name and phone number as their place of employment. When the MLO, processor, or underwriter calls the phone number to confirm the borrower's employment information, the conspirator provides false information to the caller. Modified documentation. Today's technology makes it very easy for a fraudulent actor to commit fraud through document modification. Using a computer scanner and some simple software, a borrower could change pay stubs, W-2s, tax returns or other documents to support a fraudulent claim, or maybe they could just forge a doctor's note, see below. Borrower ethics and fraud. Borrower fraud. Examples of borrower fraud. Property flipping. Borrower ethics and fraud. Examples of borrower fraud. Property flipping means buying a house, and then selling it in a short period of time at a higher price, creating a profit for the seller. Property flipping, when bona fide work is performed to warrant the increased sales price, is completely legal and ethical. Property flipping in cases in which a home is purchased at a price lower than market value, such as a foreclosure auction, and then resold at market price is also legal. When false representation of improvement and property value occur, property flipping becomes fraudulent. This fraud scheme typically involves an appraiser who inflates the value of the home, a seller and even buyers in a cash-out property flip purchase. In a cash-out property flip, the buyer may approach the seller and make a considerably higher offer than the asking price. As a condition of this offer, the buyer may ask for part of the difference between the offered price and asking price back in cash after closing. Regardless of the type of property flipping, some red flags include appraisals that lack sufficient information to back the value given, the property being sold at a higher value than the market area, or the seller claiming significant renovations without proof. Straw buyer. Another way an unqualified buyer may attempt to obtain a mortgage loan is by employing a straw buyer. As it relates to mortgage loan qualification, the real buyer will use the straw buyer's name and qualifying information on the mortgage application to mask the actual buyer's intent to purchase the property. The straw buyer is often paid for their participation, but may also do so voluntarily. For example, family members may voluntarily agree to purchase a home with the intention of transferring ownership to another family member after closing. Although it may be done with good intentions, this seemingly innocent act is considered mortgage fraud. As the first point of contact with the borrower, the mortgage loan originator must be diligent to ensure that a straw buyer is not being used for qualification. Some common red flags indicating a potential straw buyer scheme include the use of funds from more than one entity for the down payment or to pay fees, exercising a power of attorney when closing the loan, possible signs that the buyer will not occupy the residence, such as an unrealistic commute, or a big downgrade in value or size from the buyer's previous home. Buy and bail. One qualification fraud scheme that is becoming more prevalent is a direct result of the recent mortgage meltdown and foreclosure crisis. The buy and bail scheme involves a borrower buying a new home and then immediately bailing, or going into foreclosure, on their old home. During the recent financial crisis, many homeowners found that their home was no longer worth the balance of their current mortgage debt, or because of loss of income were unable to pay the mortgage. Faced with these challenges, some homeowners took advantage of the situation and used foreclosure as a way to cancel the mortgage debt. To accomplish this, the borrower would make every effort to keep their qualification factors, the 4 Cs, cash, credit, capacity, and collateral, current and in good standing until they were able to qualify and purchase a new home. To supplement their qualifying information, the borrower will often create fraudulent documents such as rental agreements showing that they intend to rent their current mortgaged residence to offset the cost of the new home, or fake income documents as were discussed in the previous section. Borrower ethics and fraud. Examples of borrower fraud: once the mortgage is approved and the purchase of the new home closes, the borrower vacates the old home and occupies the new home. At the same time, the borrower allows the old home to be foreclosed upon and may no longer be liable for the debt on the previous property. This is a simplistic explanation for the purpose of example because liability is dependent upon the mortgage contract and the legal jurisdiction. The mortgage loan originator can help prevent the occurrence of buy and bail schemes by looking out for the following red flags: the buyer's new home being significantly lower in value than their current home, rental agreements without deposits, or current loan terms that may increase the chance of foreclosure. Seller-buyer collusion. One of the most frequent instances of buyers and sellers working together to defraud the mortgage lender can be found in undisclosed kickbacks. While there is nothing unethical or fraudulent in the buyer and seller working together to accomplish the most favorable transaction for both parties, it is necessary for their activities to be open and transparent for all of the parties involved, including the lender. Undisclosed kickback. When selling a home, the seller is allowed to offer seller concessions to the buyer to help with any repairs needed for the home, on some USDA programs, or to help pay for closing costs. Each program has a maximum amount of allowable seller concessions, and these concessions can go towards closing costs and prepaid escrow deposits, but never towards the down payment. For example, in an FHA loan, no matter how much the buyer receives in seller concessions, they must bring the 3.5% down payment to the closing table. If the buyer doesn't have the money for a down payment, they may resort to accepting undisclosed kickbacks. An undisclosed kickback is a financial incentive that a seller gives a buyer at closing without informing the lender, to help qualify for an otherwise unobtainable mortgage. This could involve agreeing to a higher than originally set purchase price, so the seller is repaid from the borrowed money, or it might involve the buyer paying the seller after closing using their own funds. Regardless, it involves misrepresentation on the application and is considered mortgage fraud. To thwart the impact of undisclosed kickbacks, the lender should be aware of some red flags, including a different sales price in the closing disclosure and sales contract, family members or business relations on both sides of the transaction, funds paid to undisclosed third parties on the closing disclosure, and alteration of the sales price to fit the appraised value. Silent second mortgage. A fraud element that may be used by an unethical buyer and seller to subvert a loan's down payment requirement involves a silent second mortgage on the property. While second liens are perfectly legal, they become fraudulent when the second lien is not disclosed to a lender participating in the property's financing. A seller's silent second involves the seller giving the buyer a loan for the down payment, and then immediately after closing the seller records a second lien on the property ensuring repayment, without informing the lender. Lenders can avoid the problems of silent second mortgages by looking out for red flags such as boilerplate sales contracts that have very limited details, because the seller and buyer have a separate seller's contract containing the majority of the details including verbiage for the silent second. Borrower ethics and fraud. Examples of borrower fraud: short sale fraud. As a result of the recent financial crisis and mortgage meltdown, many homeowners found themselves in the difficult position of owing more on their home than the home was worth. This situation, known as being underwater, coupled with other financial pressures, caused some homeowners to reevaluate their responsibilities as mortgagors and seek a way to get out from under with their current mortgage debt. To accomplish this, many used the short sale process to meet their needs. Typically, in a short sale, a homeowner will need to demonstrate to their lender that they've exhausted every option to sell their home for a price at or above the current mortgage balance, and now have a potential buyer willing to purchase the home at an amount less than the balance. If the lender agrees to accept the lesser amount from the buyer, a short sale transaction can occur. The result of the sale is that the previous owner may be released from their mortgage obligation and the buyer receives a clean title on the property. Short sales reached an epidemic level in late 2010. Consider for a moment that by the end of 2012 38% of all home sales in Wayne County, Michigan were short sales. With the prevalence of short sales occurring, it was only natural that less than ethical individuals would find a way to game the system and profit from fraudulent activity. It was estimated in 2011 that short sale fraud cost the mortgage industry over $375 million, an increase of over 20% from 2010. The following sections on flopping and non-arm's length sales should provide some clarity to short sale fraud. We'll also provide some potential red flags that lenders can be aware of to protect themselves from fraudulent schemes. Flopping. One of the more recent forms of mortgage fraud, flopping, is a symptom of the significant rise in short sales. A typical flopping scheme works as follows: the home's current owner convinces their lender that they are unable to sell their home for an amount that will allow the homeowner to pay off their existing mortgage balance. The homeowner will request that the lender consider a short sale. The homeowner then works to ensure that no quality bids are made on the property. This may be accomplished by making the property appear undesirable to potential buyers by enhancing cosmetic problems, smells, flaking paint, false water damage, that can be easily remedied. An accomplice working with the owner approaches the lender with an extremely low bid on the property. Based on analysis and limited investigative resources, the lender accepts the low bid and releases its lien on the property so that the seller can transfer clean title to the accomplice. The accomplice then resells the home at a much higher price than was paid and splits the profit with the original owner. Flopping schemes work best when a lender is overwhelmed by the volume of troubled mortgages on their books and does not have the time or money to do thorough research on properties and homeowners looking to short sell. It is estimated that in 2011 the average profit gained by fraudsters through flopping was $55,000 per short sale. Non-arm's length sale. Another scheme currently en vogue related to short sales is the non-arm's length sale. The basis of the non-arm's length sale is based on the willing desire of individuals to perpetrate fraud so that they can live in their home at a reduced cost and is a variant of a straw buyer scenario. Here's how the scheme works. The current homeowner works with an accomplice, typically a relative or someone in a business relationship with them. The accomplice makes a short sale purchase of the home and receives a new smaller mortgage on the property. The accomplice then deeds the title back to the original owner so that they may remain in the home and service the mortgage at a much reduced cost. To avoid this, most lenders will require that the borrower sign an arm's length affidavit. This affidavit requires the borrower to promise that they will not sell their home to someone with whom they have an existing relationship. A real-world example of a non-arm's length sale occurred in 2013 in California when a borrower and her realtor committed short sale fraud. Augustine Simon was underwater on her home, and along with her realtor Minerva Sanchez, plotted to sell the property to Sanchez's son via a short sale. The plot was to then have him deed the title right back to Simon. Simon provided him with $355,000 to purchase the home. In addition to Sanchez receiving her normal commission as the listing real estate agent, she also received 75% of the commission paid to her son's real estate agent. As a result, Simon's bank, Tri-Counties Bank, lost $247,000, and Freddie Mac lost $107,348. Industry fraud. Appraisal fraud. The act of fraud is not exclusive to the borrower. In fact, the largest fraudulent mortgage schemes are those involving industry professionals. The inside knowledge possessed by mortgage professionals is what allows their schemes to succeed and escalate. In this section we'll summarize some of the more prevalent industry fraud schemes perpetrated by industry professionals. Keep in mind as you read through this chapter that the descriptions contained here are simplified for clarity and that most fraud schemes are more complex and typically coupled with other illegal actions. Appraisal fraud. This is a major contributor to unethical lending practices in the mortgage industry. In the past, mortgage professionals would work with appraisers and influence their determination of a property's value. This often resulted in inflated appraisal values, and ultimately more money lent than the home's true value. Real estate agents and consumers were also known to work with appraisers to get a higher value. These higher valuations allow scheme participants to profit illegally and also create a risk to the lender because the true collateral does not support the loan amount. Builder bailout. A builder bailout occurs when a builder wants to quickly sell units in a subdivision, tract, complex, or condominium and uses fraudulent schemes to sell the remaining properties. The seller, the builder, may give hidden down payment assistance or seller concessions to sell the property and leave a financial institution with an LTV greater than 100%. Builders rely on consistent credit and cash flow to maintain operation. In economically or financially stressful conditions, a builder may have a strong sense of urgency to sell remaining properties to cover financial obligations. Industry fraud. Predatory lending. Earlier in the course we discussed the Dodd-Frank Act and the rules created around UDAAPs, unfair, deceptive or abusive acts or practices. The UDAAP rules were created as a direct reaction to fraudulent behavior on the behalf of industry members in the form of predatory lending. Predatory lending occurs when mortgage professionals take advantage of their knowledge and position to convince unprepared or unsophisticated borrowers into getting loans that may be harmful for the borrower. The basis of the phrase can be found in the word prey, which means to hunt. In the case of predatory lending, the mortgage professional preys on borrowers to make an illegal profit. Typically in cases of predatory lending, loan originators and lenders are the industry players involved. Predatory lending harms many, including lenders and investors, as well as borrowers and the communities in which they live. Chunking. This type of fraud is also known as Ponzi scheme and investment club. In a chunking scheme, a third party convinces a borrower to invest in a property, or multiple properties, with the third party acting as the borrower's agent. Without the borrower's consent, the third party submits loan applications on the borrower's behalf to multiple financial institutions for various properties. The applications are submitted as owner-occupied or as investment properties with all falsified documents. Once the loan is disbursed, the third party keeps the loan proceeds and leaves the borrower with multiple loans and financial institutions with major financial losses. This elaborate scheme is a multi-person collaboration. It usually requires the assistance of an appraiser, broker, and title company to make sure the third party, acting as the borrower's agent, will not have to bring money to the closings. Steering. Just like with predatory lending, steering often falls under the UDAAP regulations because it occurs when mortgage professionals use their knowledge and position to take advantage of borrowers. The MLO's understanding of products, programs, and pricing allows them to direct borrowers into loans that are more advantageous to the mortgage professional rather than the borrower. Examples of steering include directing consumers to products that compensate the MLO better than other products or not making the borrower aware of the risks associated with the loan. Obviously, the one who stands to lose the most in cases of steering is the borrower. Industry ethics. The impact of mortgage fraud. 10 years later, if you've reached this point in the course and you think mortgage fraud and its impact on our communities is not that big of a deal, you may want to think again. Read the following story from the Cleveland Plain Dealer and Cleveland.com, about the impact of mortgage fraud on Northeast Ohio, and then answer the questions at the end of the story. Be prepared to discuss your thoughts in class. The impact of mortgage fraud, 10 years later, one by Eric Heisig, Cleveland.com. Cleveland, Ohio. A decade after the foreclosure crisis wreaked havoc on Cleveland and the rest of the country, the area's real estate market is doing better but has not fully recovered from years of mismanagement and rampant fraud. Lenders lost millions of dollars and many went out of business in the wake of the subprime mortgage crisis that began in 2007. Those who purchased homes were left with mortgages they could not pay, leading to foreclosure. As the problem got worse, investigations undertaken by a mortgage fraud task force led to hundreds of indictments against real estate agents, appraisers, brokers, and homeowners. While the actions of these people are not the sole reason for the housing market's collapse here, Prosecutors noted that they exacerbated an already dire situation. On the 10-year anniversary, Cleveland.com is looking back at some of the major figures who did their part to contribute to Northeast Ohio's foreclosure crisis. Many have been released, others remain in prison. Please note that this list is not exhaustive. There were many other defendants convicted in these cases. This is just a snapshot of those who either led schemes or resulted in the largest losses. Yuri Goffman, a Beechwood businessman, had family, friends, and others invest in his real estate company, Real Asset Fund. He bought more than 450 homes, nearly all on Cleveland's east side or in the eastern suburbs, and falsely claimed workers completed improvements, or he inflated the value of improvements to refinance and sell the homes to unqualified buyers, prosecutors said. With help from real estate broker Tony Viola and other mortgage brokers and title companies, Goffman defrauded lenders using fraudulent down payments and loan applications and distributions involving $44 million in loans. A federal jury found Goffman guilty of multiple mortgage fraud-related counts, but were deadlocked on others. He later pleaded guilty to 23 other charges and was sentenced in January 2012 to 8.5 years in prison. He was also charged, and pleaded guilty, to charges in Cuyahoga County Common Pleas Court. Industry Ethics by Eric Heisig, Cleveland.com. Tony Viola. Next to Goffman, prosecutors said Viola was one of the masterminds whose actions largely contributed to the mortgage crisis in Cleveland. Federal prosecutors said Viola took part in a scheme to provide false information on mortgage applications, obtain loans for fake sales between he, Goffman and other participants, and kept the money while allowing banks to foreclose on most of the homes. The scheme involved more than 450 homes and $44 million in loans. This mortgage fraud scheme had an immense impact on this community, Assistant U.S. Attorney Mark Bennett said during Viola's sentencing in 2012. Viola, 51, is serving a 12-1/2-year sentence at a prison camp in McKean, Pennsylvania. A county jury acquitted him of similar state charges. Viola represented himself at the state trial. Despite multiple rejections, he continues to challenge his case, and he and his supporters frequently write to Cleveland.com to profess his innocence. Anthony Jordan, of Pepper Pike, worked to buy a home in South Russell in 2007 through a land trust agreement for $710,000. He then resold it the same day for $2 million to another man based on a fraudulent appraisal, federal prosecutors said. Others. Jordan worked with, completed and submitted a fraudulent loan application, and defrauded Washington Mutual Bank by having the company issue a mortgage loan worth more than $1.5 million. Jordan pleaded guilty to conspiracy to commit bank fraud and money laundering, bank fraud, and multiple counts of money laundering. U.S. District Judge Donald Nugent sentenced Jordan, 45, in 2012 to more than 8 years in federal prison. He was released in May 2016. Levon Ruderson appraised properties beyond their real market value. This is appraisal fraud. It allowed Wilson and straw buyers to get the extra money from the loans for their own use. Ruderson appraised several homes on Cleveland's east side for $80,000 to $95,000, though the homes were worth half that amount. The scheme involved 28 properties, and loan companies lost nearly $2 million. A federal judge sentenced Ruderson, 47, to more than 5 years in prison after a jury found her guilty. She is set to be released next year. Industry Ethics by Eric Heisig, Cleveland.com. Susan Alt, 64, of Thousands Oaks, California, acquired about $3 million in a mortgage fraud scheme involving 7 homes in Chagrin Falls, Gates Mills, Toledo and Port Clinton. She pleaded guilty to 31 state charges in 2010. Prosecutors said Alt masterminded the scheme, along with real estate agents, title agents, mortgage brokers, an appraiser, and straw buyers. It involved fraudulent mortgage applications and upscale homes. Alt put much of the money she earned from the scam into fine dining and hotels. Common Pleas Judge Eileen Gallagher sentenced Alt in 2010 to 9 years in prison. Judge Nancy Margaret Russo, who heads the county's re-entry court, freed Alt in 2016 after Alt was recommended for the program. Alt completed the program in February. Stephen Holman, who was employed as a mortgage loan officer for the now-defunct Buckeye Lending, worked with his brother Timothy Holman and others in a scheme that involved 7 properties in Solon. Prosecutors said Stephen Holman and his brother persuaded straw buyers to allow properties to be put in their name by promising they could purchase the properties with no money down and would receive cash back at closing, according to a federal indictment. Both state and federal prosecutors brought similar charges. A county jury found him guilty of several fraud-related counts, and he pleaded guilty to federal charges. County Common Pleas Judge Nancy Margaret Russo sentenced Stephen Holman in 2009 to 12 years in prison. She freed him from state custody in December, but the 46-year-old is now serving a 41-month federal prison sentence imposed by a judge in a corresponding federal case. Postscript: the laws and actions we discuss in the course become all the more real after reading this story. The long-term impact of the fraudulent actions of these individuals, as well as numerous others not featured here, continues to haunt Northeast Ohio as home values still struggle to reach the level of national averages. Some borrowers are only realizing today that they may have participated in one of these individual schemes and must now deal with the burden of overvalued and wrongly titled properties. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO Chapter 14, Insurances. Mortgage insurance, funding fees, and guarantees. Insurances. Most people think they have a basic understanding of insurance. In a basic sense, insurance provides protection against loss. Our friends at dictionary.com say insurance is coverage by contract in which one party agrees to indemnify or reimburse another for loss that occurs under the terms of the contract. We would like to use dictionary.com's version as an introduction to this chapter because if we break it down, the pieces of the definition will help us focus on the upcoming discussion. Coverage by contract. Insurance in our business requires an agreement between at least 2 parties. Because a loan is involved, we will often have 3 parties involved: the homeowner, borrower, the lender, and the insurer. Indemnify or reimburse. Insurance isn't some kind of magic shield that deflects danger and stops damage. Instead, it provides money or some other kind of support to fix whatever might be damaged if danger occurs. Under the terms of the contract, insurance only protects the parties against a specific danger or issue. For instance, your car insurance doesn't cover the costs when you visit your doctor to be treated for an illness. It's important that we understand dictionary.com's definition because in this chapter we'll discuss the categories of insurance. Heads up, there are 3, mortgage, hazard, and title, you'll encounter in your role as a mortgage loan originator. Each category protects the insured parties from different kinds of trouble that can occur for borrowers and lenders once the loan is closed and payments begin. As you read this chapter, be sure to distinguish what type of insurance is needed and by whom, and why the insurance is necessary. Mortgage insurance, funding fees, and guarantees. The first category of insurance we'll cover is mortgage insurance. Mortgage insurance is a form of protection for the lender in case the borrower defaults, doesn't pay their mortgage debt obligation. This insurance is not used to cover the borrower in terms of their monthly payment. Mortgage insurance is used as a last recourse after a non-paying borrower is foreclosed upon and the lender sells the home to obtain the principal balance owed on the home by the borrower. The purpose of mortgage insurance is to fill the gap between what the foreclosed upon property sells for, and what the lender is owed. If the home sells for enough money to cover the debt, the lender will not require compensation from the insurance. If the home sells for less than what is owed, the insurance should cover the difference. Insurances. Mortgage insurance, funding fees, and guarantees. The reason mortgage insurance is so important to our industry is that it provides certainty to the lender that even if the borrower defaults on the loan, the lender is protected against loss. This certainty allows the lender to be more willing to make loans, which means more opportunity for borrowers to get the loans. Depending on the type of loan product we're discussing, mortgage insurance may have different names. Providers of those loans are very touchy about calling something insurance when they refer to it as a fee or guarantee. So be careful. It's important to use the name that's associated with the program or product, even though, as we'll explain, they're all just forms of mortgage insurance. One last thing, the borrower is responsible for paying the mortgage insurance. Depending on the program, the payment may be required at the beginning of the loan, as part of the borrower's monthly payment, or a combination of both. Insurances: mortgage insurance, funding fees, and guarantees. Conventional mortgages, private mortgage insurance, PMI. In general, both conforming and non-conforming conventional mortgage loans require mortgage insurance if the borrower has an LTV ratio higher than 80%, equity 20%. So if the borrower has a $100,000 loan amount and their current equity position is less than $20,000, they are typically required to carry mortgage insurance on the loan. The type of mortgage insurance used for conventional mortgages is called private mortgage insurance, PMI. Remember, conventional mortgages in their most basic sense are considered private mortgages because they're not government loans. You can use this as the key to link conventional mortgages to private mortgage insurance. Just to reiterate what we covered in the introduction to this chapter, each mortgage program uses different terms to describe how they insure their loans. Conventional mortgages call it PMI. The amount of PMI required to be paid on the loan each month is tied directly to the loan's risk profile. This is why PMI is only required on conventional loans with LTV higher than 80%. Once the borrower achieves a 20% equity position in the home, they're considered to be pretty well vested, committed to the property, and unlikely to default on their debt obligation. Those houses that are defaulted on at lower than 80% original LTV are also less likely to have lost more than 20% of their original value. This is why many home buyers strive to make a 20% down payment when they buy a home. A down payment of 20% or more on a conventional mortgage allows them to avoid the expense of PMI. PMI can be paid in a variety of ways. It can be paid monthly in conjunction with the borrower's PITI payment, at closing in lump sum form, or sometimes by the lender, LPMI, lender paid PMI. Because monthly PMI payments are the most common, we'll focus our discussion on that method. In most circumstances, the amount of PMI required on the loan will be set at the time of closing based on the LTV. This setting of the PMI amount is called casting. There is typically a specific PMI factor associated with the range of LTV ratios. In this way, LTV determines the PMI factor, or the amount borrowers pay for PMI. Calculating PMI: the PMI is calculated by multiplying the PMI factor by the loan amount and then dividing the result by 12 to determine the monthly PMI payment requirement. This monthly PMI payment will be required every month until the borrower reaches at least 80% LTV. The loan amount is $100,000. Their PMI factor is 0.37%, or 0.0037. $100,000 x 0.0037 equals $370 divided by 12 equals $30.83. Based on this equation, the borrower will be required to add $30.83 to their monthly payment until they reach at least 80% LTV. PMI Cancellation Act: what did we mean before by at least 80% LTV? There is a law that we will talk about again in the fairness laws called the Homeowners Protection Act, HPA. HPA is also known as the PMI Cancellation Act, and provides the opportunity for the borrower to request that their PMI be cancelled at 80% LTV. This is approved/allowed, provided they've been on time with their payments and two other factors: the home's value has not declined since the time the loan closed. There are no new liens on title since the time the loan closed. Verifying these two factors will incur expense for the borrower in the form of a new appraisal and title work. Because of these expenses, many borrowers will allow for the PMI to remain until the LTV reaches 78%. At 78%, the lender is obligated under the rules of the PMI Cancellation Act to remove the borrower's PMI requirement. Insurances: mortgage insurance, funding fees, and guarantees. FHA loans, UFMAP and MIP. Now that we have a pretty good grasp on mortgage insurance based on our discussion in the introduction and through the block on private mortgage insurance, PMI, let's talk about FHA loans. As we said earlier, each form of mortgage insurance has a different name depending on the program. FHA requires two forms of mortgage insurance on its loans: mortgage insurance premium, MIP, and upfront mortgage insurance premium, UFMAP. FHA borrowers must pay both as a condition of receiving an FHA loan. Both MIP and UFMAP function like other mortgage insurances. They are designed to provide a safety net for the lender in case the borrower defaults and the proceeds from a foreclosure sale fall below the remaining loan amount. In cases of this shortfall with FHA loans, the premiums paid on UFMAP and MIP cover the lender's loss. Insurances: mortgage insurance, funding fees, and guarantees. Upfront mortgage insurance premium, UFMAP. Upfront mortgage insurance premium is a one-time fee on FHA loans, paid by the borrower at closing. UFMAP is a standard 1.75% of the loan amount. It can be paid with funds at the closing table or rolled into the amount financed. As an example, if our borrower receives a $150,000 loan, the UFMAP for the loan would be $2,625, $150,000 x 1.75%. The borrower could pay the $2,625 at closing or roll it into the loan and thus pay the UFMAP as part of the monthly payment. Mortgage insurance premium, MIP. Mortgage insurance premium, MIP, sometimes referred to as monthly mortgage insurance premium, is the FHA mortgage insurance that must be paid monthly by FHA borrowers. Like PMI, the premium amount is calculated annually and then distributed equally across the 12 monthly payments. These premium amounts and the factors used to determine them are available in the FHA chart below. In the chart you'll see that the FHA has divided their loans into two general categories based on loan term, those with terms beyond 15 years and loans with terms 15 years or less. You'll also see information about LTV, the MIP, and duration. You'll notice that in the chart they use something called BPS, basis points, to describe the MIP factor. Basis points, BPS, is just financial lingo for 1% of 1%. So if 1% is written mathematically as 0.01, 1% of 1% is 0.0001, or 1/1000th. So the MIP factor in the first available line of the chart is 80 BPS or 0.008. You'll also see that the length of time the borrower will be required to pay MIP is shown in the far right duration column. For loans with LTVs of 90% or less, borrowers are only required to pay MIP for 11 years. If the LTV at closing is higher than 90%, the borrower will be required to pay MIP for the full term of the loan. Insurances: mortgage insurance, funding fees, and guarantees. VA loans, funding fees, guarantee, and entitlement mortgage loans provided by the United States Department of Veterans Affairs carry a component that protects the lender in case of default, but it's not called mortgage insurance. Instead, the VA refers to a system involving entitlement, guarantee, and funding fees. At the end of the day, it all functions pretty much like mortgage insurance, but it's called entitlement and guarantee, and the borrower pays for it through the one-time VA funding fee. Here's a summary explanation of how it works based on general principles. How it works: a veteran receives a level of entitlement that is based on service record. Basic entitlement provides the borrower with a $36,000 guarantee on loans of $144,000 or less. If the loan amount is greater than $144,000, the basic guarantee is 25% of the loan amount. The guarantee is a commitment to the lender by the VA that if the borrower should default and the home is sold through foreclosure, the VA will make up the shortfall to the lender from the guarantee. So, if a borrower has basic entitlement and a full guarantee benefit, the lender knows that if foreclosure occurs there will be money available to cover the loss. While the VA doesn't come right out and say it, the cost for the guarantee is in some ways paid for by the borrower's funding fee. The basic funding fee for a first-time VA borrower without a down payment is 2.3% of the loan amount. Fees range from 0.5% to 3.6% depending on the circumstances of the loan. Circumstances include down payment amount, loan purpose as well as number of times the borrower has previously used a VA loan. One of the major benefits earned by a veteran is the right to waive the funding fee if they have a disability incurred because of their service, so it's possible that a VA borrower will not have a funding fee requirement. Insurances: mortgage insurance, funding fees, and guarantees. VA loan scenario: Adam is an Army veteran seeking to buy his first home. He contacts his friend Taylor at Fast Loans about getting a mortgage. Taylor takes him through the standard application process and finds that Adam qualifies for a VA loan. Adam buys a home for $135,000. He uses the no down payment option for his loan and rolls the 2.3% funding fee into the loan. The seller covers Adam's closing costs through seller concessions, so the only thing Adam is responsible for is the loan. After the roll-in of the funding fee, Adam's total loan amount is $138,105. Over the next 6 years, a lot changes for Adam. He gets married, starts his own business and becomes a father. He makes his monthly mortgage payments on time and leads a generally happy life. In the 7th year, things change again. Adam's business fails. To make matters worse, one day he comes home from a hard day of pounding the pavement looking for work, only to find that his wife and child are gone. All the furniture's gone too. There's a note left on the floor in the living room where the couch used to be in his wife's handwriting: "Sorry, but I can't be married to you anymore. Little Adam's at my folks' house, I'm headed to Mexico with a friend." This is all too much for Adam and he has some kind of breakdown. He just walks out the front door and never comes back. A few months after Adam's breakdown, Fast Loans is forced to foreclose on the house. They can't find Adam, and no one has been paying the bills, much less cutting the grass. The house is in shambles and Fast Loans sells the home through foreclosure. At the time of the foreclosure sale, Adam still owes Fast Loans $102,000. Because the house is in such disrepair, the home only sells for $90,000. Fast Loans is out $12,000, $102,000 to $90,000. This is where the VA guarantee comes into play. Remember, Adam's basic guarantee was $36,000. The VA provides Fast Loans $12,000 from Adam's guarantee to make up the difference. Sounds like mortgage insurance, right? Okay, but our story doesn't end here. Let's say some time passes and Adam resurfaces after spending the last decade strolling the beaches of California collecting sea glass. He's straightened himself out, started a new life, and he's making a mint in the sea glass art business. In fact, he's known as the king of sea glass by people who collect the stuff. All this time Adam's been living frugally, getting his finances in order and hoping that someday he can buy another house. He even shares joint custody of his son with his ex-wife's parents. She never came back from Mexico. By chance, he runs into his old friend Taylor at the grocery store. He tells her how sorry he is that he screwed up with the house and how he's gotten his life together. She tells him she understands and says she actually bought one of his pieces at an art gallery. She's a big fan of sea glass. He tells her that someday he'd like to take another shot at buying a house, but he's not sure if he could ever qualify again. She tells him that it may be possible and if he wants they can sit down at her office and take a look. She tells him that he should check out if he has any remaining guarantee available from his VA entitlement. And that's why the story didn't end. The VA allows a borrower to use remaining entitlement and guarantee benefits on a new loan, if there are any available, even if the previous loan ended in foreclosure with a portion of the guarantee being tapped to cover the loss. In Adam's case, $12,000 of his guarantee was used, which left him with $24,000 of available guarantee, $36,000 to $12,000. The remaining guarantee can be used for a new loan, provided he qualifies. The new loan may have different down payment and additional requirements because of the limited guarantee, but nonetheless the guarantee may still be available. While the scenario is a simplified one, it should help to explain how the VA funding fee, entitlement, and guarantee work for VA borrowers. Insurances: mortgage insurance, funding fees, and guarantees. USDA loans, guarantee and annual fee. The final version of programs and mortgage insurance we'll discuss is for USDA mortgage loans. Like the VA, the USDA does not call their financial protections for lenders in case of default mortgage insurance, instead they refer to guarantee fees and annual fees. While USDA offers multiple loan programs, the guarantee fee and annual fee, along with the protection they provide to the lender, are only available for loans offered through their guaranteed loan program, i.e., Single Family Housing Guaranteed Loan Program, SFHGLP. The protection that USDA provides to lenders with these loans is the same methodology seen with other mortgage insurances. Should the borrower default on the loan and the lender sell the home at a loss, they may be able to recoup, get back, a portion of the loss through payment from the USDA. The USDA is able to fund this protection through payment of the borrower's initial guarantee fee, which is paid at closing, 1% for purchase and refinance loans, and annual fee, 0.35% of the unpaid balance. The annual fee does not come due until 12 months after loan closing and is paid in monthly installments. As an example, if a borrower has an unpaid balance of $50,000 after the first year of making payments on their loan, the annual fee requirement would be $175, $50,000 x 0.35%. Therefore $14.58, $175 divided by 12, would be added to each loan payment for the next year. Insurances: hazard insurance. Hazard insurance. In this chapter we will break down what hazard insurance is and what it isn't. We'll also discuss what obligations the borrower has to the lender as well as the expectations servicers have. Finally, we'll discuss one of the unique hazard products, flood insurance, that your borrower may be required to carry, and touch briefly on other special hazard products that you may encounter in your role as a mortgage loan originator. One of the things that a mortgage lender will absolutely require of their borrower is hazard insurance protection. To be clear, hazard insurance protects the home in the event of disasters like storms, fires, floods and earthquakes. If one of these things happens and the home is damaged, the hazard policy covers the cost of repair or provides some other remedies such as reconstruction services. Basic homeowners insurance. In most cases, a basic homeowners insurance (HOI) policy will include the hazard insurance coverage for the natural disasters we described above. If the property is in a high-risk area for a specific type of hazard, that coverage may not be available as part of the basic policy and a special hazard policy may be required for that specific hazard. As an example, flood insurance is a form of special hazard insurance required when a home is located in a flood zone. Basic HOI may also include things like the cost for replacing contents of the home, example the borrower's TV, computer, and furnishings, as well as temporary housing services if needed due to the damage caused by the hazard. Those items are not part of the hazard coverage. HOI Simplified Homeowners Insurance, HOI, includes hazard insurance. Hazard insurance does not include HOI. Replacement value. The law allows lenders to require that borrowers carry hazard insurance on the mortgaged property, but only to the extent of the replacement value of the home. Replacement value is the amount of money needed to rebuild the home where it stands. Replacement value does not take into account property location or market value, only the cost of the materials, labor, plans, permits, etc. It's entirely possible for a small home in an exclusive community to have a low replacement value of $75,000 even though it could sell on the open market for $750,000. Meanwhile, a large home in a declining neighborhood might sell for $25,000, but cost $250,000 to rebuild. This conflicting dilemma is one that you should be aware of because as an MLO, you may encounter a borrower attempting to finance a home which costs them a minimal amount, but will require a significant amount of hazard insurance due to its high replacement value. Force-placed insurance. Force-placed insurance is hazard insurance obtained by a servicer on behalf of the creditor of a mortgage loan when no hazard insurance coverage is present on the mortgaged property. This could happen if a borrower allows their hazard insurance to lapse after the loan closes. Servicers may not charge a borrower for force-placed insurance unless there is reason to believe that the borrower did not meet the mortgage contract requirement of maintaining their own hazard insurance on their property. Before the servicer can place and charge for such insurance, the borrower must be provided with a force-placed insurance notice. This written notice must be delivered at least 45 days before the servicer assesses an insurance charge and contains the following: the date of the notice, the servicer's name and address, as well as the borrower's name and address, a statement that requests the borrower to promptly provide hazard insurance information for the property and identifies the property by its physical address, a description of the requested insurance information and how the information may be provided, a statement that the borrower's hazard insurance is expiring or has expired, and that the servicer does not have evidence of hazard insurance coverage past the expiration date, a statement that hazard insurance is required on the borrower's property, and that the servicer has purchased or will purchase insurance at the borrower's expense, a statement that insurance the servicer has purchased or will purchase may cost significantly more than insurance purchased by the borrower, and may not provide as much coverage. The servicer's telephone number for borrower inquiries. Flood insurance. As you read before, when a home is located in a high-risk area for a particular kind of hazard, the lender may require the borrower to carry a specific hazard policy for that threat. An example of this type of policy is flood insurance. During the appraisal process, the appraiser will determine based on available data if the home is located in a flood zone. If this is the case, ensuring that flood insurance is carried by the homeowner will be a condition set by the underwriter prior to loan approval. The appraiser or surveyor must determine the flood zone designation for the property's location, and this will determine whether the homeowner needs to obtain flood insurance. Flood insurance only covers the home above grade. Above grade means only the house on the ground, not under the ground. Basements are not covered, nor is the land upon which the house sits. So if the flood washes away the ground, flood insurance will not cover the cost of replacing the dirt the house is on. In many cases, homeowners required to obtain flood insurance can do so through the Federal Emergency Management Agencies, FEMA, National Flood Insurance Program, NFIP, or through a private insurer. Even with a private insurer, the federal government retains responsibility for the underwriting losses. Insurances. Hazard insurance. An area called a Special Flood Hazard Area, SFHA, designated by Zones A, AO, A, A130, AE, A99, AR, AR/A130, AR/AE, AR/AO, AR/A, AR/A, VO, V130, VE, and V, is defined as an area of land that has a 1% chance of being flooded within any given year. This is also called the base or 100-year flood mark. Flood insurance coverage must be equal to whichever of the following is the least: 100% of dwelling's replacement cost, the maximum insurance available from the NFIP, the unpaid principal balance, UPB, of the mortgage. Zones A and V are high risk where flood insurance is required. The maximum limit of coverage depends on whether you choose to buy a federal or private flood insurance policy. Coverage from the NFIP typically can't exceed $250,000 for your home structure and $100,000 for your personal property. Private flood insurers can provide much higher limits. Title insurance. Insurances. Title insurance. We're down to the last of the three insurances, which is title insurance. Title insurance protects the policyholder against unexpected claims against title. Remember, when we talk about title in our business, we're talking about ownership. Title is not a piece of paper or a document, it's simply another word for ownership. Therefore, title rights are ownership rights. What is title? The basis for the term title and ownership goes back to medieval times when royalty basically owned everything. Members of the royal family all had titles like king, queen, prince, princess, duke, duchess, or the king's sister. As a simple and partially historic fact example, King Henry VIII was the King of England from 1509, 1547. Because he was the king, he pretty much owned everything in the British Empire. If you know anything about Henry, he was a bit of a scoundrel and occasionally he needed to reward people or buy them off. One of the ways he did this was by granting them a title. For instance, when Henry wanted to divorce his fourth wife, Anne of Clovis, he granted her the title the king's sister and gave her Hever Castle to live in. So with the title of the king's sister, came ownership of Hever Castle, and we suspect a great many chuckles behind her back. Seriously, the king's sister, she should have held out for something a little more impressive like maybe Hever Clever, hey it rhymes. This is where the concept of title as ownership was initially created. As title relates to our business, people often just refer to title as one all-encompassing activity that includes the investigation and the insurance, but to be clear they are two different things. The title process in the mortgage industry actually consists of two different things: title work, research and investigation of the ownership of a property, and title insurance, protection for claims against that ownership. Title work: the title investigation process is requested by the lender's underwriter to ensure that the information provided by the borrower about the property and their ownership rights are correct. The investigation includes a review of the records associated with the property to see if there are any encumbrances, claims against title. Encumbrances could include existing mortgages, tax liens, judgment liens, or mechanics liens. We'll cover the title process in more depth in the third-party services block. Insurances: title insurance policies. Once the title work is completed, and provided the research findings meet the expectations of the title company and the underwriter, the title company will provide a commitment to insure. The commitment to insure is the title company's statement that if the loan closes they are prepared to provide title insurance in the case of a claim against title. The title company will offer two title insurance policies: lender's title insurance and owner's title insurance. Both policies protect the policyholder in case of title claims, but they are designed for different policyholders. Lender's title insurance: lender's title insurance is a policy that the lender will require, and the borrower must pay for. It protects the lender from any claims on title over the term of the loan. Let's say there was a missed tax lien that pops up a few years after closing, someone needs to pay it, and the title insurance does just that. Owner's title insurance: owner's title insurance functions in much the same way as lender's title insurance by protecting the property owner against claims on title, however it is optional. Owner's title insurance can be written beyond the length of the mortgage and for the entire period of ownership for the buyer. Chapter 15. Third-party services. Credit reporting. Third-party services. You may remember from our block on RESPA that there are many more players involved in a mortgage loan transaction than just the lender. While the lender provides the financing, there's a whole host of others needed to make the transaction work. These other participants are referred to as third-party services, or settlement services. Each one of these services comes with a fee that is charged by the service provider. In most instances this fee is passed on to the borrower. How the fee is handled is governed by the rules of RESPA. This chapter will provide a brief overview of what these services are and how they work. Credit reporting. As we've discussed previously, the credit pull is one of the first steps that an MLO will typically take when beginning the application process with the borrower. The beginning of the loan origination process is not the only time that the MLO will look at the borrower's credit report. Most underwriters will also review the borrower's credit just prior to closing to ensure nothing has changed. For example, if the borrower opens a new line of credit while the mortgage loan is in process, it could impact the borrower's credit profile and may cause them to no longer qualify for the loan. Credit reports are typically provided to our industry by the three major consumer reporting agencies: CRAs, Equifax, TransUnion, Experian. Third-party services credit reporting. Many providers of consumer credit will use a tri-merged report in which all three credit reporting agencies are represented in a singular form. These companies are the main third-party service providers for credit reporting. There is a fee for using these companies, which most lenders pass on to the borrower as a credit reporting fee. A consumer's credit profile may change daily. The credit report is typically valid 90 to 120 days, depending on the loan program. Each reporting agency calculates credit scores differently, but the following factors are commonly involved: payment history. 35% of the credit score. Paying bills on time is one of the best ways for a consumer to maintain a good credit rating. Credit use. 30% of the credit score. The ratio of current revolving debt, credit card balances, to the total available revolving credit limits. Credit history. 15% of the credit score. The length of the consumer's credit history. Credit type. 10% of the credit score. Whether credit is made up of installment, revolving, or other consumer finances. Inquiries. 10% of the credit score if there have been recent searches for credit and/or the amount of credit obtained recently. While a consumer's attempts to obtain new credit can have an adverse effect on their credit score, it is generally understood by the credit reporting agencies that multiple credit reviews, polls, by a specific segment of lenders for large ticket items, such as a mortgage or car, during a fixed shopping period of approximately 14 to 28 days should not negatively impact a consumer's credit score. Third-party services. Property inspection. Property inspection. In most circumstances, a property inspection is not the appraisal. We'll go into depth on the appraisal later, but for the moment consider that the property appraisal determines the property's value while the inspection determines if something may impact the home's structure in a negative way. Depending on the loan program, sewer, pest or other inspections may be required. State and local law may also require specific types of property inspection. As an example, VA requires termite and pest inspections in some states. Property survey. The property survey is usually conducted by a property surveyor and may be required in some mortgage loan transactions. The surveyor determines the property's physical boundaries by performing an on-site evaluation through measurement and inspection. The survey may be requested by the lender or the title company depending on the location of the property and the loan program. Appraisal. While it is necessary for the borrower to qualify for the mortgage loan, just as important to the final approval by the underwriter is the value of the subject property. For a mortgage application to be approved, the value of the home must meet minimum value thresholds. The determination of that value is the appraisal. Appraisal basics. Once the borrower receives an initial approval and the underwriter has confirmed the accuracy of the application with necessary documentation, an appraisal is ordered. Given the importance for the appraiser to operate independently, many MLOs will use a third-party appraisal selection company to assist in finding and assigning an appraiser to perform the appraisal. This additional step ensures that no undue influence can be put on the appraiser. The appraiser is required to provide a written report of their property valuation. The appraisal may include a visual inspection inside and outside of the property, and it may also include the exterior of the home and rooms inside. The appraiser does not include outlying buildings, such as detached garages, in their determination of value. Nor do they include certain basement or below-grade rooms in the home unless they meet a finished standard, no exposed cinder block, rafters, etc. The appraiser takes photographs of the home, and of comparable properties to provide illustration for their report. They also include a map showing the property's location. Third-party services. Appraisal rules and regulations. Valuation independence. Section 42 of TILA, the Valuation Independence Rule, requires that the appraiser operate independently of outside influences in the conduct of their job. TILA prohibits coercion of the appraiser and any improper characterization of value. TILA establishes boundaries for conduct between interested parties, MLOs, borrowers, and the appraiser, but that does not mean that all interactions are illegal. For instance, the appraiser can be informed of recent renovations to the home. The appraiser may even request receipts from the homeowner if available to determine costs. The underwriter can request additional information and explanation from the appraiser after receiving and reviewing the report. Underwriters may also request multiple appraisals to be performed on the property if necessary. USPAP. The Uniform Standards of Professional Appraisal Practice, USPAP, is administered by the Appraisal Foundation and provides the guiding principles of the appraisal industry. It's their safe manual. Point 1. The basic USPAP requirements for appraisals require the appraiser to identify the client, identify the reason for the appraisal, example loan, owner's information, buyer's information, describe the real estate, identify how the property is held, example fee. Simple, least fee, identify the appraisal approach, i.e., market, cost, income, provide relevant dates, describe the basis for and scope of the report, describe assumptions and hypothetical conditions. Third-party services appraisal program, specific appraisal guidelines. Each mortgage program includes some unique qualities and requirements for the appraisals done for their loans. Fannie Mae and Freddie Mac provide many of the industry standards, and their requirements serve as the benchmark for the entire industry. Fannie and Freddie include an appraisal independence requirement, with all their loans that mirrors TILA's valuation independence rule. Fannie and Freddie appraisals are good for 120 days. FHA follows the standards set by Fannie Mae and Freddie Mac, with one exception. The borrower's health and safety are FHA's chief concern as it relates to the appraisal, and therefore they require that any repairs needed to ensure health and safety must be made prior to closing. VA requires a Certificate of Reasonable Value, CRV, as its valuation documentation. The CRV does not list items in need of repair and is valid for 180 days. In addition to the CRV, the lender may require a full appraisal. USDA loans require that the home must be in livable and stable condition. The USDA does allow for repairs to be made after closing. The appraiser must provide an explanation if seller concessions exceed 6%. Appraisal adjustments. Appraisals in many ways are based on comparable property values. To ensure that the homes used for comparison meet an equitable standard, the appraiser uses a system of adjustments to compensate for the resulting difference in value. Each type of adjustment allows for a maximum threshold difference. If the adjustment item exceeds the threshold, either a viable explanation is required, or a new comparable property must be found. The adjustments and corresponding thresholds are as follows: line adjustments less than or equal to 10% for each line item, when comparing one specific item in the subject property to the same in a comparable property, such as number of bedrooms, and the value provided, the difference cannot exceed 10%. As an example, if the subject property sales price is $100,000 and the bedroom value in the subject property is $15,000 and the comparable property bedroom value is $18,000, the difference is $3,000. $3,000 divided by $100,000 equals 3%. So in this case the line adjustment is well within the tolerance. Net adjustments less than or equal to 15% for overall comparison. When comparing all the factors involved between the subject property and the comparable property, the net combination of items cannot exceed 15%. For example, if there are two adjustments, one of plus $3,000 and one of $2,000, the net adjustment is $1,000, $3,000 to $2,000. Using our previous $100,000 example, this would be a 1% difference and still within the 15% tolerance. Gross adjustments less than or equal to 25% for overall comparison. When comparing all the factors involved between the subject property and the comparable property, the gross combination of items cannot exceed 25%. For example, if there are two adjustments, one of plus $13,000 and one of $15,000, the gross adjustment is $28,000, $13,000 plus $15,000. If we use our $100,000 subject property value again, this $28,000 gross adjustment would exceed the 25% threshold and the appraiser would need to find a different comparable property. Third-party services appraisal. Appraisal approaches. There are three approaches to determine a property's value through appraisal. These are the sales comparison approach, the cost approach, and the income approach. The sales comparison approach is also known as the market approach and relies on 3 recent sales in the surrounding area, usually within a 1-mile radius. This is the most common approach and can be used for purchases or refinances. The cost approach is used for construction loans, remodeling, repairs, improvements and additions. The value is based on an analysis of the cost of materials, labor, planning, and oversight. This approach can also be used to determine replacement value for insurance purposes. The income approach is used for income-producing properties, example rental property. This approach determines the amount of cash flow the property can produce based on market rents and upkeep costs. A calculation using the net operating income of the property divided by the capitalization rate, the investor's expected return, is used to help determine the property's value. Appraisal forms. The Uniform Residential Appraisal Report, URAR, Form 1004, is the form most commonly used for appraisals. The URAR is considered a full appraisal because it includes an interior and exterior inspection of the evaluated property. All 3 valuation approaches, sales comparison, cost, income, should be considered for the 1004 report, but the appraiser must select the most suitable approach and justify the reasons. The URAR is not, however, meant to report the appraisal of a manufactured home, condominium, or cooperative. Point 2. The following are some other common forms used in specific appraisal circumstances. Exterior only, Form 2055, may be used if the lender only requests an evaluation of the home based on the exterior inspection. The appraiser may do outside measurements, review county records and take exterior photographs. 3. Small Residential Income Property Report, Form 1025. Used for unique investment home types such as multi-unit dwellings with unique layouts and varied unit sizes, example a duplex that was redeveloped from a single-family home. 4. Individual Condominium Report, Form 1073, used for condominium evaluations. Third-party services. Title. The title process investigates the legal ownership of the home as well as what liens or obligations may be associated with the property. The underwriter will request a title report on the property to ensure that there are no unforeseen circumstances that might impact the mortgage transaction, such as additional property owners, unpaid obligations, or lien priority of existing mortgages. Other areas of concern include easements and right-of-ways which obligate the property owner to allow for certain specific uses of all or sections of the property. These obligations and easements are called encumbrances because they restrict how the property can be used or sold. The information in the title report should match the information the borrower provided at application. If it does not, the success of closing the loan may be jeopardized. There are multiple steps in the title process, ultimately concluding with the purchase of title insurance should the loan close. Title process. A title company agent or attorney that is selected by the borrower performs title work. The goal is for the lender, at a minimum, to obtain a title insurance policy. When the title commitment is submitted to the lender, it usually comes in a package that includes the insured closing letter, the preliminary closing disclosure, HUD-1 settlement statement, payoffs, and wiring instructions for the funding of the mortgage loan. Title search. The lender will provide the title company or attorney with the borrower's name and property address. Based on this information, the title abstractor or attorney will do a search of the county records to establish the status of the property, example ownership, liens, judgments. It is the abstractor's responsibility to review the property's title and verify that there are no unsettled liens or claims against the property. Completed title report. This report is the product of the title search. Even though a mortgage applicant may be buying a property, in the case of a purchase, or already own the property, refinance, they may not be entirely aware of, or truthful about, the number of liens against the property. That's why it's crucial for a lender to obtain a title report for any property upon which they intend to make a mortgage loan. The title report shows a summarized history of the legal ownership of a real property, including any recorded documents that affect title. These records involve taxes, special assessments, judgments, mortgages, and other encumbrances, liens, that have ever affected the real property. The title report is also known as the abstract of title. Technical review. The title report will be analyzed by the title insurance company to determine accuracy. Once this review is cleared, the title commitment, which is a promise to issue a title insurance policy, is ready to be delivered. Third-party services. Title preparation of commitment to ensure. Once all open liens, judgments, and ownership interests are established, the title company will issue a title binder or policy to the lender. This binder identifies ownership, requirements that must be satisfied, and exceptions. Exceptions will be listed to show what the title insurance policy will not cover. Title insurance. Title insurance policies protect lenders or homeowners against losses due to disputes over the ownership of real property or claims against the title that may have been missed in the original title search. They are generally paid for with a one-time premium by the borrower. There are two types of policies that are typically issued: borrower's title insurance and lender's title insurance. Lender's title insurance is always required, however, the borrower's title insurance is optional. Underwriting. While the appraisal and title process are being worked on, the underwriter assesses the risk of the loan by comparing what information was given on the loan application to verification documentation. In some cases, the underwriter will put the loan through an automated underwriting system, AUS, to see if the loan should be approved or denied. Below are a list of the automated underwriting systems: 1. Do, Desktop Underwriter, /Do, Desktop Originator used for Fannie Mae loans. 2. LPA, Loan Product Advisor used for Freddie Mac loans. 3. Total, Technology open to approved lenders used for VA and FHA loans. 4. GUS, Guaranteed Underwriting System used for USDA loans. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO Chapter 16, Mortgage Math 2. What's the point? If you've worked in the finance industry, you may have heard the term point, used to describe a measurement of value, and it's no different in our business. In the mortgage industry, a point is equal to 1% of the loan amount. So if the loan is $500,000, 1 point would be $5,000, $500,000 x 1%. It's that simple. You may not need that calculator. Many mortgage loan originators will charge 1 point to originate a borrower's mortgage. So in that case, if the borrower has a $100,000 mortgage loan and the MLO charges them 1 point to originate, that mortgage, the origination fee is $1,000, 1% of the loan amount. If the loan were $310,000, the 1 point fee would be $3,100. Points are also used to help the borrower pay to reduce their interest rate. These are called discount points. Even though a point is 1% of the loan amount, it does not equal one interest rate percentage. Because the value of money and interest rates change constantly, using points as increments of cost creates a simpler way for the financial industry to keep pricing consistent. Points can also be used by the borrower to assist them in paying their closing costs through a lender rebate. A lender rebate is when the lender increases the borrower's interest rate, at the borrower's request, to cover closing costs. Let's say the borrower qualifies for a 4% rate, but doesn't have the money needed to pay the loan's closing costs. The lender can offer a rebate to the borrower to cover those costs. The chart below shows how discount points and lender rebates can impact loan costs. It also demonstrates how the discount or rebate will impact the loan's interest rate and the borrower's monthly payment. In the example, the borrower's qualifying rate is 4% on a $100,000 loan. This rate is also known as the PAR rate or 0-point rate because the rate has not been modified with discount points or rebates. In the example, the borrower's cost for his 0-point loan is $4,000. At 4%, the borrower's monthly payment would be $1,000 per month. The line above the 0-point rate shows what happens when the borrower pays one discount point to reduce his or her interest rate by 0.25%, from 4% to 3.75%, also referred to as a permanent buydown. This modification will cost the borrower $1,000 or 1% of the loan amount. Thus the borrower's cost on the loan would be $5,000, $4,000 plus $1,000, and the borrower's new monthly payment would be $975. On the other hand, if the borrower wanted to reduce the costs of their loan, they could do so by using a lender rebate. The line below the 0-point rate shows the borrower's interest rate increasing by 0.25% through a 1-point lender rebate. The rebate causes the borrower's cost for the loan to be lower, $3,000, $4,000 to $1,000. This increase in interest rate will result in a higher monthly payment for the borrower, $1,100 per month. Permanent buy-down discount points, good for long-term, PAR lender rebate lender credit, good for short-term, mortgage math 2 annual percentage rate. There's one other math concept we wanted to touch on up front because it may make some of our ongoing discussions easier to follow. Heck, you don't even need your calculator for this one. One of the biggest areas of confusion for consumers when they borrow money is the difference between the simple interest rate and the annual percentage rate, APR. While they seem like the same thing, they are actually much different. Whereas the simple interest rate is just the fee the borrower pays for using the lender's money, there are also many other costs that may be involved in a credit transaction. These fees are known as the cost of financing. They include the simple interest we discussed above as well as additional fees such as origination charges, discount points, and other lender fees. When expressed in dollar form, these costs are called finance charges. To better evaluate the true costs of a borrower's loan, we need to consider not only the simple interest rate, but also all of the other financing costs. When these costs are added together for the full term of the loan, distributed on an annual basis and expressed as a percentage in relation to the loan's initial principal balance, it is known as the annual percentage rate, APR. Because the APR includes all of the financing costs, it provides a much clearer picture of the cost of the loan. The APR is also dependent on the length of the loan, so it is important to compare loans with the same length of term. The below example is a simplified version of how APR works. The calculation for APR on a mortgage loan is complicated and dependent on the running principal balance of the loan. Most financial calculators include APR functions, and you can find numerous spreadsheet programs and online sites that provide the calculation. As we get further into your training, you will not be required to calculate APR, but it is necessary that you understand how it is determined. Per diem interest: when the borrower pays off their mortgage debt, the payoff amount isn't typically just the remaining loan balance. Depending on which day of the month the loan is paid off, the payoff may also need to include per diem interest, or interest for every day since the last payment was made. Per diem interest: new mortgage loan agreements seldom close on the first day of the month, and existing loans are rarely paid off on the last day of the month. Because of this, considerations must be made for the daily costs for interest. In this section, we'll break down per diem. Per diem is Latin for per day, interest. As we already discussed with PITI payments, lenders and servicers expect to earn interest on the loans they make. In fact, they expect to get paid for each day of interest for which the money is being loaned. This daily interest component must be included when a new loan is started or an existing loan is paid off. Remember, all interest is paid in arrears, or backwards, so if a borrower is paying off their loan on the 15th of June, they must pay for 15 days of interest for those 15 days of June. Calculating per diem interest: before we get into the daily interest calculation, there is one more thing you should know. In the world of calculating interest, there are always 30 days in each month regardless of the number of calendar days. This means that even though there are typically 28 days in February or 31 days in July, we still calculate interest based on 30 days. Keep in mind, to get to the daily interest, you'll have to first do the monthly interest calculation we already discussed. Once you have the monthly interest, you can then calculate daily interest, then you simply multiply to get the total daily interest based on the payoff date. Loan payoff. The reason it was necessary for us to figure out the daily, per diem, interest is because the calculation is necessary for paying off an existing mortgage or starting a new one. Now we can use that information to determine the loan payoff amount. The payoff is determined by adding the principal balance due to the amount of total daily, accrued, interest. For example, if the borrower owes $100,000 at a 5% interest rate, if they pay off the loan on the 15th of the month, their payoff amount would be $100,208.35. How did we get that answer? Principal balance due, $100,000 interest rate, 5% $100,000 x 0.05 equals $5,000, annual interest, $5,000 divided by 12 equals $416.67, monthly interest, $416.67 divided by 30 equals $13.89, daily interest, $13.89 x 15 equals $208.35, total daily interest, $100,000 plus $208.35 equals $100,208.35, loan payoff, prorated taxes at loan payoff. We also need to consider what the seller owes for prorated property taxes. Property taxes are paid annually and, therefore, it's likely that the buyer and seller will need to split the amount due for the year the sale occurs. The calculation for accomplishing this is known as proration. By performing the proration calculation, we can distribute the property tax payment according to how long the seller and the buyer own the home during the year. Before we can do this calculation though, you should be aware that property taxes are based on the number of calendar days in the year, and there are 365 property tax days per year, unless it's leap year, and then there are 366. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO Chapter 17, TILA governs TILA Truth in Lending Act, Regulation Z. The Truth in Lending Act, TILA, Regulation Z, was passed along with a series of laws designed to improve civil rights and consumer protections. TILA's main focus is to ensure that consumers make informed decisions when applying for and receiving financial credit. Point 1. In the next sections, we'll cover what the law is and what it isn't. Then we'll break down the law to give you the basics you'll need to conduct your job within its guidelines. After that, we'll break down the specific sections of the law that impact our industry. We'll finish up the section with the disclosures the law requires as well as penalties and record-keeping requirements. TILA governs people and organizations that regularly provide consumer credit. Forms of consumer credit include mortgages, auto loans, and credit cards. The law requires the delivery of standardized disclosures with information about the terms and costs of financing. TILA also includes advertising standards and prohibitions. Loans covered by TILA include entities that offer credit to consumers. Mortgages are a form of credit and subject to regulation when the homeowner's dwelling of 1 to 4 units secures the mortgage debt and is used for personal, family, or household purposes. Card issuers that make credit subject to finance charges or make the credit payable under a written agreement that requires repayment in more than 4 installments. Any person who extends consumer credit more than 5 times in the preceding calendar year. If a person did not meet these numerical standards in the preceding calendar year, the numerical standards shall be applied to the current calendar year. Any person who originates more than one credit extension subject to the requirements of a high-cost mortgage under HOIPA or one or more such credit extensions through a mortgage broker. Point 2. HOIPA loans are high-cost loans and we'll go deeper on HOIPA in a few pages. TILA does not govern TILA does not govern TILA is not responsible for business or commercial credit. This means that if a company wants a loan to finance its new headquarters or buy some inventory, that type of loan does not fall under the rules of TILA. The regulations set by TILA do not apply to the following individuals or businesses: those who extend business, Agricultural or organizational credit transactions involving credit in excess of $61,0003 if not secured by real property or a dwelling. Public utility credit that includes any credit that covers services provided via wire, pipe, or connected facilities. Credit extended by a broker registered with the Securities Exchange Commission or the Commodity Futures Trading Commission. Home fuel budget plans. Student loans made, insured, or guaranteed by the Higher Education Act of 19,654. TILA simplified. TILA's purpose is to promote the informed use of consumer credit. The law enables consumers to shop for the best loan for their needs by ensuring they have the information necessary to make an educated decision. TILA also includes sections that define high-cost and higher-priced loans with prescribed limitations on their use. As it relates specifically to mortgage loan originators, TILA has rules that govern their behavior and compensation. Two of the ways that TILA ensures borrowers can make an educated decision about their loan is through the timing requirements for disclosures, and mandatory waiting periods between disclosure delivery and loan closing. In the case of a refinance on primary residences and reverse mortgages, TILA allows borrowers to cancel the transaction after closing in certain circumstances. TILA requires that creditors advertise in a truthful manner, meaning that they can only advertise products and programs that are available. Because of the complicated financial information involved, TILA requires that terms for the loan be provided through advertising in a clear and conspicuous manner. Examples of a clear and conspicuous manner include showing the information in a standalone manner or through fonts and styles that draw the consumer's attention. TILA's advertising provisions also require that trigger terms, loan elements that require additional information to understand actual costs, cannot be included in an advertisement unless accompanied by the details necessary to fully comprehend how the term impacts the loan. An example of a trigger term is the simple interest rate. If a lender advertises the simple interest rate, they must also include the annual percentage rate, APR, so the consumer has a full picture of the financing costs in relation to the amount borrowed. TILA in-depth. The purpose of the Truth in Lending Act, TILA, Regulation Z, is to promote the informed use of consumer credit through disclosures about its terms and cost. TILA protects consumers by requiring creditors to advertise to consumers in a truthful way that is not misleading, enabling consumers, through a documented process, to withdraw from credit transactions related to their principal residence and by providing information related to high-cost and higher-priced loans. Permissible fees and finance charge requirements. TILA allows the inclusion of many fees or finance charges on a loan transaction. The finance charge is the cost of consumer credit as a dollar amount. It includes any charge payable directly or indirectly by the consumer and imposed directly or indirectly by the creditor as an incident to or a condition of the extension of credit. It does not include any charge of a type payable in a comparable cash transaction, example taxes. Applicable charges that are always included are interest, transaction fees, loan origination fees, aka consumer points, credit guarantee insurance premiums, mortgage insurance, charges imposed on the creditor for purchasing the loan, which are passed on to the consumer, discounts for inducing payment by means other than credit, mortgage broker fees, fees for preparing TILA disclosures, real estate construction loan inspection fees, fees for post-consummation tax or flood service policy, and any required credit life insurance charges. In other words, if the service or fee is necessary for financing to take place, it will typically be governed by TILA. Charges that may be allowed in certain circumstances, if bona fide and reasonable in amount, are varied. Charges that are not allowed include charges payable in a comparable cash transaction, e.g. taxes, fees for unanticipated late payments, overdraft fees not agreed to in writing, seller's points, membership fees, seller's discounts, interest forfeited as a result of interest reduction required by law, and charges absorbed by the creditor as a cost of doing business. TILA in-depth. Business day. In general, the Truth in Lending Act defines a business day as a day when the creditor's offices are open to the public for carrying out the majority of its business functions. A business day means all calendar days except Sundays and legal public holidays such as New Year's Day, the birthday of Martin Luther King, Jr., Washington's birthday, Memorial Day, Independence Day, Juneteenth, Labor Day, Columbus Day, Veterans Day, Thanksgiving Day, and Christmas Day. Advertising requirements. The Truth in Lending Act requires the following when it comes to the advertisement of financing secured by a dwelling. Only currently available credit terms may be advertised by the creditor. Any disclosures of information made in an advertisement must be clear and conspicuous. The standard for clear and conspicuous varies dependent on the delivery method of the advertising, but in general the information should be reasonably understandable and provided in a way that draws attention to its importance. If a simple interest rate is advertised, it must be stated in conjunction with, and no more prominently than, the annual percentage rate, APR. If the APR can change after consummation, it must be indicated in the advertisement. If the down payment, number of payments, amount of any payment, or the amount of any finance charge are provided in the advertisement, these are known as trigger terms. Any of these trigger terms requires that the following then be included in the advertisement: the amount or percentage of any down payment needed, the terms for repayment for the full term of the loan, example interest rate, length of loan, the annual percentage rate, and if the rate may increase after consummation. The phrase annual percentage rate must be spelled out in those words. If the amount of credit exceeds the fair market value of the dwelling, this must be stated in the advertisement. Such advertisement should also state that the consumer should consult a tax advisor for more information regarding tax liability for this particular type of loan. TILA also prohibits the following in advertising: misleading advertising of fixed rates and payments, misleading comparisons in advertisements, misrepresentations of government endorsements, misleading lender's name, misleading statements of debt elimination, misleading use of the term counselor, misleading foreign language advertisements. For TILA, important sections of TILA. Important sections of TILA. Because TILA governs more kinds of credit than just mortgages, it has numerous sections. For the purposes of your work as a mortgage loan originator, we'll focus on the following. Sections 19 Mortgage Disclosure Improvement Act 23 The Right of Rescission 32 Home Ownership Equity Protection Act 35 Higher Priced Mortgage Loans 36 The Loan Originator Rule 42 Valuation Independence 43 Ability to Repay and Qualified Mortgages. TILA, Section 19, Mortgage Disclosure Improvement Act, MDIA. The Mortgage Disclosure Improvement Act, MDIA, requires a 7-business day waiting period between the delivery of the initial disclosures and loan closing. This waiting period may be waived by the borrower in cases of a bona fide emergency. If a change of circumstance occurs, then a revised disclosure must be provided and an additional 3 business days must be added to wait for closing. One very important requirement of MDIA is the intent to proceed provision for all closed-end mortgages. This requires that the borrower must provide their intent to proceed with the loan process prior to the charge of any fee, with the exception of the credit report fee. The intent to proceed is not a commitment to the final terms of the loan, but is simply an indication that the borrower reviewed the early disclosures provided, specifically the loan estimate, and wants to move forward with the process. If the borrower is seeking an ARM, the delivery of the Consumer Handbook on Adjustable Rate Mortgages, CHARM booklet, and the early ARM disclosure are also required prior to the payment of any non-refundable fee. Annual percentage rate requirements. You may recall we've talked about finance charges once before, when we introduced annual percentage rate. APR is a uniform measurement of the cost of a loan, including interest and finance charges, expressed as a yearly percentage rate. See Mortgage Math 2 to review how APR is calculated. TILA. Important sections of TILA. Permissible annual percentage rate tolerances. TILA has thresholds in place to ensure that, if pricing fluctuates during processing, the resulting change in APR is communicated appropriately to the borrower. The tolerance for the increase in the annual percentage from the early disclosure to the closing disclosure on a TILA-governed transaction is 0.125%, 1/8, on fixed-rate mortgages and 0.25%, 1/4, on variable rate, adjustable rate, mortgages. Example: if the APR listed on the loan estimate for a 30-year fixed-rate mortgage is 4%, The APR can be no more than 4.125% on the closing disclosure. If allowable circumstances during the loan origination process such as a change in borrower qualification causes the borrower's rate to change beyond the tolerance, disclosures impacted by the rate change must be redisclosed to the borrower. These changes are referred to as a change in circumstance. Examples of things that could cause a change in circumstance are a change in the value of the property after the appraisal, or a change in the borrower's credit score while they are in process. If at the time of closing it is discovered that the rate listed on the closing disclosure is greater than the tolerance compared to the rate listed on the loan estimate, or redisclosed LE, the creditor has 30 days from closing to remedy the error by reducing the interest rate on the loan to remain within the tolerance. Waiting period to close requirements. TILA requires that the borrower must wait 7 business days from receipt of the initial disclosure, initial truth in lending for open-end mortgages, loan estimate for all other mortgages, before the loan can close. This waiting period is designed to provide the borrower an opportunity to evaluate and understand their loan before they sign anything making them contractually obligated for the debt. This waiting period can be waived in the case of a bona fide emergency. TILA, Section 23, the right of rescission. The right of rescission allows consumers who have closed on non-purchase mortgages, reverse mortgages or refinance loans, on their primary residence to back out of the transaction after closing. This right of rescission only applies to reverse and refinance loans and includes anyone with title, ownership, rights to the home, even if they are not a borrower. Any owner may execute their rescission right to cancel the transaction for any reason. Conditions involving the property must be returned to status quo, normal, as if the loan process never occurred, if the right to rescind is exercised. The right of rescission is communicated to all owners of the property at closing through the delivery of the notice of right to cancel disclosure. All owners get 2 copies. The time frame for canceling the transaction is 3 business days from closing. After 3 business days, the loan will be consummated, meaning that the borrower is contractually obligated to the agreement. If all of the owners do not receive the notice of right to cancel, the time frame for rescission becomes 3 years from the date of closing. 1. Important sections of TILA: consummation vs. closing. There is a difference between closing and consummation. Closing is when all parties commit to the loan. Consummation is when the borrower becomes contractually obligated to the loan. Even though you would think once someone signs a contract they're obligated to pay the bill, this isn't always the case with mortgage loans. TILA's right to rescind allows reverse mortgage and refinance, on a primary home, borrowers to cancel the agreement even after it is signed. With rescission rights, these borrowers have 3 business days from closing to change their mind and cancel the agreement. In cases where the right to rescind exists, lenders will typically not fund a loan until the 3 business day period passes. Once the loan is funded, the agreement is consummated and the documents are filed with the county. Waiting until the rescission period passes to fund and record the mortgage allows the lender to avoid hassles in case the borrower has second thoughts. Some state laws include rescission periods for loans other than those covered in the TILA rules, but you can worry about those later when you're preparing for your state licenses. TILA, Section 32, Home Ownership Equity Protection Act, HOEPA. HOEPA provides protections for borrowers receiving high-cost, aka covered, loans. HOEPA defines what high-cost loans are and includes numerous provisions to limit the type of loans allowed. A specific disclosure must also be provided to borrowers who seek a high-cost loan. The reason the HOEPA provisions exist is to protect consumers with limited finances or credit challenges from excessive costs when financing their home. What is a high-cost loan? There are 3 main criteria that can be used to determine if a loan is high-cost. Total points and fees compared to the loan amount. 2. If the loan is $22,696 or more, the points and fees cannot exceed 5% of the loan amount. As an example, if the loan amount is $50,000 and the total cost of points and fees is $2,500.01 or more, then the loan is considered a high-cost loan. If the loan amount is less than $22,696, then points and fees cannot exceed 8% of the loan amount or $1,148, whichever is lower. The loan's APR compared to the APOR. If the loan's APR is more than 6.5% above the APOR, average prime offer rate, the average APR for low-risk consumers in the current market, on a first lien, 8.5% above the APOR on a first lien for a mobile home, or 8.5% above the APOR on a subordinate lien, the loan is considered high cost. Prepayment penalty. If the creditor charges a prepayment penalty beyond 36 months or if any prepayment penalty exceeds 2% of the principal balance, the loan is considered high cost. 3. Minimum terms for balloon loans. While the requirements for HOIPA loans make it unlikely that a balloon loan fits the criteria, there are a few scenarios in which balloons may meet HOIPA standards. The balloon may not have a term of less than 5 years. The payment schedule is adjusted to meet the seasonal or irregular income pattern of the borrower. The loan is a bridge loan, 12 months or less, to facilitate the financing of a new home purchase while the borrower is attempting to sell their current home. The lender is serving an underserved or rural area and the loan meets ATR/QM requirements. TILA. Important sections of TILA. Prohibitions under Section 32. If a loan is a high-cost loan, it cannot contain a balloon payment, negative amortization, or a DTI 50%. Requirements under Section 32. If a borrower is getting a high-cost loan, then the borrower must receive counseling prior to closing. HOIPA disclosure. If the loan meets the standard of a high-cost loan, the mortgage loan originator must provide a HOIPA disclosure, also known as the covered loan notice, to the borrower at least 3 business days prior to consummation. The disclosure includes many of the features already provided to the borrower in other TILA disclosures, such as the statement of no obligation, the APR, regular payment amount and the amount borrowed. Points and fees with HOIPA loans. Regulations associated with HOIPA loans do not allow the borrower to finance the loan's costs, aka rolling in the points and fees. As it relates to this requirement, HOIPA does not consider the following as points and fees: any premium, paid before or at closing, associated with any federal or state agency program for guarantee or insurance, example UFMAP or funding fee, mortgage insurance paid before or at closing up to 2 discount points for the purpose of reducing the interest rate under HOIPA. Fees paid to brokers may be paid by the creditor or borrower, but if they're paid by the borrower, they must be considered to be a finance charge and included with the points and fees calculation to determine if the loan meets the high cost threshold. TILA. Important sections of TILA. TILA, Section 35, Higher Priced Mortgage Loans, HPML. The TILA provisions for HPML were written to help protect borrowers who have qualification limitations. A lender or servicer may cancel the mandatory escrow account for HPMLs if the borrower pays off their mortgage debt in full and/or at the request of the borrower, 5 years after closing, provided the unpaid balance is less than 80% of the original value of the home and they are current with their payments. Because of this, lenders will charge a higher rate of interest to alleviate their risk. In the case of HPMLs, the P stands for price. In the business of lending, we price loans by using interest rates. What is a higher-priced mortgage loan? APOR thresholds for HPML. HPMLs are closed-end loans on a borrower's primary residence where the APR meets or exceeds the APOR threshold by the following: 1.5% for first lien mortgages, 2.5% for jumbo first lien mortgages, 3.5% for subordinate lien mortgages. Requirements for HPML. TILA's requirements for HPML include mandatory escrow accounts and full physical appraisals. TILA also requires a second appraisal if the seller has acquired the home within a 90-day period and the sale price in the current transaction exceeds the seller's original purchase price by more than 10%, or if the seller has acquired the home within a 180-day period and the sale price in the current transaction exceeds the seller's original price by more than 20%. This second appraisal requirement is to protect against substandard improvements made to the home by house flippers, someone who buys a home and quickly resells it at an inflated value. Higher-priced mortgage loans less than $28,500 are exempt from the special appraisal requirements. TILA, Section 36, the Loan Originator Rule. The Loan Originator Rule was added to TILA by the CFPB to address concerns over the influence of compensation practices on MLO behavior. The rule also includes some provisions related to servicing rules. The rule specifically outlaws steering consumers into products that provide higher compensation for the MLO, and further enhances this protection for consumers by limiting how the MLO can be compensated. There are also servicing requirements outlined in Section 36 of TILA. The servicing requirements in Section 36 ensure that servicers process payments on the day they are received, handle late payments appropriately, and provide payoff statements within 7 business days of request. Compensation for MLOs may be paid based on the size, amount, of the loan, a salary, and additional compensation such as bonuses. MLOs are prohibited from receiving payment more than once for a single loan. This means that a mortgage broker cannot be paid a broker fee and an origination fee on the same loan. Prior to Section 36, this was legal, receiving payment based on the terms of the loan. Example: the MLO cannot be paid more for an ARM than a fixed-rate mortgage, steering consumers to loans that generate higher compensation for the loan originator, unless the loan is in the best interest of the consumer. As an additional note on the issue of steering, the rule provides the opportunity for the mortgage loan originator to obtain safe harbor in complying with the anti-steering requirement by presenting to the qualifying consumer multiple loan options, one that offers the lowest interest rate, one with no risky features, and one with the lowest cost for origination points, fees, and discount points. Servicing rules under TILA. The servicing requirements in Section 36 require that servicers process payments on the day they are received, handle late payments appropriately, and provide payoff statements within 7 business days of request. There is also a provision under Section 36 that prohibits servicers from fee pyramiding or fee stacking, which is the process of charging a late fee for the late payment or non-payment of a previously unpaid late fee. TILA, Section 42, Valuation Independence. TILA's Valuation Independence Rule is a direct response to the impact inflated appraisals had on the real estate market and the mortgage industry at the time of the mortgage meltdown. Section 42 specifically outlaws the coercion and undue influence on property appraisers by parties such as MLOs and borrowers. This section forbids someone from requiring or compelling, through acts such as intimidation or bribery, an appraiser to provide a specific value on the property being appraised. TILA, Section 43, Qualified Mortgages, QM, and Ability to Repay, ATR. Section 43 was added to TILA by the CFPB to establish specific minimum standards for mortgage loans, qualified mortgages, QM, and requirements for the review of a borrower's ability to repay, ATR. For a mortgage to be considered a qualified mortgage, the borrower must meet the ATR standards. The statement and the guidance during the mid-2000s, prior to the mortgage meltdown and the rules created to resolve the financial crisis, regulatory agencies saw the potential for the problems that ultimately changed the face of the mortgage industry. In response to this concern, these agencies created 2 directives advising the industry of the possible future pitfalls and how to address the issues. These 2 directives, the Statement on Subprime Mortgage Lending, the Statement, and the Guidance on Non-Traditional Mortgage Product Risks, the Guidance, were not binding laws but provided the basis for what would ultimately become the qualified mortgage rules implemented by the CFPB. The statement focused on the problems that might occur in providing high-cost or sophisticated product types to borrowers with limited qualifications or troubled borrowing histories. In some ways, the warnings in the statement led to the language in Dodd-Frank dealing with UDAAPs. TILA. Important sections of TILA. The guidance provided recommendations with warnings on how lenders should administer high-risk mortgage products and dealt with 3 key areas: loan terms and underwriting standards, risk management policies for lenders and MLOs, consumer protection issues. Ability to repay. Explain the ability to repay, ATR, is based on the standards first established in the statement and the guidance. The ATR is based on the following 8 borrower considerations: 1. Income and assets. 2. Employment. 3. The amount of their new monthly mortgage payment. 4. Other mortgage payments. 5. Monthly mortgage-related obligations 6. Current debt obligations 7. DTI and residual income 8. Credit history. Qualified mortgages, QM, are mortgages that meet a specific standard regardless of the program from which they are provided. The specifications associated with QM create more certainty for investors when they buy loans from lenders in the secondary market. Qualified vs non-qualified mortgages. Qualified mortgages, QM, are loans that are considered less risky due to the standards and thresholds required during the qualification and underwriting process. A mortgage loan must meet the following 8 criteria to be considered a QM. 1. The regular periodic payments do not result in an increase of the principal balance, negative amortization, allow the consumer to defer repayment of the principal, interest only, or contain a balloon payment. A balloon payment mortgage loan is a qualified mortgage if made and held in the portfolio of a small creditor operating primarily in rural or underserved areas. Loans are only eligible if they have a term of 5 years or longer, a fixed interest rate, and meet certain basic underwriting standards. These loans are not subject to the 43% DTI requirement. 2. The loan does not include balloon payments that are twice as large as the average of earlier scheduled payments. 3. Income and financial resources, assets, of the consumer are verified and documented. 4. For fixed-rate loans, the underwriting process is based on a payment schedule that fully amortizes the loan over the entire loan term, to maturity, and takes into account all applicable taxes, insurance, and other assessments. 5. For adjustable rate loans, the underwriting process is based on the maximum interest rate allowed during the first 5 years of the loan. It is also based on a payment schedule that fully amortizes the loan over the entire loan term, maturity, taking into account all applicable taxes, insurance, and other assessments. 6. The loan complies with guidelines established by the CFPB relating to ratios of total monthly DTI or alternative measures of ability to repay. Currently, the maximum total DTI ratio required for a qualified mortgage is less than or equal to 43% TILA. Important sections of TILA 7. The total points and fees payable in connection with the mortgage loan do not exceed 3% of the total loan amount, i.e., the points and fees threshold. Bona fide discount points in most cases are excluded. Loans greater than or equal to $114,847 points and fees cannot exceed 3% of the loan amount. Loans greater than or equal to $68,908 but less than $114,847 points and fees cannot exceed $3,445. Loans greater than or equal to $22,969 but less than $68,908 points and fees cannot exceed 5% of the loan amount. Loans greater than or equal to $14,356 but less than $22,969 points and fees cannot exceed $1,148. Loans less than $14,356 points and fees cannot exceed 8% of the loan amount. 8. The term of the mortgage loan does not exceed 30 years, except if extended by the CFPB in high-cost areas. There are 2 additional designations that are frequently associated with QM loans: GSE eligible qualified mortgage, for loans eligible to be purchased, guaranteed, or insured by government-sponsored enterprise, HUD, FHA programs, VA, or USDA, same loan feature limitations as a general qualified mortgage in which negative amortization, interest only, and balloon payments are not allowed. Same term limit of 30 years, and the same 3% points and fees limitation. All other underwriting criteria are applicable per GSE or agency requirements. Small creditor qualified mortgage. A small creditor is defined under Section 1026.35 of TILA as a financial institution whose assets equal less than $2 billion at the end of the year and whose total originated loans equal 2,000 or less of first lien closed-end residential mortgages, subject to ATR requirements. For loans made by small creditors, the same general qualified mortgage criteria applies, with the exception of the 43% DTI rule. If the small creditor considers and verifies a consumer's housing and total DTI ratios, then no specific DTI limit applies. For QM mortgages, there is also a limitation for prepayment penalties. A prepayment penalty is a charge to a borrower, on a closed-end mortgage loan, for paying all or part of the principal before the maturity date of the loan. Prepayment penalties are allowed on fixed-rate, qualified mortgage loans that are not higher priced if the following additional criteria are met. The prepayment penalty period does not extend beyond 3 years. The maximum prepayment penalty cannot be more than 2% in the first 2 years, and 1% in the third year. The creditor can only offer the consumer a covered transaction with a prepayment penalty if the creditor also offers the consumer an alternative covered transaction without a prepayment penalty. A creditor must also keep evidence of compliance with the QM rule for 3 years after the closing of a transaction. Subject to these rules, non-qualified mortgages, non-QM, are loans that do not meet the QM standard. Loans that do not meet QM standards cannot be sold to Fannie Mae or Freddie Mac and are either sold to private investors or held by the lender in their own loan portfolio. Disclosures required under TILA. Disclosures required under TILA. TILA requires a number of disclosures be given to the borrower throughout the loan process to provide guidance, notification, and education for the consumer. Required disclosures: general TILA disclosures, loan estimate, closing disclosure, HOIPA disclosure, covered loan notice, notice of right to cancel, CFPB's Home Loan Toolkit, Consumer Handbook on Adjustable Rate Mortgages, early ARM disclosure, TILA servicing ARM adjustment disclosures, open-end, reverse-end HELOC, mortgages only, initial TIL, final TIL, what you should know about your HELOC, general TILA disclosures. The general rules of TILA require that the mortgage loan originator disclose the following to the consumer as part of the consumer credit origination transaction: statement recommending that the consumer retain a copy of all loan-related disclosures, statement that terms are subject to change and the consumer may receive a refund of third-party fees, statement that borrower default could result in the loss of the property, statement of no obligation, loan estimate, LE, required under the general rules of TILA and the TILA-RESPA integrated disclosure rule provides an estimate of all costs for the transaction given to all borrowers at the time of application or within 3 business days if mailed. Closing disclosure, CD, required under the general rules of TILA and the TILA-RESPA integrated disclosure rule provides all the final costs of the transaction given to all borrowers 3 business days prior to consummation of the loan. HOIPA disclosure, covered loan notice, required for borrowers with high-cost loans, repeats much the information provided in earlier disclosures must be given to the borrower at least 3 business days prior to consummation. TILA disclosures required under TILA: notice of right to cancel, right to rescind, required under Section 23, the right of rescission only available on primary residences for non-purchase transactions, reverse or refinance mortgages, given to all parties with ownership, title, interest in the property, each gets 2 copies. At closing, borrower can rescind within 3 business days of closing if a copy of the notice is not given to an individual with ownership interest, then the rescission right is extended to 3 years. Home Loan Toolkit, special information booklet, purchase transactions only must be delivered separately to the consumer at application, or within 3 business days if mailed, informs the consumer of the mortgage process, includes explanation of affordability, how to shop for a mortgage loan, review of the loan estimate and closing disclosure, adjustable rate mortgage, ARM disclosures, Consumer Handbook on Adjustable Rate Mortgages, CHARM booklet, required under Section 19, MDIA educates the consumer on risks and advantages of ARMs due to the borrower at application, or prior to the payment of a non-refundable fee. Early ARM disclosure required under Section 19, MDIA educates the consumer on the specifics of their ARM, rate, adjustments, caps, index, etc. Due to the borrower at application, or prior to the payment of a non-refundable fee. Rate adjustment disclosures provided during servicing. Initial interest rate adjustment disclosure required under Section 36. The loan originator rule due 210 to 240 days prior to rate adjustment includes information about the servicer and possible alternatives to avoid paying the new interest rate, provides the effective date of the new interest rate and the new payment amount, as well as any other changes to loan terms ongoing, subsequent, Interest rate adjustment disclosure required under Section 36. The loan originator rule due 60 to 120 days prior to rate adjustment includes information about the servicer and possible alternatives to avoid paying the new interest rate, provides the effective date of the new interest rate and the new payment amount, as well as any other changes to loan terms, TILA penalties, TILA open-end mortgage only disclosures, initial truth in lending statement, TIL. Provides an estimate of the costs for financing must be delivered to the consumer at application, or within 3 business days if mailed. For reverse mortgages and HELOCs only includes interest rate, financing charges, annual percentage rate information. What should you know about your HELOC? When your home is on the line, due at application or within 3 business days, educates the consumer on the structure of a HELOC as well as what to look for when shopping for a HELOC plan. Final truth in lending statement, TIL. Due date at close or 1 day prior if requested by the borrower, used to compare the financing costs listed on the initial TIL. TILA penalties. Penalties for the violation of TILA include monetary fines ranging from $400 to $4,000. Class action equals up to $500,000 or 1% of the creditor's net worth, whichever is less. Willfully or knowingly breaking TILA rules may result in fines as high as $5,000 and 1 year in prison. Violations of the loan originator rule can result in actual damages of 3x the amount paid to the originator. TILA record keeping. The record keeping requirements for TILA are: records relating to TILA must be retained for 2 years after the disclosure is made or action is required to be taken. 1 Loan originator compensation records and records pertaining to ATR/QM must be retained for 3 years. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO. Chapter 18, Fairness Law, Fair Housing Act, FHA. In this chapter, we've grouped the Home Mortgage Disclosure Act, HMDA, Regulation C, the Fair Housing Act, FHA, and the Homeowners Protection Act, HPA, as laws specifically involving fairness for consumers. We've also taken the laws related to financial crime that impact the mortgage industry and gathered them here. The fairness laws were designed to level the playing field for consumers seeking mortgage loans, and in some cases, these laws go far beyond our daily responsibilities in the mortgage industry. The financial crime laws may seem as if they are far from your responsibilities, but the opportunity for illegal acts is prevalent in our business. As you read through this chapter, pay attention to how these laws may have already impacted your life. Fairness Law, Fair Housing Act, FHA. The Fair Housing Laws and the Fair Housing Act, FHA, were enacted to prohibit discrimination in the financing, sale, and rental of dwellings. The laws ensure equal opportunity in all HUD programs and equal access to housing. Discrimination based on the following is not allowed: race, color, national origin, religion, sex, familial status, disability. Please note, ECOA prohibits discrimination in extension of credit while the FHA prohibits discrimination in housing. The regulatory authorities for the fair housing laws are HUD and the Department of Justice, DOJ. HUD administers the Fair Housing Act, but the Department of Justice is the regulator and enforcer. Any transaction involving a purchase, rental, or financing of a dwelling is covered. The following are exempt under the Fair Housing Act: owner-occupied buildings with no more than 4 units, single-family housing sold or rented without the use of a broker if the owner does not own more than 3 such single-family homes at a time, housing operated by private clubs or organizations that limit the occupancy to members only. Fairness Law, Fair Housing Act, FHA. The original act was amended in 1989 by the Fair Housing Amendments Act to do the following: prohibit discrimination based on disability or familial status, presence of children under the age of 18 and pregnant women, establish new administrative enforcement tools for HUD attorneys to bring actions before administrative judges on behalf of victims of housing discrimination, revise and expand DOJ jurisdiction to bring suit on behalf of victims in federal district courts. The Act also contains accessibility provisions for individuals with disabilities. The provisions relate to design and construction on multifamily dwellings built on or after March 13, 1991. Redlining is a prime example of a Fair Housing Act violation. Any customer or consumer can bring action within 1 year of discovering a violation. Civil and criminal charges may be assessed. Fairness Law Home Mortgage Disclosure Act, HMDA, Regulation C Home Mortgage Disclosure Act, HMDA, Regulation C The Home Mortgage Disclosure Act, HMDA, was enacted by Congress in 1975 and implemented as Regulation C. The creation of HMDA came from concerns about credit shortages in specific geographic areas, especially urban neighborhoods. HMDA requires financial institutions to maintain and annually disclose data about home purchases, home purchase pre-approvals, home improvement, and refinance applications involving 1 to 4 unit and multifamily dwellings. The Home Mortgage Disclosure Act defines a dwelling in a fairly broad way. According to HMDA, a dwelling is defined as a residential structure. No language is included that an attachment to real property is required. The law lists the following as dwellings covered by HMDA: principal residences, second homes and vacation homes, investment properties, residential structures attached to real property, detached residential structures, individual condominium and cooperative units, manufactured homes or other factory-built homes, multifamily residential structures or communities, such as apartment buildings, condominium complexes, cooperative buildings or complexes, and manufactured home communities. HMDA's regulatory authority is the CFPB. HMDA loan data requirements apply to financial institutions such as banks, savings associations, credit unions, and other mortgage lending institutions. Institutions originating fewer than 100 closed-end mortgage loans in either of the 2 preceding calendar years will not have to report such data. Loan data from state-chartered or state-licensed financial institutions are exempt from HMDA because these institutions are already subject to state disclosure requirements. However, institutions must specifically apply for this exemption. Fairness Law Home Mortgage Disclosure Act, HMDA, Regulation C. The following loan types are also excluded from the data collection requirements under HMDA: loans originated or purchased by an entity acting as a fiduciary agent, loans on unimproved land, temporary loans, bridge or construction, the purchase of an interest in a pool of loans, such as mortgage-backed securities, the purchase solely of the right to service loans acquired as part of a merger. HMDA requires lending institutions to submit a loan/application register, L/AR, to the CFPB no later than March 1 of every year. A modified L/AR, without application or loan number, application date, and date of action taken, must be available to the public by March 31. The L/AR must include the following information: the purpose of the loan, home purchase, home improvement, refinancing, the type of property involved, single family, multifamily, the loan type, conventional loan, FHA loan, VA loan, the location of the property, information about race, ethnicity, and sex gathered in the URLA Section 8, demographic information, the gross income of the borrower, whether or not the loan was granted. If the loan was denied, the reason why it was denied, whether the interest rate charged was over a certain threshold. If the loan was subsequently sold in the secondary market, the purchasing entity. Civil penalties may be levied for violations of HMDA, bona fide errors are excluded. The L/AR must be retained and available for public inspection for 3 years. Fairness Law Homeowners Protection Act, HBA Homeowners Protection Act, HBA. The Homeowners Protection Act, also known as the PMI Cancellation Act, provides specific provisions that allow homeowners to cancel private mortgage insurance, PMI. It also requires the return of unearned premiums and establishes notification and disclosure requirements. HBA covers conventional mortgage loans that exceed 80% LTV in which the borrower is paying private mortgage insurance, PMI. Please note, we did not say MIP. HBA only covers conventional mortgages and PMI. HBA is regulated by the CFPB. The notice of right to cancel PMI disclosure must be provided to the borrower at the time of closing for conventional loans over 80% LTV. The content of this disclosure educates the borrower on how PMI may be cancelled upon request or automatically. The lender and/or servicer must automatically terminate the PMI when the loan's principal balance reaches 78% of the original value, as long as the borrower is current on mortgage payments. Unlike when the borrower requests cancellation, there is no provision in the automatic termination section of the Act that protects the lender against decreasing property value or subordinate liens. Borrowers may request in writing a cancellation and termination of PMI when the following conditions are met: the principal balance of the loan reaches 80% of the original value, the borrower has a good payment history, the borrower is able to represent to the mortgage holder that the value of the property has not declined below the original value and certify that the borrower's equity is not subject to a subordinate lien. 1. For individual actions, actual cost or statutory damages are not to exceed $2,000. The borrower must bring action within 2 years of discovering action. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO Chapter 19, Financial Crime Laws. Financial Crime Laws USA Patriot Act. In your role as an MLO, you may participate in transactions involving large sums of money. Because of this, you'll need to have an understanding of some financial crimes including money laundering. In fact, in your new role you'll have some unique responsibilities in the battle against terrorism. USA Patriot Act, uniting and strengthening America by providing appropriate tools required to intercept and obstruct terrorism. As a response to the September 11, 2001 terrorist attacks, the U.S. Congress enacted the Uniting and Strengthening America by providing appropriate tools required to intercept and obstruct terrorism, USA Patriot Act of 2001. In relation to the mortgage industry, Title III of the Act focuses on identity theft and money laundering through financial transactions in support of terrorist activities. The most important aspects of Title III for mortgage professionals are the required establishment of the following: an anti-money laundering program by the lending institution, the sharing of information with other financial institutions and law enforcement agencies, a customer identification program, CIP, that includes the collection and verification of customer information, including name, date of birth, social security number, and address, the 5-year maintenance of records after the account is closed, and the notification to customers that their identity must be verified in order to attempt a transaction. 1. The expectation is that the institution can track the customer's transaction activity throughout the process and report that activity, if necessary, to the proper agency. Financial Crime Laws BSA and AML. BSA and AML Bank Secrecy Act and Anti-Money Laundering. The Currency and Foreign Transactions Reporting Act is commonly referred to as the Bank Secrecy Act, BSA, or the Anti-Money Laundering Law, AML. BSA/AML requires financial institutions, including mortgage lenders, to report suspicious activity that may indicate money laundering, tax evasion, or other criminal activities. Money laundering is transforming the monetary proceeds derived from criminal activity into funds with an apparently legal source. Originally created as a method to thwart drug traffickers and tax cheats, BSA/AML gained renewed importance following the September 11, 2001 terrorist attacks. Due to concerns about funding methods terrorists used for their illegal activities, lawmakers amended the rules associated with BSA/AML and related portions of it with the USA Patriot Act. Anti-Money Laundering Program Requirements. The BSA authorizes the Financial Crimes Enforcement Network, FinCEN, and the Secretary of the Treasury to take measures against financial crimes by requiring financial institutions to implement strict anti-money laundering, AML, programs and other procedures to prevent illegal activities. An AML program must include the following components to guard against financial crimes: develop internal policies and control systems that ensure compliance with the BSA for record keeping and reporting, appoint a compliance officer to oversee the program's daily operations, implement an ongoing training program to train people to detect potential financial crimes, perform an independent audit when necessary. Financial Crime Laws BSA and AML reports used under BSA/AML. FinCEN Form 104 Currency Transaction Report, CTR. A CTR must be filed for each transaction in currency of more than $10,000. FinCEN Form 105 Report of International Transportation of Currency or Monetary Instruments Report, CMIR. Each person, including a bank, who physically transports or mails monetary instruments in an aggregate amount exceeding $10,000 into or out of the United States must file a CMIR. Report of Foreign Bank and Financial Accounts, FBAR. Each person, including a bank, subject to the jurisdiction of the United States and with an interest in, signature, or other authority over one or more bank, securities, or other financial accounts in a foreign country must file an FBAR if the aggregate value of such accounts at any point in a calendar year exceeds $10,000. Suspicious Activity Report, SAR. Banks must file an SAR for any suspicious transaction relevant to a possible violation of law or regulation within 30 days of initial presentation and review of fraudulent activity. If no specific suspect is identified, the time period can be extended to 60 days. Chapter 20, Disclosures and Documents. What's a disclosure? Disclosures and documents. In this chapter we'll be reviewing many of the disclosures we discussed in other chapters related to the laws that require their delivery to the borrower. We'll begin the chapter with a deep dive on the TILA-RESPA Integrated Disclosure Rule, TRID, which provides authority under TILA to combine disclosures required under TILA and RESPA into singular disclosures. These TRID disclosures cover the requirements expected under both laws. We'll focus most of the discussion in this chapter on TRID because the delivery of these two disclosures plays a prominent role in borrower education for closed-end loans. What's a disclosure? In simple terms, to disclose means to tell or inform. In our business, there are three types of disclosure requirements: basic, written, and form. The basic disclosure means that the law compels, requires, the MLO to disclose to the borrower certain information like, you should keep all of the documents you receive for this transaction. Basic disclosures do not have specific requirements for how they must be provided to the borrower, but most MLOs provide them in written form to ensure the borrower can keep a copy. Written disclosures are just what they sound like, disclosures that must be provided in writing. Form disclosures are disclosures that must be provided to the borrower on a specific type of form. For example, the loan estimate and closing disclosure are two forms that must be used when a borrower is in process for a closed-end mortgage. What's TRID? The Dodd-Frank Act required improved consumer mortgage disclosures, and so the CFPB developed the TILA-RESPA Integrated Disclosure Rule, TRID, also known as the Know Before You Owe Rule, KBYO, to simplify the information provided to mortgage borrowers in the disclosures required by TILA and RESPA. In essence, TRID used the information found in two already existing early disclosures, the Good Faith Estimate, GFE, from RESPA and the Initial Truth in Lending Statement, TIL, from TILA, as a basis for the creation of the loan estimate. Likewise, TRID used the information found in two already existing final disclosures, the HUD-1 Settlement Statement, HUD-1, from RESPA and the Final Truth in Lending Statement, TIL, from TILA, as a basis for the creation of the closing disclosure. What's TRID? Simplifying TRID. The TILA-RESPA Integrated Disclosure Rule calls for combining some of the disclosure requirements under RESPA and TILA into more consumer-friendly documents. The details of settlement costs and finance charges that were once provided to the borrower in separate forms are now combined in the loan estimate and the closing disclosure. TRID applies to all closed-end mortgages. TRID does not apply to open-end forms of credit. This means that reverse mortgages and HELOCs are exempt from the requirements of TRID. TRID was created to simplify the information provided to mortgage loan borrowers. The early disclosure requirement for TRID is met by the loan estimate, which provides an estimate of settlement and finance costs. The closing disclosure is provided as a final disclosure and provides the final costs for settlement and financing. TRID also added some new specific requirements to the mortgage loan origination process. The requirement to gain an intent to proceed from the borrower, which resides in Section 19 of TILA, MDIA, is a result of TRID. To review, a borrower must provide their intent to proceed with the loan process to the MLO prior to being charged any fees. The intent to proceed may be provided verbally, electronically, or in written form. The MLO is obligated to retain a record of this intent for a period of 3 years from the date upon which it was received. Charges and fees disclosed. The TRID disclosures provide information about numerous costs and fees that previously were disclosed on multiple disclosure documents. This reduction in paperwork simplifies the process for consumers. The following costs and fees are available on the TRID disclosures and broken down into 2 categories: loan costs and other costs, disclosures and documents. The loan estimate. The loan estimate. The loan estimate, LE, is a 3-page document containing an estimate of credit terms and closing costs. The LE is delivered at the time of application. Think of it as the borrower's menu. It tells the borrower what everything costs. Information on the loan estimate is valid for 10 business days from the date of disclosure. This means that the borrower must provide their intent to proceed within 10 business days. If the borrower does not provide their intent within the 10-day period, a new LE must be generated based on the new current circumstances. These new circumstances may include changes in the borrower's qualification profile. The LE must be retained for 3 years from the date of consummation by the MLO or lender. The loan estimate should help the consumer recognize and comprehend the expense, risk, and characteristics of the loan for which they are applying. The loan estimate contains a good faith estimate of the charges in dollar form a borrower may face throughout the loan process. These estimates are good for 10 business days from when the loan estimate is provided. It also contains other essential information related to the loan, example the interest rate and the annual percentage rate. Revised LE must have reasons for revision. A main thing to note about the loan estimate is that a mortgage loan originator cannot charge or collect any fee, except for a credit report fee, until the loan estimate has been disclosed and the potential borrower has explicitly expressed their intent to proceed. If an MLO provides a consumer with a written estimate of terms or costs specific to that consumer before the consumer receives the loan estimate, the MLO shall clearly and conspicuously state at the top of the front of the first page of the estimate in a font size that is no smaller than 12-point font, your actual rate, payment, and costs could be higher. Get an official loan estimate before choosing a loan. The loan estimate. The loan estimate. Page-by-page loan estimate. Page 1. Page 1 is a summary of the transaction and is directly comparable to the closing disclosure in terms of the information provided. Loan term. This section provides the important information about loan amount, interest rate, a projected monthly principal and interest payment, and whether or not the loan contains a prepayment penalty or balloon payment. This section also asks the question, can this amount increase after closing? If the answer listed is yes, this could signify that the loan has the possibility of negative amortization or is an ARM. Projected payments. This section breaks down the estimated total monthly mortgage payment. This shows whether a loan has any associated mortgage insurance or fee. This section also breaks down if there is an escrow account and an estimate of how much the escrow payment could be. Another thing this section breaks down is whether the payment will change throughout the life of the loan. Costs at closing. The final section on page 1 is titled Costs at Closing. This separates and explains the estimated closing costs and the estimated cash to close. The estimated closing costs are broken down further on page 2. The estimated cash to close includes the estimated closing costs as well as any extra funds a borrower would need, such as the down payment. The loan estimate. Loan estimate, page 2. Page 2 is titled Closing Cost Details and is an initial overview and estimate of nearly all the costs a borrower may be charged for obtaining the loan as well as any costs for necessary third-party services. It breaks down into 3 sections: loan costs, other costs, and calculating cash to close. Loan costs. The first section on page 2 of the loan estimate is titled Loan Costs and is divided into subsections A, D. Subsection A is titled Origination Costs. These are the costs the mortgage loan originator charges for originating the loan. These costs may include any discount points a borrower will pay or any rebates the borrower will receive. The cost of these services cannot change at closing. Subsection B is titled Services You Cannot Shop For. These are necessary costs of the loan process. Some main costs that fall under this category are an appraisal fee, a credit report fee, and a flood determination fee. A borrower cannot shop for these services for a couple different reasons. For example, a borrower cannot choose who does their appraisal, as it could easily lead to fraud. Another example is a borrower cannot choose where their credit report comes from, since there are only 3 generally accepted credit reporting agencies, and normally a lender will look at all 3, using the middle score for qualification purposes. The cost of these services as a whole may change by up to 10% at closing. Subsection C is titled Services You Can Shop For. It includes other necessary costs of the loan process. A couple main charges under this subsection are a pest inspection fee, a survey fee, and title-related fees. Typically, a mortgage loan originator will provide a list of suggestions for these services, although a borrower can choose whoever they desire to perform these services. If the borrower chooses a provider suggested by the MLO, the threshold for change is the same with the cost variance of 10% listed for subsection B. If the borrower chooses a provider not recommended by the MLO, there are no limits on a variance of cost. Subsection D is titled Total Loan Costs. It is the sum of subsections A, B, and C. Other costs. The second section on page 2 of the loan estimate is titled Other Costs. It is broken down into additional subsections E, J. Subsection E is titled Taxes and Other Government Fees. The main fee here is the transfer tax. It is the cost the government charges for processing and recording the transfer of ownership interest in the property. Subsection F is titled Prepaids. The main costs under this subsection are homeowners insurance, property taxes, prepaid interest, and any applicable mortgage insurance, guarantee, or funding fee. A borrower must pay these various charges in advance of when they are technically due, hence the term prepaid. A borrower often pays for 1 to 12 months of these items prior to or at closing. Subsection G is titled Initial Escrow Payment at Closing. This subsection breaks down any necessary escrow payments needed at or before settlement. Subsection H is titled Other. The services found here are usually optional, such as an owner's title policy or a pest inspection fee. Subsection I is titled Total Other Costs. It is a sum of the costs in subsections E, F, G, and H. Subsection J is titled Total Closing Costs. It is a sum of the total loan costs, subsection D, and total other costs, subsection I. Disclosures and documents. The loan estimate calculating cash to close. The third section on page 2 is titled Calculating Cash to Close. This is an estimated summation of all funds necessary for the borrower to close their loan. The main things in this section are the total closing costs, subsection J, as well as any down payment, earnest money deposit, or other adjustments. Many times in a purchase transaction, a borrower puts down an earnest money deposit that gets deposited into a trust account. Since the borrower paid this in advance, it is subtracted from the total amount of funds required. Loan estimate, page 3. Page 3 is titled Additional Information about this loan. It shows the information about the mortgage loan originator or originators involved in the loan process. It also breaks down into 3 sections: Comparisons, Other Considerations, and Confirm Receipt. Comparisons. The first section on page 3 is titled Comparisons. It is meant to be used by the borrower as a tool for shopping for other comparable loans. This section includes a breakdown of how much principal and interest a borrower will have paid off in the first 5 years of their loan. This section also includes the annual percentage rate, APR, and the total interest percentage, TIP. As the loan estimate states, the TIP is the total amount of interest that you will pay over the loan term as a percentage of your loan amount. If there is a changed circumstance that causes the APR to change by more than 1/8% on fixed-rate loans or 1/4% on ARMs, the initial LE needs to be redisclosed with the updated costs. Other considerations. The second section on page 3 is titled Other Considerations. This section's intent is to give the borrower a heads up on some of the other features of the loan or loan process. The main considerations are to provide the borrower with information involving appraisal, assumption, homeowner's insurance, late payments, refinance considerations, and servicing. Confirm receipt. The third and final section on page 3 is titled Confirm Receipt. This is where the borrower sign the loan estimate to confirm they have received it. As prescribed by the Mortgage Disclosure Improvement Act, MDIA, it contains a statement of no obligation. You do not have to accept this loan because you have signed or received this form. Disclosures and documents. The closing disclosure. The closing disclosure. The closing disclosure, CD, is a 5-page document containing the final amounts of all the costs involved in the transaction. It provides the final costs of the entire transaction. Think of it as the borrower's receipt. The CD is due 3 business days prior to consummation of the loan. Remember, consummation is different than closing, so depending on the transaction, like a refinance on a primary residence, closing could actually take place 3 business days prior to consummation, in which case the CD could be provided at closing. The borrower may request the CD 24 hours before consummation, and many lenders will simply provide it as a courtesy to avoid any confusion. The CD must be retained for 5 years from the date of consummation. If there are any errors on the CD, the MLO or lender has 30 days from the date of closing to correct the error. If there are any numerical errors on the CD, the MLO or lender has 30 days from consummation to correct the errors. For non-numerical errors, the time frame is 60 days. Creditors also must provide a corrected closing disclosure to correct non-numerical clerical errors and document cures for tolerance violations no later than 60 calendar days after consummation. Refunds due to tolerance errors must also be within 60 calendar days after consummation. Disclosures and documents. The closing disclosure. The closing disclosure, page by page closing disclosure. Page 1. On the very top of page 1 of the CD is the closing information, the transaction information, and the loan information. This is listed clearly at the top, so the borrower has a breakdown of many of the important features of the transaction. One thing to note under closing information is that it may list the sale price, the appraised property value, or the estimated property value. What is listed depends on what type of transaction the loan is. If it is a purchase, then the sale price will be listed. If it is a refinance where an appraisal was done, then the appraised property value will be used. If it is a refinance where no appraisal was obtained, then the estimated property value can be used. Loan terms, projected payments, and costs at closing. The rest of page 1 breaks down to 3 sections: loan terms, projected payments, and costs at closing. The amounts and features listed here should be nearly identical to the LE. Some parts are more apt to change than others. An example of a common difference would be the escrow amount increasing or decreasing from the estimate listed on the LE to the actual cost listed on the CD. Disclosures and documents. The closing disclosure. Closing disclosure, page 2. Page 2 of the CD is a further breakdown and itemization of the information on page 2 of the LE. It contains 2 sections: loan costs and other costs. The CD goes further than the LE, because it shows who is paying what, and when the cost is being paid. Loans costs also has a subsection titled Services Borrower Did Shop For, which needs further explanation. If the borrower shopped for a service that was on the written list of settlement service providers that the mortgage loan originator provided, it falls under the tolerances on the LE that we described earlier. Once again, the aggregate total of these costs should not increase by more than 10% of what was on the LE. But if a borrower uses a service not on this list, then the change in cost for these services from the LE to the CD can be any amount. Other costs. Other costs, as the name states, discusses some of the other costs a borrower will face in the loan interaction. These include costs such as taxes, insurance, home inspection fee, real estate commission, and title insurance. Disclosures and documents. The closing disclosure. Closing disclosure, page 3. On the top of page 3 of the CD is calculating cash to close. This is a continuation of the total closing costs and a further breakdown of the information on the previous page. Under the section Calculating Cash to Close is the subsection simply titled, Did this change? This is to help provide clarity to the borrower on what has or has not changed from the LE to the CD. If something has changed, it shows where to find and compare these figures. This helps both the originator and the borrower to see if these figures have stayed within the legal tolerances. On the bottom half of page 3 of the CD is the section titled Summaries of Transactions. This is where the CD starts to break costs down much further than the LE, which does not contain all the information located here. This section of the CD also has two columns, Borrower's Transaction and Seller's Transaction. This section further shows what is due at closing. It provides clarity for all parties involved by showing who the funds are going to and who they need to come from. Some main items found here are seller concessions, i.e., seller credits, or other existing loans. Closing disclosure, page 4. The header for this page and page 5 is additional information about this loan. Page 4 has only one section, and it is titled Loan Disclosures. This is where a borrower can read about some of the main features their loan does or does not contain. Some of these features are a demand feature, negative amortization, or assumption. Another focus of this section is to highlight whether the borrower will have an escrow account and make the borrower aware their escrow payment may change in the future. A final disclosure found at the bottom of the page states matter-of-factly, you may lose this property if you do not make your payments or satisfy other obligations for this loan. This straightforward statement is another way the CD helps a borrower understand the responsibilities involved with financing a home. Disclosures and documents. The closing disclosure. Closing disclosure, page 5. Page 5 is the final page of the CD. It contains 4 sections: loan calculations, other disclosures, contact information, and confirm receipt. It also has a box labeled questions. This gives the contact information for the CFPB. Loan calculations. Under the loan calculations section, the borrower can find how much in total dollars and cents they will pay over the life of the loan. This figure presupposes the borrower makes all payments as scheduled. This amount is a summation of a few different factors: the principal balance of the loan, the finance charge, any mortgage insurance or fee, and other loan costs. Two other important percentages here are the APR and tip. These should closely reflect what the borrower saw on the LE. As a reminder, if there was a changed circumstance that caused the APR to change by more than 1/8% on fixed-rate loans or 1/4% on ARMs, the initial LE should have been redisclosed to the borrower prior to the delivery of the CD. Other disclosures. The Other Disclosures section informs the borrower about a few more features of their loan. Two common ones are refinance, which states that any future financing of this property is subject to approval, and appraisal, which reminds the borrower about their right to receive a copy of the appraisal used to value the home. Contact information. The contact information section shows the main points of contact for all real estate and mortgage professionals involved in the transaction. Confirm receipt. The final part of the CD is titled Confirm Receipt. As with the LE, it is a statement of no obligation that informs the borrower, by signing, you are only confirming that you have received this form. You do not have to accept this loan because you have signed or received this form. This is to help let the borrower know that they can still legally walk away from the transaction at this point. Want to try some MLO exam practice questions? Go to www.learnbyhearing.com/MLO Chapter 21, Closing and Ownership. Closing 101. Closing. In this section, we'll discuss what MLOs consider to be the end of the loan process, but if you turn the table, the closing table that is, you'll see that for your client this is just the beginning. This chapter will cover closing, settlement types, funding methods, and the recording of the documents. Closing 101. You've probably heard the term closing table before. If you come from a background in sales, you recognize this to mean the place where the sales professional and the buyer come to an agreement on the terms of the transaction. If you're new to the business world and the mortgage industry in general, You might be envisioning a conference room with a big table. At the table are seated all of the parties involved in the transaction: the seller, the buyer, the real estate agents representing the seller and buyer, the mortgage loan originator, the lender, and the closing agent. While you may imagine all of those people at a table, in reality the closing table is more of a myth than a reality. Consummation vs closing. We've touched on this before, but let's revisit. There is a difference between closing and consummation. Closing is when all parties commit to the loan. Consummation is when the borrower becomes contractually obligated to the loan. Even though you would think once someone signs a contract they're obligated to pay the bill, this isn't always the case with mortgage loans. TILA's right to rescind allows reverse mortgage and refinance, on a primary home, borrowers to cancel the agreement even after it is signed. With rescission rights, these borrowers have 3 business days from closing to change their mind and cancel the agreement. In cases where the right to rescind exists, lenders will typically not fund the loan until the 3 business day period passes. Once the loan is funded, the agreement is consummated and the documents are filed with the county. Waiting until the rescission period passes to fund and file the loan allows the lender to avoid hassles in case the borrower has second thoughts. Some state laws include rescission periods for loans other than those covered in the TILA rules, but you can worry about those later when you're preparing for your state licenses. Closing a purchase. In the case of a purchase transaction, the closing agent will typically meet with the borrower first and have them sign the necessary documents and collect any payment of closing costs. Closing costs could include the down payment, loan fees, and prepaid items. This payment must be provided in the form of certified funds such as a bank check or wire transfer. By paying it this way there's certainty that the funds are available, and this also provides a paper trail for record-keeping purposes. Once the closing agent collects signatures and payment from the borrower, the closing agent then meets with the seller. At this meeting the seller will sign any necessary documents, and depending on the settlement terms, we'll talk about this later in this chapter, may provide the buyer's payment from the lender. Once both parties have signed their documents and have been paid, the closing agent will take the documents and file them with the county. Simultaneous closings. Before we talk about who signs what and when, it's necessary to explain that when real estate is purchased with a loan, the mortgage, there are actually 2 transactions occurring simultaneously, at the same time. One transaction involves the agreement between the seller and the buyer. The seller sells the home to the buyer for a specific sum of money. In exchange for the money, the seller gives title to the buyer. If no mortgage is involved, the buyer pays the seller and the necessary documents are signed. Done deal. When a mortgage is used by a buyer to purchase a home, the process becomes more complicated. This is where the term simultaneous closing comes into play. With a simultaneous closing, not only is the transaction between buyer and seller taking place, but there is also another transaction taking place between borrower, the buyer, and their lender. It's almost like a 3-way handoff in which the seller turns over title to the buyer/borrower, then the lender turns over the money to the seller. But the lender can't give the seller the money without the buyer/borrower promising to pay the lender. With a simultaneous closing the seller and buyer/borrower have a purchase closing while the buyer/borrower and lender have a loan closing. Both must occur at the same time for all parties involved to be satisfied with the agreement. Think about it this way, the seller is not going to give up the keys to their house unless someone gives them the money, and the buyer/borrower cannot give them the money without pledging the rights to the house to the lender. A refinance transaction is much simpler because the borrower already has title to the property and thus there are only 2 parties, the borrower and the lender, involved. Closing. A refinance. For the most part, a refinance closing follows the same steps as the purchase closing. The one big difference is that with a refinance, the borrower already owns the home so there's only one signing meeting rather than 2. In a refinance closing, the borrower meets with the closing agent, signs the necessary documents, and pays any required closing costs. In many cases, the borrower will roll those closing costs into the new loan, but this is not a requirement. There is a possibility that the borrower will bring cash to close, which we already understand has to be certified funds and not really cash. Once the documents are signed, the closing agent will then take the documents to the county for recording. Closing settlement types who must be present at closing: at a minimum anyone with ownership interest in the property, anyone with debt obligation interest in the loan, and or their representatives must be present at closing. Either party may send a power of attorney to the closing to represent them as well. The lender is typically represented by the closing agent at the closing. The MLO is not required at the closing but may attend. In general, the interested parties may bring or invite anyone they want to attend the closing. As a side note, in the state of South Carolina, the MLO is required to inform the borrower that they have the right to bring an attorney of their choosing with them to closing as an advisor or representative. The closing agent, aka settlement agent or escrow agent, is the facilitator for the closing process of a mortgage loan. If you think of the players in the closing process, example the borrower, the lender, the seller, as musicians, the closing agent is the conductor. The closing agent controls what documents need to be signed, when and where the signing will occur, and how the documents will be filed. They will also notarize, legally witness, the signatures made at closing and provide an explanation of the documents and fees. Beyond these basic responsibilities, the closing agent may prepare the documents prior to close, arrange for the setup of escrow accounts, and disperse funds to the necessary parties. Because of the responsibility with funds, the closing agent is typically required to be bonded or insured for this purpose. The closing agent is often an employee of the title company, or an attorney, but this is not a requirement. Settlement types: how a loan is settled, closed/consummated, is tied directly to how and when it is funded. In our industry, there are two basic methods for settling a mortgage loan: wet settlement or dry settlement. Wet settlement: a wet settlement is one in which the funds are dispersed to the parties at the time of closing. Or to be more literal, while the ink from the signatures on the documents signed at closing is still wet. A wet settlement is typically used for purchase transactions. If the method for settlement is wet, the loan also consummates at closing due to the exchange of funds. Some states prohibit wet settlements regardless of the type of loan. Dry settlement: now that you know what a wet settlement is, we'll bet you have a pretty good idea of what a dry one is as well. The dry settlement is one in which the funds are dispersed after closing. Or more literally, after the ink has dried on the documents signed at closing. The dry settlement is used for transactions covered by TILA's right to rescind, non-purchase loans, as well as many other loans in which it is unnecessary or illegal to disperse funds at the table, thus triggering consummation. Funding methods: closing funding methods. Now that we've figured out how to close and settle our loans, it might be a good time to discuss how the loans are actually funded. By funding we mean who actually provides the money for the loan. There's a lot more to it than a lender just writing a check. The three main funding approaches in the mortgage industry are table funding, warehousing funding, and direct funding. Each functions differently in how the loan and the flow of money works. Table funding: with table funding, the loan is closed at the table by the loan originator in their own name. For example, if the loan is originated by a mortgage broker using table funding as their approach, they would be responsible for processing and underwriting the mortgage and serve as the lender at the closing table. As the loan closes, a new lender, i.e., investor, immediately advances funds for the loan and the loan package is transferred to the new lender. The loan documents are then filed in the new lender's name. Table funding is a great tool for many MLOs because it allows them to maintain a relationship with their client throughout the entire loan process and with a minimal amount of expense, because the loan is transferred to another lender immediately at closing. Warehouse funding/lending: warehouse funding, aka warehouse lending, is a practice in which an investor provides funds from which the MLO may draw to close mortgage loans. These funds are sometimes referred to as a warehouse line of credit. In warehousing lending, the MLO closes the loan in their own name, like table funding, but instead of instantly transferring the loan over to the investor, the loan is held by the MLO until they sell it in the secondary market. Once the loan sells in the secondary market, the MLO pays the investor for the use of their funds with the warehouse line. The use of warehouse lending is popular with many MLOs because it allows them to be the lender on record. Some consider warehouse lending to be riskier for MLOs because of the possibility that they will be unable to sell the loan in the secondary market and will thus be unable to repay the warehouser for the use of the line of credit. Direct funding/lending. Direct funding is just like it sounds, the MLO is responsible for funding the loan. There are no intermediaries or investors involved when a loan is directly funded. The loan is funded directly by the lender. Recording closed, settled, funded. Now what? Can we start collecting payments? Not yet. As the last step in the closing process, some refer to everything that occurs after the closing table as post-close, so we could say this is the next post-close step. The appropriate documents must be filed with the registrar of the county in which the property is located. This filing process is known as recording. After the loan is consummated, the closing agent's final obligation is to record the documents. In an earlier unit, we discussed the issues of lien priority and who gets paid first when title is conveyed to a new owner. Making sure the documents are filed and recorded in a timely manner will ensure that the lien is placed in its proper position of priority for future settlements. Typically, the security instrument, which collateralizes the home as the pledged asset by the borrower, is recorded with the county. If the transaction is a purchase, the deed, which shows who owns the property, ownership is also referred to as title, will also be filed. Remittance and ownership. Servicing. After the loan closes, the borrower begins the process of paying the owner of the loan. The process of sending payment is known as remittance. If a borrower has a 30-year mortgage, that means they'll be remitting 360 times 12 monthly payments x 30 years. Servicing. The servicer is the collector of the borrower's monthly mortgage payment. Servicers collect and record borrower payments, administer the loan, handle ongoing communication with the borrower, manage the borrower's escrow account, if applicable, process/evaluate borrower proposals such as loan modifications and disperse payment receipts to loan owners. Some lenders will service their own loans while others will sell the loan servicing rights to another organization. Servicing rights are different than owning the loan. For doing their work, servicers are typically paid a fee or a percentage of the loan payment based on the loan's principal value. RESPA servicing rules. Under Section 6 of RESPA, servicers must set specific policies and procedures within their organization to meet certain RESPA-required objectives. The following 4 objectives are foremost. 1. Provide timely and accurate information, whether in relation to an information request, complaint, foreclosure process, or death of a borrower. Ensure that borrowers are well informed about procedures for submitting error notices and requests for information. 2. Properly process and evaluate loss mitigation applications. Loss mitigation is when a borrower seeks to resolve a defaulted loan with the servicer through arranging temporary terms such as extended payments or waived fees. Follow proper regulations with regard to the pre-foreclosure process. 3. Properly oversee and ensure compliance of all employees with relation to procedures and laws. Certain procedures must be followed with relation to a borrower's escrow account and/or hazard insurance policy. 4. Ensure that necessary information about probable or actual transfer of servicing are disclosed to the borrower, and ensure that all documentation is transferred during actual servicing transfer situations. TILA Servicing Rules. Section 36 of TILA has 3 basic standards that servicers must follow. Whereas RESPA servicing rules focus on the management and administration of the borrower's loan, TILA's servicing rules impact the timing of payments and the information associated with the loan's mechanics. Payment processing. Servicers must process a borrower's periodic, monthly, payment properly by crediting a borrower's payment to the loan account on the date the payment is received. This prompt application may be delayed if the delay in crediting does not result in any charges to the borrower or in the reporting of negative information to the consumer reporting agencies. Remittance and ownership recording. With regard to late fees on periodic payments, servicers can only charge a fee if the payment is received after the due date or after the courtesy period noted on the mortgage contract. Late fees cannot be charged solely because the borrower failed to pay a late fee on a previous mortgage payment. Payoff statements. Servicers must provide borrowers, upon request, an accurate statement of the outstanding balance that would be required in order to satisfy the borrower's mortgage as of a specified date. This payoff statement must be provided within a reasonable time, but no later than 7 business days after the borrower's request. In certain circumstances, such as if the loan is in foreclosure, where the payoff statement cannot be provided within 7 business days, it must simply be provided within a reasonable time. Periodic statements. For each billing cycle of a closed-end mortgage loan, a periodic, monthly, statement must be provided to the borrower with the following information: the amount due, including the payment due date, and the amount of any late payment fee that will be imposed if the payment is not received. If the transaction has multiple payment options, the amount due must be shown under each of the payment options. An explanation of the amount due, including a breakdown of how the principal, interest, and escrow, if applicable, will be applied. The total of all payments received since the beginning of the current calendar year must also be shown. Any partial payment information regarding how the payment will be applied. A toll-free telephone number and, if applicable, an email address that may be used by the borrower to obtain information about their account. Basic account information such as the outstanding principal balance of the loan and current effective interest rate. If the borrower is more than 45 days delinquent, a separate statement must be attached. This statement or letter must notify the borrower of possible risks that may be incurred, such as foreclosure, account history information, the total payment required to become current on the loan account, and a reference to a homeownership counselor. The periodic statement must be provided to the borrower within a reasonably prompt time after the payment due date, or the end of any courtesy period, of the previous billing cycle. The statement does not need to be provided more often than once a month, regardless of the billing cycle time frame. Reverse mortgage loans, timeshare plans, and certain fixed-rate mortgage loans with coupon books are exempt from this disclosure requirement. Remittance and ownership. Securitization. Securitization is what happens to a loan after it is sold into the secondary market. By selling these loans, the lender has fresh capital with which to make more loans. Loans can be packaged or bundled together into a financial security, investment, product that they will then sell in the investment marketplace. These bundles are commonly referred to as mortgage-backed securities, MBS. Types of MBS. The two most common forms of MBS are pass-throughs and collateralized mortgage obligations, CMO. Pass-throughs function as a financial trust in which investors buy shares. Investors are then paid their share of the payments made on the mortgages in the trust. CMOs consist of many MBSs combined. The CMO is then categorized into slices which are called trans-CHES. The trans-CHES are created based on the interest rate of the mortgages in the CMO. Trans-CHES with higher interest rates have higher investor risk, while those with lower interest rate have lower investor risk. The MBS marketplace. The MBS marketplace is made up of institutional investors and GSEs, government-sponsored enterprises. Lenders can sell their conventional conforming mortgages to Fannie Mae and Freddie Mac, or to investors. Because conventional conforming loans meet Fannie and Freddie's standards, they are considered of high quality in the market. These high-quality loans are then packaged by Fannie or Freddie as agency MBSs and sold in the financial markets. Loans that do not meet Fannie and Freddie's standards can also be sold in the secondary market. They cannot be packaged with conventional conforming loans, and are called non-agency MBSs. Government, non-conventional, mortgage loans can be packaged into non-agency MBSs that are guaranteed by Ginnie Mae. Ginnie Mae serves a specific purpose with non-conventional mortgages in that it functions in the secondary market as a packager and guarantor of MBSs comprised of government loans. Whereas with conventional conforming mortgages, Fannie and Freddie buy the mortgages in the secondary market and then package them as MBSs, Ginnie may buy government mortgages and package them as MBSs, but more prevalently Ginnie Mae provides insurance and serves as the guarantor to investors who buy government loan MBSs in case the MBS product fails. Repayment reconveyance repayment. In this chapter, we'll discuss potential options the borrower has to meet the commitment of their mortgage obligation to the debt holder. This could include paying off the loan in its entirety or encountering obstacles that cause the servicer to seek resolution without repayment. Reconveyance occurs when the borrower pays off the mortgage debt in full. This repayment can occur by following the monthly payment schedule or by paying the loan off early. When the loan is paid off, the lender is obligated to provide a document to the borrower showing that the homeowner has met their financial obligation and a guarantee that the mortgage encumbrance has been removed from the property's title rights, clearing the title. At the time of reconveyance, the lender is also required to file a deed of reconveyance in the county records. The deed of reconveyance shows names of lender and borrower, address and legal identification of the property, initial loan amount wherein county records the original transaction documents were filed. Sale. If the borrower sells the home, they must repay the lender the current principal balance owed on the mortgage. This responsibility can be found in the due on sale clause located in the mortgage contract. The basic language of the due on sale clause requires that the balance be paid to the lender if the property is sold or title is transferred. Refinance. A refinance mortgage is one in which the borrower pays the principal balance due on their mortgage with funds from a new lender. This refinance mortgage then replaces the borrower's current mortgage. To be clear, a refinance loan is a brand new loan that replaces the old loan. Common reasons a borrower will refinance their mortgage: cash out, C/O. The borrower taps into their available equity and receives funds at closing as part of their new loan agreement. Rate and term, R/T. The new mortgage provides a better interest rate or loan term for the borrower. Change of product type, black small square arm to fixed. The borrower wants the certainty of a fixed payment, or the current rates are low enough on fixed products to justify the change. Black small square closed end to open end. The borrower wants the flexibility of an open-end loan, or vice versa. Black small square forward mortgage to reverse mortgage. Borrower is 62 years of age or older and wants to avoid monthly payments. Default repayment. Sale. Default occurs when the borrower does not make their payment on time. To be clear, in the language of the mortgage agreement, the contract between lender and borrower, default occurs when the borrower does not meet their obligation. If the payment is late, the borrower is considered in default. The only way that default can be remedied, cured, is by paying the monthly payment amount plus the late fee. The default is cured by the borrower meeting their debt obligation. When a borrower is in default, the servicer will attempt to work with the borrower to resolve the issue. If payment, including the late fees, is not made within 90 days, the servicer will typically issue a demand letter. The demand letter is also known as the acceleration notice. Acceleration means that the borrower is now required to pay the entire principal balance due immediately. The acceleration is triggered by the default. Forbearance. Forbearance is a form of short-term relief for a borrower seeking to avoid foreclosure due to missed payments. The missed payments are typically due to some form of hardship such as job loss or illness. Forbearance allows the borrower to get back on track without losing their home through short-term payment reductions through an agreement by the lender to not foreclose while the borrower seeks a long-term solution. Modification. Loan modification is a revision or change of the existing mortgage agreement. Modifications may be provided by the lender or servicer when the borrower is unable to afford their current mortgage payment and it is determined that the borrower will be unable to refinance the mortgage. A modification is different than a refinance in that it is a change to the existing agreement, not a new loan. The modification may provide a lower interest rate, lower payments through extension of the loan term, or even a forgiveness of a portion of the debt. Foreclosure. If a borrower defaults on a loan, it allows the lender to gain possession of the property secured by the mortgage loan. Because foreclosure processes vary state to state, HUD has issued a timeline of events that a borrower can expect to experience if they enter into a foreclosure process. What follows is a summary of that timeline along with generalizations for ease of understanding. Because state law governs mortgage and foreclosure proceedings, consider the following: a brief explanation of the foreclosure process. When a borrower starts missing payments, their servicer will contact them and attempt to collect payment or understand the situation leading to the delinquencies. The servicer will attempt to work with the borrower to cure the default. Generally, after 3 consecutive months of delinquencies, the servicer will issue a demand letter or notice to accelerate. This tells the borrower the specified period of time they have to bring the mortgage current and avoid foreclosure. After 4 months of missed payments, foreclosure proceedings can begin, and the servicer will refer the borrower to an attorney. If an arrangement has not been made to bring the debt current, a property sale will be scheduled through the local sheriff or public trustee. Depending on the type of foreclosure allowed in the state, the lender might gain the property's title. Some states allow for a redemption period, which is the time after the sale of the home when the borrower may still be able to pay their outstanding debt and reclaim the property. Repayment default: lender and borrower rights. As long as a lender or servicer adheres to state law, they have the right to pursue recovery of their lost assets, either property or monetary, in the event that a borrower becomes delinquent. They may sell the property that they obtain title for, and can also seek reimbursement of any legal fees that were incurred throughout the foreclosure process. The borrower may seek legal counsel or the help of a homeownership counselor at any point in the foreclosure process. They may also petition their servicer for alternative methods to avoid foreclosure or challenge the validity of a foreclosure claim in court. Prior to the seizure of property by the lender or servicer from the borrower, many states offer some final borrower protections. With pre-foreclosure redemption, the borrower can avoid foreclosure by paying the lender or servicer the loan's principal balance as well as any accrued interest and fees. Post-foreclosure redemption occurs after the foreclosure sale and allows the borrower to reclaim their home by paying the foreclosure sale price, plus interest and fees, to the purchaser of the property. One of the most important factors involved with the rights of the borrower and the lender deals with whether the state follows lien or title theory. Legal theories of ownership: lien theory: when a borrower has a property secured by a mortgage lien, the lender doesn't actually hold onto the legal title. Therefore, to proceed with a foreclosure, the lender or servicer would first need to petition a court to obtain title before taking ownership of the property. Title theory: the lender actually holds legal title to the property secured by the debt until that debt is paid in full. Once the debt is paid in full, the lender will reconvey the property and title back to the borrower. If the debt cannot be paid, the lender can exercise their right to foreclose without petitioning a court. Types of foreclosure: judicial foreclosure: the lender or servicer is required to file a suit in court. In some states, such as lien theory states, this type of foreclosure is actually required so that the lender can state their case for recovering their losses through the acquisition and sale of the property. This type is allowed in all states. Non-judicial, power of sale, foreclosure: the lender or servicer has included a power of sale clause in the mortgage that allows them to sell the home in the event of a default. Instead of filing a suit in court, the home will go straight to auction. This type is not allowed in all states. Strict foreclosure: the lender or servicer files suit in court to reclaim the full amount of the defaulted debt. If the borrower fails to pay it within the specified period of time, the lender gains title to the property and is not obligated to sell it. This type of foreclosure is allowed only in a few states. Chapter 22, Ethics and the MLO. Ethics: Webster's Dictionary defines ethics as the principles of conduct governing an individual or a group. This chapter is focused on introducing you to the challenges a mortgage loan originator faces every day. Your responsibilities as a mortgage loan originator: adhering to the law is a necessity of our business, but is acting ethically just another way of saying, I obey the law? The answer is no. Ethical behavior requires the mortgage loan originator to not only follow the law, but also to ensure that we do not take advantage of the consumer. The concept that it is the consumer's responsibility to know the risks associated with a transaction does not apply in the mortgage industry. It's really the other way around. It's the mortgage loan originator's responsibility to ensure that the borrower understands everything associated with the transaction. Because of this you can consider ethics to be the law plus, meaning for a mortgage loan originator to act ethically they must not only follow the law, but they must go above and beyond the law to ensure that the consumer knows what they are doing. The following scenario is designed to help you understand the challenges that face mortgage loan originators and their clients on a regular basis. Be ready to discuss the scenario in class, the ethical dilemmas involved, and how you would respond. The dilemma. Jacob is a consumer who wants to buy a new home. He's owned his current house for the last 8 years, and while he works hard to make his mortgage payments on time, sometimes he runs a little behind. Balancing the costs and expenses of being a single dad with 2 teenage girls, Jacob occasionally paid his mortgage or other bills late so that he could take care of emergency or immediate expenses. On the positive side, it's been almost a year since he was late on a credit card payment and over 6 years since he was late on his mortgage or car payments. The other day Jacob and his daughters were returning from a weekend trip to the lake and passed a house with a for sale sign in the front yard. It's within walking distance of the beach at the lake and has a 2-car garage, something Jacob realizes he'll need now that the girls will be driving soon. When they get home, Jacob calls the number on the sign and talks to the real estate agent. The house is a new listing and they make arrangements for Jacob and the girls to swing by the next day for a tour. Sure enough, the girls love the house, and based on the price the seller wants, Jacob thinks he can afford it. He's making pretty good money now and has enough saved up to afford a significant down payment. He calls the 800 number of Easy Loans, a company that's always advertising about mortgages. At Easy Loans he reaches Allison, a mortgage loan originator who listens to Jacob's story. She tells him she'll take a look at the numbers and call him back in about an hour to let him know if there's a mortgage option that will fit his needs. Before Allison even hangs up, she knows that there are several products that Jacob qualifies for that fit his needs. Allison is really excited because it is the end of the month, and if Jacob decides to move forward before the end of the day, she'll hit her bonus goal. That bonus could really help with the new car she is thinking of buying. Allison runs the numbers and finds that there are 3 options for Jacob based on his qualifications, ethics and the MLO. Your responsibilities as a mortgage loan originator. As part of the Easy Loan process, Allison also reviews Jacob's credit report with her credit underwriter to ensure that Jacob's history will not impact getting his loan approved. She finds out that based on the length of time since Jacob's last late mortgage payment, if he waits 3 more months to apply for a mortgage, the derogatory information from the late payments will be removed from his report. This could significantly improve his credit score. A higher score would likely reduce his interest rate by 0.5%, which might result in mortgage payments as much as $50 lower per month than what he would be required to make if he decides to move forward today. Weighing the options as she thinks about what she should tell Jacob when she calls him back, Allison gets an email from her boss Juliana asking if Allison has any remaining leads for the month that might turn into loan applications. Rather than replying online, Allison knocks on Juliana's office door and is waved in. "I saw you talking to credit a little while ago," Juliana says. "Got anything cooking?" "Yes," Allison says. "I got a call this morning from a potential client named Jacob. He's really interested in a house he saw for sale and called to see if he could qualify. Based on the information he gave me, it looks like he's got a couple of good options." She hands her notepad to Juliana to show her the numbers. "The reason I was talking to credit is because Jacob's had some credit issues in the past and I wanted to make sure we wouldn't have any hiccups." "Well, do we?" Juliana asks. "Have any hiccups, I mean?" "Only that he's on the edge of his score going up in a few months," Allison says. "And if he waits a few more months to get a loan, his qualifications would be higher, meaning a better deal for him." "But that means no loan today," Juliana says. "Exactly," Allison says. "I'm not sure how to tell him. I mean, on one hand, he qualifies now, but if he waits it could save him a good deal of money. $50 a month adds up to $600 a year, that's a lot, especially for a single dad with teenage girls." "Sure," Juliana says. but who knows what the market will be like then. Waiting could mean higher interest rates, and that house is probably going to sell long before then. I know. Allison bit down on her lip. I'm just trying to think how I should present this to him. Tell him the truth, Juliana said with a wink. Allison grins. Sounds like a plan. Why are you talking to me then? Juliana asks. Call him back and let's get this one in the books. You only need one more loan to make bonus. Then she lowers her voice, and if you hit your goal, I can finally justify to the partners a promotion for you to director. Really? Allison says. So I'd have my own team to run. Juliana stands to walk Allison out. You bet. Before she opens the door to let Allison out, Juliana adds, plus, I'm pretty overwhelmed. You hitting goal and getting a promotion would make my life so much easier. As Allison walks back to her desk, her head starts to spin. Decision time, Allison thinks to herself. Jacob qualifies today, and it sounds like he really wants that house. Does it even make sense to tell him what might happen in the future if he holds off? Who knows where the market will be then? Will rates be higher? Will that house still be on the market for him? Ethics and the MLO. Your responsibilities as a mortgage loan originator. One more loan for bonus. That may give me enough to make a decent down payment on a new car. Juliana wants to promote me. She's counting on me to get this loan written. She sits down at her desk and starts writing her thoughts down on her notepad. Be prepared to discuss your thoughts on this scenario with a group of your fellow MLO candidates. Pay special attention to the ethics and fraud formula we covered earlier in the course. How does that impact your thinking as it relates to your own conduct? Mariama's business practices. Certain business practices, while they may help generate business, can be in violation of some fairness laws. It is not against the law to pursue business and make a decent living. But MLOs need to be careful that while they are attempting to create opportunities for themselves, they do not violate any specific laws and ensure their behavior remains ethical and above board. Mariama is a mortgage loan originator who has been in the industry for over 10 years and considers herself a savvy business professional. She uses advertising to generate business, because she knows if borrowers see an enticing low rate, they are more likely to call her up. The rates she is currently advertising are a stretch. Not many people will actually qualify for the lowest rate on her ads. In fact, the last time someone qualified for her lowest advertised rate was over 6 years ago, when the market supported rates that low. Thank you for listening. Now let's practice what you've learned. Try some MLO exam practice questions at www.learnbyhearing.com/MLO.